or maturity transformation outside the banking system lacked prudential oversight and took on positions that generated run risk and other vulnerabilities. And the global financial crisis also revealed the challenges that governments face in responding quickly to financial crises, reflecting the difficulty of assessing how serious the situation was at the time, reflecting issues around moral hazard and political constraints. So in the years following the global financial crisis, many countries tightened microprudential policies and adopted preemptive macroprudential policies to ensure the financial system could continue to function and support real economic activity during periods of stress. And this new macroprudential approach includes risk management and regulatory tools that can be applied to banks and non-banks. It also applies new governing bodies for decision-making. That is especially important when regulatory gaps exist and traditional regulators do not have mandates for financial stability. So in my remarks today, I want to look back at the tests and achievements of this macroprudential framework and look ahead at some emerging threats. And I want to look back at the macroprudential framework through the lens of the strains triggered by the pandemic and by Russia's invasion of the Ukraine, which has added to the economic and financial stress when monetary policy has shifted to starting to fight inflation. I'd also like to look ahead and test the macroprudential framework through the ongoing development of digital assets. So strictly speaking, the main difference between digital assets and more traditional financial products is that ownership of digital assets are supported by a new type of technology. But that should not make a fundamental difference from a policy perspective, as suggested by the idea that policy should be tech neutral. Yet, unlike earlier forms of non-bank financial intermediation that relied on the banking system, distributed ledger technology is designed to bypass banks and other intermediaries, and in a sense is an extreme form of non-bank intermediation. Not surprisingly then, digital assets give rise to new products or activities that do not fit neatly into existing regulatory strategies. So to preview where I'm going, overall, I believe the macroprudential approach and the reforms established since the great global financial crisis have substantially strengthened the core of the financial system. As evidence of this, the financial sector was supportive of the real economy during the recent risk events. But the events also suggest there could be adjustments to bank capital and to margin practices at CCPs to reduce procyclicality, and that reforms to reduce vulnerabilities in the non-bank sector have fallen quite short. And as the system evolves, including to digital assets, I believe the macroprudential framework is highly relevant, but developing the regulations will be complex, reflecting that features of digital assets themselves, as well as that macroprudential policy needs to be part of a broader government approach that also accounts for objectives such as uniform currency, monetary sovereignty, global competitiveness, as well as social issues such as privacy. So let me take a minute to just step back and talk about what the macroprudential framework is and what it's looked like over the past decade and a half. So turning to monitoring and measurement, most countries now produce financial stability reports. I think all central banks, major central banks, produce them. And they have covered leverage, maturity transformation, debt burdens of the non-financial sector, as well as asset prices. This monitoring is inherently multidimensional. You can see all the complex colored heat maps, but because they're trying to get banks and non-banks, and they try to capture in some way the complex linkages across the system. It's also useful for a macroprudential framework to have a quantifiable summary measure, much like price stability for US monetary policy of PCE inflation of 2%. So following the GFC, macroprudential policymakers tended to focus on various intermediate objectives, such as excess credit growth at banks or leverage, which were then linked to specific systemic measures and policy tools. These innovations helped put macroprudential policy in place, but they did not provide a way to understand aggregate risks to the economy. So a more comprehensive quantitative measure has been offered, starting with Tobias and Nina, who is here, Nina Boyachenko and Domenico Giannoni, who propose a summary measure of financial stability risks as the conditional forecast of GDP growth at a low percentile, which is labeled growth at risk. And many of you have probably heard of this. It links current financial sector conditions to future risks to economic growth. It builds on the empirical observation that the conditional distribution of forecast GDP growth varies over time and is not symmetric. And instead, for example, just putting the forecasted conditional distribution shows that while loose financial conditions, maybe because regulatory constraints are less binding, can reduce downside risk to GDP in the near term, those loose conditions are more prone to negative shocks, to a sharp tightening when a negative shock occurs, and growth at risk can become very negative in later quarters. An additional follow-up work with Tobias and others, I worked with him, we expanded the term structure of this growth at risk measure for 11 advanced economies and showed that loose financial conditions combined with rapid non-financial credit growth reduce downside risk to growth in the near term, but increase them later. And so moreover, we show these effects are causal. So a significant implication of this research, following on the original, is that there's an intertemporal trade-off where good times characterized by loose financial conditions can sow the seeds for a future financial crisis. And related work is underway by researchers at the Bank of England and others on bank capital or how currency mismatches can forecast growth at risk. And there's work beginning to link it to regulatory tools like the CCYB, the countercyclical capital buffer. So let me turn to some tools. Macroprudential policy tools, which were added as part of the post-global financial crisis reforms, included capital surcharges for systemically important banks, liquidity buffers, and new resolution standards. And Basel III also introduced a countercyclical capital buffer, which can be built up in boom times when cost of equity is relatively cheap, and then released in downturns to support lending to the real economy. For non-banks, the macroprudential toolkit is much less structured. And perhaps this is because non-banks often evolve in response to bank capital regulations, because banks in some ways remain the core of the financial system, at least because their liabilities tend to serve as money and payments. Yet non-bank financial intermediation has grown because of regulations, because of technology, and in the US, even as credit to households and businesses has been rising sharply, the credit to GDP ratio provided by banks has been flat for the last, say, 30 to 40 years. While the credit to GDP from non-banks has more than doubled, and that's been roughly from 30% to, say, to 70%. Ben Bernanke, in his new book, A 21st Century Monetary Policy, has cited the growth of non-bank financial intermediation as one of the three main reasons for changes in monetary policy in this century. The other two are the Phillips curve and the change in R-star. And third is the growth of non-bank intermediation. So an important tool for macroprudential policy authorities to bring new firms or activities into the regulatory perimeter are shown by some examples that both the US Financial Stability Oversight Council and the UK Financial Policy Committee, the FPC, have. One is the FSOC has the authority, the FSOC is the US Council, has the authority to designate non-bank financial firms as well as payment, clearing, and settlement activities for additional regulation as supervision as systemically important. And this could have led perhaps to prudential regulation of investment banks, the independent investment banks before the global financial crisis. And the FPC regularly is required to review the boundaries of prudential regulation. Other tools for non-banks will depend on their activities and the way the resulting vulnerabilities would affect the system. And former colleagues, Andrew Metrick and Dan Tarullo, have proposed something called a congruence principle for financial regulation, according to which activities that pose similar risks to financial stability should be subject to the same type of regulation, regardless of the legal form or charter. But they emphasize it does not imply necessarily that non-banks are subject to the exact same rules as banks, because bank regulations also need to reflect microprudential reasons. And let me mention the third element of the macroprudential framework, which is governance. And to create focus and accountability for financial stability policies and outcomes, many countries created financial stability committees after the GFC, and in some cases gave them powers to meet these new mandates. In work with Rochelle Edge that I've done over the past few years, we documented a fourfold increase in committees worldwide. There were only 11 such committees in 2008, and there are currently about 47 among the 55 or so countries that have adopted Basel III. The majority of the committees focus on mainly improving communications, coordinating actions among the different regulators. And about 1/4 have some authority to take actions or recommend actions. And we found this committee structure really does matter. Countries with the stronger committees were more likely to activate a countercyclical capital buffer during 2016 to 19, after accounting for credit growth and other factors. So who is in charge actually matters. An interesting feature of these new committees is the presence of the Ministry of Finance. And that's interesting to me, not just because I'm now at a Ministry of Finance, but it was interesting at the time that you connected formally central banks and treasuries and financial regulators in one group. By their natures, ministries of finance reflect the view of elected officials more than independent regulators or independent central banks. But it turns out the Ministry of Finance is a member in 40 of the 47 committees and is the chair in 25 of them. So they're important players. In the US, the FSOC is chaired by the Treasury. In the UK, the Financial Policy Committee is chaired by the Bank of England, but while HMT is an observer, they play a big role. They may be there not simply because in crises it may require fiscal resources to respond for crisis management, but has been suggested by some others, including Paul Tucker in his book, Unelected Power. Finance ministries help to strengthen the political legitimacy of macroprudential policies, which can have effects for homeowners, for access for mortgages or small businesses. So finance ministries may also play a coordinating role among the independent regulators and may have a more independent perspective on the gaps, since they themselves generally are not a regulator. So those are the governance things. So let me turn now to looking at how this framework has done over the last few years, and starting first with the COVID pandemic. And if you'll bear with me, I'm just going to spend like 2 minutes on sort of how we saw the pandemic. There have been many representations of it, but want to use that to sort of introduce some of the reforms that are still needed. So our first test was the COVID-19 panic in March 2020, the onset. You'll recall that prior to that, in most countries, and especially the US, inflation was below target. The unemployment rate was near half-century lows. Financial conditions were loose, but credit growth was generally quite moderate in many advanced economies, and banks were holding a lot of capital and liquidity above minimum requirements. So metrics such as a growth at risk metric didn't indicate there would be notable downside risks to growth, say, a year ahead. But the onset of the pandemic clearly was unexpected, and the resulting change was quite dramatic. The massive shock placed enormous pressure on financial markets. Asset prices fell sharply. There was a dash for cash across a wide range of financial markets, and including generating illiquidity in the Treasury market, which is known to be the most deep and liquid market in the world. And there were variation and margin calls for some levered investors, and open-end funds faced record outflows and had to sell corporate bonds as well as treasuries to meet these large redemptions. And then, of course, there were runs on prime money market funds, which were comparable in speed and intensity to what happened during the global financial crisis in 2008. And while these financial markets were quite stressed, banks and clearinghouses, or the CCPs, showed considerable resilience. And the Fed had to take a number of extraordinary actions to restore market functioning. And the government spent in the US more than $3 trillion, which softened the blow of the pandemic to the financial sector and the economy. Our second test is still ongoing. Over the past few months, the financial sector, though, has generally proven resilient, just as in the situation of post-pandemic. Margin calls by CCPs for energy and other commodities contracts have been large, especially in Europe, with CCP margin requirements on a global scale exceeding those that were in March 2020. Commodity trading firms face significant pressures and often were asking governments for liquidity support. And more recently, some open-end funds are facing notable outflows with interest rate rises and losses on their positions. Overall, though, the shock of Russia's invasion and tighter monetary policy to date has not amplified materially by the financial vulnerabilities of the sector. So what have we learned from these two tests? First, bank resilience dampened the amplification of the COVID-19 shock to the core of the financial system. Banks faced a real-life stress test, but they had more capital and liquidity than after the global financial crisis and had stronger risk management capabilities, including the ability to, in nearly real time, assess their direct exposures to Russia or to commodities firms, for example. Of course, bank resilience would have been much worse had the authorities not intervened so aggressively. Second, countries actively use this new tool, the countercyclical capital buffer, the CCYB. So we have found in research that pre-pandemic, 16 countries had raised the CCYB above zero in 2020, and 15 of those, all but one, quickly relaxed it in the months following the pandemic, the onset of the pandemic. And the intent was to support lending, and most countries also asked banks not to reduce and free up to distribute dividends and repurchases to the shareholders. The countries that didn't activate the CCYB took some multiple actions, kind of idiosyncratic ones. For example, they released other buffers, but this might have triggered automatic reductions in dividends and compensation, or they offered ad hoc adjustments, like it's temporary relief for loan forbearance. But in some, 41 countries took about 60-something actions to really offer relief. And since then, 8 of the 15 countries have recovered, have started raising it again, and new ones have added. So I think what this evidence is suggesting is that countries believe countercyclical capital actions can help. It can offset the inherent procyclicality in regulations and in behavior. And so that this tool has turned out to be quite useful in my view. Based on this evidence, I think some changes could be considered to improve their use further. and the apparent reluctance of banks to use buffers. So there could be better communication to banks about the goals and the simplicity of using it. In addition, we have found that authorities might be slow to activate it because it is very hard to know when risks to financial stability are elevated until it's really obvious. And so the UK and some other countries have changed the practice to set a positive CCYB. I think David was there when this got implemented. A positive CCYB as the default level in normal times. And this could maybe be offset perhaps by other regulatory adjustments, but it would help to ensure that there's a usable buffer when risks are realized. Third lesson, margin calls proved very effective at protecting CCPs and other financial institutions against counterparty default risk. But while the margin requirements, not surprisingly, rise when volatility increases, they appear to be pretty unpredictable because of lack of transparency of margin models or in how they're implemented intraday when volatility is very high. So some changes could be made to make margin calls by CCPs less pro-cyclical, less unpredictable, so you can avoid fire sales in stress periods. Any changes, of course, need to consider the incentives for market participants to pull out of CCPs and engage in bilateral, or just to reduce hedging. And finally, I would mention the scale of fragilities in the non-bank financial sector was surprisingly large and led to dysfunction in multiple markets. And there are efforts underway to address these. Importantly, one is to improve the resiliency of a core bond market, the Treasury market. And in the US, we've taken quite a few actions, including expanding the definition of dealers who would participate in the market, improving the trading platforms, increasing the Treasury market transactions, which can be reported, and then also mandated central clearing. Another proposal would be to make the leverage ratio for banks countercyclical, which could help support market making when stress erupts. And a countercyclical leverage ratio would boost resilience by serving as a backstop to risk-weighted capital requirements when systemic risks are building, but would ease constraints on firms that are central in the financial system when it is relaxed. In addition, reforms should be considered to reduce the liquidity mismatch in open-end funds. As I mentioned, the spillovers from this mismatch to corporate bond and Treasury markets were significant, as these funds had become quite large. And notably, it was the investment-grade bond market that faced relatively greater liquidity pressures than the high-yield segment, as investors sold their investment-grade bond funds for liquidity. A very natural reform would be to introduce new funds, that more closely align the liquidity of the fund, the daily redemption, to the underlying liquidity of the assets of the pool. But swing pricing, which has been proposed, actually could also be helpful. For money market funds, some prime funds are subject to liquidity and credit mismatches. And the 2014 reforms in the US that created a link between the net asset value and the possibility of closing gates actually exacerbated the first mover advantage, as some had predicted in 2014. But it is critical to introduce some reforms so that the Federal Reserve and the Treasury, again, do not have to support money market funds in the next crisis. Let me say just last word on leverage. Regulators also need much better visibility into the strategies and leverage of hedge funds. In the US, there are some changes underway to get better data on leverage and more timely information after a material stress event occurs. In addition, a pilot program has started just like 2 weeks ago. I'm very excited about this, to start data collection on bilateral repo transactions. that are not centrally cleared, which will give us some insight into leverage of private funds. So let me turn now to digital assets. And digital assets you may probably know better as cryptocurrencies, and include a whole range of types of products and tokens. It's grown dramatically since the pandemic, and volatility, of course, has been quite substantial. The total market cap increased from under 200 billion in January 2020 to more than 3 trillion in November of 2021, and it's now less than 1 trillion. So there's been a lot of increase and a lot of decrease. Of course, it is Bitcoin and Ether, it is stable coins, and then there are a few hundred billion in other kinds of assets and tokens with volatile assets. These innovations may offer benefits to consumers and businesses, but there are some risks as well. Presently, many of these digital assets, specifically the ones I was speaking to, the securities, are just high-risk, high-return assets with the potential which raise risks to investors and consumer protection, as well as illicit finance. And a first-order task for regulators is to bring about compliance with existing rules to guard against these risks. Regulators also need to ensure that banks that are engaged in related services, such as custody, can ensure their own safety and soundness. More challenging is how to address the risk posed by the novel aspects of DeFi, though I would note that most DeFi currently involves some degree of centralization. So in terms of financial stability risks of digital assets, the vulnerabilities are quite similar to those in the traditional financial markets. The recent turmoil has highlighted these vulnerabilities. Asset prices have fallen as investor risk appetite has pulled back sharply, and certain large stablecoins have collapsed or temporarily lost their peg as a result of redemption pressures, because this is that liquidity or credit mismatch. And a large digital asset lending platform was forced to suspend withdrawals because it is highly leveraged. So these are standard vulnerabilities. In short, to paraphrase a former colleague, the digital asset ecosystem is proving to have many of the same fragilities of the 19th century banking system, but with 21st century speed. So far, these losses haven't spilled over to the banks. But as digital assets expand, the potential for spillovers will grow. And stable coins in particular pose significant spillover risks. So let me point to 3 of them. First, they aspire to have the functions of money. They want to be a store of value, a unit of account, a medium of exchange. But if they're backed by commercial paper or other assets that are linked to short-term wholesale funding markets, runs on those stable coins could result in fire sales, much like similar to the prime money market funds. If stable coins were to become widely used for payments, there would be disruptions in the mechanisms that support the storage or transfer of stable coin could definitely disrupt economic activity. And then there's also the prospect that one or more stable coins could become very large or too big to fail, become within a walled garden, and that could happen rapidly due to network effects or access to existing user bases. So those are 3 risks. So what would macro-prudential policy do? The stablecoins raises a basic question about the appropriate regulatory structure for stablecoins, whether it should be a bank model or a non-bank model. So either model plausibly could address concerns about runs and payment system risk, but might otherwise have different implications for financial stability and economic growth. Under a bank model, stablecoins could be backed by assets, bank assets such as loans, but also bank capital and liquidity and prudential oversight. In the US, banks are eligible to get accounts with the Fed, borrow from the Fed, access the Fed payment systems, can get eventual settlement in central bank money. But because banks are at the center of the financial system, it'd be especially important to ensure that safeguards are in place to protect them. Under a non-bank model, stablecoins would need to be backed one-to-one with safe assets in order to reduce run risk. And this model would definitely reduce the direct ties between stablecoins and the banking system, but could interfere with intermediation in the economy, credit intermediation, if non-bank stablecoins compete with banks for deposits, and in the process reduce the amount of stable funding available for credit. So in times of stress, a safe stablecoin, could increase the risk of depositor flight from banks that might face growing risk because they provide credit, and that would further constrain credit availability. In addition to one-to-one backing, non-bank stablecoin issuers would need to be subject to capital, liquidity, and other prudential standards to be commensurate. So where do we go from here? So there's clearly work to do on macroprudential policy for digital assets. But I just want to raise that digital assets raises a whole host of questions beyond financial stability, and they fall outside the remit of financial regulators, and need financial regulators to collaborate with other agencies. For example, in principle, digital assets raise questions about preserving a national currency, a uniform national currency, and monetary sovereignty, which are really issues more for central banks than financial regulators or finance ministries. The advantages of a uniform currency could be undermined if stable coins traded at a discount, could not be redeemed one-for-one for other money, or were even in some countries denominated in currencies other than the national unit of account. Digital assets could affect the role of currency in the international financial system, with potential implications for objectives related to national security, guarding against illicit finance, which was used in sanctions against Russia, for example, as well as a country's borrowing costs. And there may also be national interests in promoting technological development in digital assets to establish or maintain a strong position in global economic competitiveness and leadership. They also raise the prospect of social equity and inclusion and privacy of its citizens when all transactions are on a blockchain. So finance ministries need to work closely with central banks and other regulators to address and promote these goals. I would mention in the US, President Biden's recent executive order on digital assets has asked the US government to address many of these issues I've just outlined. And Treasury is leading reports, a number of reports, 5 of them, including the future of money and payments, and one on financial stability, another on illicit finance, and another on international coordination. And we'll be coordinating across the government on these reports. So let me just summarize. I know I've gone on a long time. The macro-pru approach, risk measurement, policy tools, appropriate governance, has gone through some significant tests since the global financial crisis. It's gone through the pandemic, the start of a war, and a change in monetary policy in response to inflation that hasn't been seen in more than 40 years. So the core of the financial system has proven resilient to these events to date, but they've revealed other important lessons as well. There's a much need to do more on non-bank intermediation as it continues to grow, and these liquidity mismatches and leverage can lead to significant stress in core funding and bond markets. The apparent utility of the CCYB has provided lessons for the use of buffers in stress periods and may be useful for thinking about procyclicality and high uncertainty of margin practices by central clearinghouses. I would mention the policy framework also has held up well. While the shocks were unexpected, pandemics and wars are generally unexpected, the vulnerabilities and the transmission channels were fairly well understood by policymakers. Summary metrics of financial stability risk continue to be developed that can express those risks in units that other macro policymakers can understand and consider in their own policy deliberations. And this will help financial stability authorities better communicate their framework, including the trade-offs of loose financial conditions today, raising the costs of financial stresses tomorrow. And then the policy framework also applies well to digital assets. Financial regulators correctly highlighted the vulnerabilities of digital assets before the recent sharp downturn. But we expect vulnerabilities to evolve quite rapidly. And the appropriate policy for digital assets is not a task for financial regulators alone. Instead, it will require inputs from central banks because of implications for currency and monetary sovereignty, and from finance ministries and other government authorities because of implications for a country's global position, national security, and other social objectives. So thank you very much for your time. Appreciate the opportunity to speak here today. Thank you.
Thank you very much, Nellie. So we have a few minutes for some questions, and I think I'll kick off with at least one myself while you're thinking of questions you'd like to ask yourselves. Perhaps we could begin with bank capital. I'll just pick out some of the themes you raised. You spoke quite positively about the countercyclical buffer in your remarks. The US obviously didn't apply this tool before COVID struck. Is this a tool, should we infer that this is a tool you'd like to see more actively used in the United States in particular, and does there need to be any changes to the framework governing the use of that tool to enable that to happen?
So let me say, so I am very positive on the countercyclical capital buffer. I think most financial economists who've spent time at the central bank like this. And it has some elements of like preemptive to like take away the punch bowl, as a former Fed chair said. So this is, many countries have done it. I didn't get into the details of the US. So countries have done capital buffers. Almost all countries have also implemented stress tests in some way. And they're done quite differently across countries. If you just, you just pick a few, even the US and UK do them quite differently. And I think both of those systems have very robust stress testing. But in the US, the stress tests have a very strong countercyclical element. And not to get too far into the weeds, but it requires that for banks, part of the stress test used to require that you pre-fund your dividends and your shareholder share buybacks ahead of time. So in some sense, when times are expansionary, times are good, bank management likes to increase dividends and share buybacks. The US stress tests require that you pre-fund 2 years of those. And it turns out that could be 1 to 2 percentage points of risk-weighted assets. It's huge. And so when times are building, you're actually requiring them to increase their capital already. So that adds the countercyclical piece. So that was up till about 2019. And this year, the Fed has changed their stress tests to be a little more, to not require all that pre-funding. So they will have a more regular capital buffer. And so I could imagine they might be more inclined to consider this now. But up till now, they haven't needed to because it's part of the stress test process. Again, it gets a little bit difficult. But I think I want to take away that countries Rochelle Edge and I did some research on the use of this buffer and looked at who was using it based on credit growth, inflation, GDP growth, and found that those all can help explain, but also the governance of it is important. And it was also interesting to see that once the pandemic hit, countries loosened monetary policy, countries put out, a lot of fiscal policy, and then there were we documented 60 plus capital actions to provide capital relief. So I think countries are starting to use this. So I'm very optimistic, and I actually would love to see that the CCPs and their margin practices take some lessons from this, and that would be one of my key recommendations.
Very good. Are there any questions in the audience? Yes. Let's start with Colette.
Thank you, David. And Dr. Lang, thank you very much for that very interesting introduction. My name is Colette Bowe. I'm an external member of the Bank of England's Financial Policy Committee, and everything you've touched on in your talk is, as you know, central to what we are concerned with as well. I was very struck by what you said about the number of jurisdictions that now have some form of financial stability committee. It's a very striking phenomenon, that, isn't it, following the great financial crisis. And my question is, do you think that central banks and possibly treasury departments could do more to communicate to people at large the important work that is being done, which is all about resilience? Because in my experience here in the UK, although everybody in this room and people who are living in this world understand what it is we do and what we talk about, an awful lot of people at large simply don't know that all this work goes on. Given its importance and its centrality, do you think we could be doing more to get these messages out? And if so, how the heck could we do it? Thank you.
Thank you for that question. It's a great question. I actually think the FPC is very successful at this, as successful as across all the other committees. I agree with you. Financial stability reports have become, everyone does them now, but that also grew. I think the challenge is financial regulations are hard. They're complicated, they're complex, you talk about CCPs and FMUs and all these things that, lots of acronyms. But it is important, and that's why I think this framework of quantifying financial stability risks in terms of risks to GDP growth. As I said, Tobias and Nina and others have worked on this, is like a really important first step. It's like translating risks of the financial sector to things that people hear about and understand. So it's risk to GDP growth. I think Mike Kiley may have done risk to unemployment, and just sort of trying to take what are risks of all these things I talked about, non-banks and open-end funds and money market funds and CCPs, and kind of collapse them down to, what does this tell me about? Should I worry about growth and employment? And so I think, to me, that is like a key element. And so that's why I'm pretty excited about some of that kind of research. And trying to speak in like regular language, as opposed to, we get caught up in our acronyms, but I agree with you, it's an important thing. I've been trying to work on that for years, so part of this research agenda of the growth of it and the growing importance of it, I think, is a part of that.
George, I saw your hand next.
Interesting lecture. George Kapetanios, I'm an academic here. I was interested in a point you made about growth at risk and the idea that there is a causal relationship. Could you say a bit more about how you explore the causality behind it as opposed to just the correlation?
So that was a paper I worked on with Tobias and two colleagues at the IMF, Federico Grimberg and Shahryar Malik. We used the growth at risk framework across 11 advanced economies. And we added financial conditions and interacted them with the credit growth of the non-financial sector, so that if you have very loose conditions and high credit growth, you're likely the sort of subsequent bust was going to be more costly. The way we did causality is some GIV estimator, where we were able to use bank EDFs, bank estimated default frequencies, across these 11 countries. I think maybe we ended up with only 9 countries were, in that causal test, but we used a GIV estimator, and that was kind of nice, because then we could, well, as you suggested, we can show causality as opposed to just correlations.
I think we're going to try and stick to time in this conference, and we're at 10 o'clock now, so why don't we stop there? We're going to have a coffee break, but a big thank you once again, Nelly, and great start to the event. 3 minutes for a coffee now. It'll be served in the arcade, and we'll see you back at 10:30.
Okay, excellent. This is the first paper session. My name is Rhys Bitter. I'm the Deputy Director of the Qatar Centre for Global Banking and Finance. The format is going to be fairly standard. It's going to be 20 minutes presentation, followed by 10 minutes discussion, and then 10 minutes of Q&A, rather than one big Q&A at the end. So this session is on banking regulation. We're delighted to start off with Alex Haas, University of Oxford. So take it away, Alex.
Very good. Thank you so much for coming to this first presentation. I'm Alex. This is joint work with Andrea in Oxford. And I should say that despite this session being called banking and regulation, there won't be any banks in this model. But we'll hopefully still have something interesting to say about the aspects of liquidity and safety. So let me start off with two things on which as we perceive it, there seems to be a broad consensus in the macrofinance literature at the moment or these days. First, early stages of the 2007-8 financial crisis were largely driven by a dry up of liquidity. And second, more generally, liquidity and credit conditions are relevant over the business cycle. Now, liquidity, as I defined it or as I described it in these first two statements, is a very broad notion, right? And then there are at least two sub-concepts one could think about when one talks about liquidity, or this broad notion of liquidity or dry-ups of liquidity. First, one could talk about an asset being illiquid due to limits to its resellability, or what we'll call pure liquidity if you want. So problems of reselling an asset in thin financial markets. Or second, one could talk about an asset being illiquid due to concerns about safety, about quality, possibly linked to asymmetric information. Now in practice, it's hard to separate these two concepts, which is why in most of the statements we're talking about broad liquidity or dry-ups of liquidity in a very broad sense. But in practice, it does matter when we talk about policy interventions, when we talk about credit easing or quantitative easing. Now, our starting point in this paper, in this attempt to disentangle the two sub-concepts, is this empirical decomposition of liquidity and safety premia in Krishnamurthy and Wissing-Jorgensen 2012. And what they do in their paper, in a very empirical sense, is that they start off defining this convenience yield as the difference in the yield on a AA corporate bond index in the US and a 10-year treasury yield. Plotted that series here from 1962 to 2022, and we see there's quite a bit of volatility, in particular in times of crises when these yields, when this convenience yield goes up. Now, what they then go on to do, and that's related to what I described before, is they try and disentangle these two subcomponents of liquidity, or this broad measure of liquidity, into a liquidity premium and a safety premium. Now, we won't have time to look at the exact differences or how they exactly do it, and there are other ways of kind of looking at these two concepts, different measures. But it seems fair to say that while these two sub-series, liquidity and safety, correlate over large parts of the sample, there are divergences, right? And and we'll use these divergences to identify underlying structural shocks to asset liquidity and safety. So the problem with these series, with these empirical decompositions, is that these two series are endogenous, right? I mean, there are at least a couple of structural factors that could drive liquidity and safety premia in markets. There could be structural shocks, that's what we're after, but this will also depend on the supply of perfectly liquid, perfectly safe assets, for instance, the US government debt to GDP ratio. So there are many factors that will kind of influence these empirical decompositions, which is why we propose in this paper to use a structural model to kind of back out structural shocks. So what we do is we build this heterogeneous agent, medium-scale New Keynesian model that will endogenously kind of create something along the lines of these liquidity and safety premia, and will then back out structural shocks to liquidity and safety, orthogonal shocks if you want. How do we get these endogenous premia? Well, on the liquidity side, we'll have a resellability constraint on private assets, something along the lines of Kiyotaki and Moore, which you might have seen in the other papers. And on a second financial friction will give us this quality or safety premia, and that's shocks to asset quality linked to asymmetric information. Again, along the lines of what I described before as a motivation for this project. We'll then take the model to the data, we'll estimate the model using standard macroeconomic financial time series, and we'll then study the role of these structural shocks to liquidity, and we'll hopefully be able to zoom in on problems in liquidity and say something about whether it's really about quality or about pure financial shocks, or pure liquidity shocks. And then in the last step, and we won't have time for this now, as I mostly present some estimation results, some very preliminary results, is will you compute some crisis simulations, some counterfactuals, and we'll hopefully have something to say about these policy interventions and the role of these policy interventions. Regarding the literature, on the empirical side, we kind of connect to this convenience yield, safe asset literature, which you might have heard about. On the theory side, we bring together these liquidity and safety quality frictions in a unified framework in order to disentangle or really zoom in on broad liquidity. And then in a more conceptual sense, what we're really doing here is we're wondering about the role of financial shocks over the course of the business cycle. So we'll kind of have a paper in the end in the spirit of what Cristiano Motorostagno, for instance, have done for risk shocks. Final point, in the final paper we'll also have something to say about the liquidity puzzle, but for time reasons I'll skip that today. Okay, so that's the timeline. Talked you through the introduction. I'll say a bit about the model, then we'll look at some estimation results and some next steps. And as I said, I'll skip the liquidity puzzle bit. Good, so the model in a nutshell. I'll be very brief here for most of these institutions. The model has all the bells and whistles you should expect from a new Keynesian model. And we need them because we want to take the model to the data, right? We want to estimate the model. So we need all these different kinds of frictions and entities in order to kind of reasonably well match investment, consumption, and other things in the data. So the households, not very interesting in the model. They consume, they supply labor, their own firms and retailers. There will be labor unions and investment goods firms. Again, nothing you haven't seen in the Smets and Wouters or other kind of standard new Keynesian models. The core bit, and I'll talk about that for a few slides, are these heterogeneous firms, and that's why we introduced the financial frictions. And there will be kind of two parts of the heterogeneous firm problem. There will be a production side and an investment side. We'll see that in a second. And then we'll close the model with final goods firms, monetary fiscal policy. Again, at this point, fairly straightforward and nothing too exciting happening on that side. So let's look at these heterogeneous firms. As I said, there are two parts, two layers if you want. First, production. So firms come into a period with a certain stock of capital. There's some heterogeneity, so some firms will bring more capital than others. But turns out, because this production problem at this early stage is fairly standard, as you see here, they basically select an amount of labor they want to employ, and they select a certain capital utilization U, and then they use their capital and just produce. And that will give them a certain return to capital. And it turns out, because of this very simplified framework here with Kaplan-Meier production functions, constant returns to scale, no idiosyncratic disturbances, you can easily aggregate everything. So the point of this slide is basically, despite the heterogeneity in the firm problem, the first layer, this production side, is perfectly straightforward and standard. So we get this usual factor prices, and this is all standard. Now, more interestingly, after production, so firms produce, they kind of get a return to capital. They set themselves up for next period. So they invest into new capital formation or buy capital in secondary markets to go into the next period and then be ready to produce again. And that second stage, that's the important bit. So here the problem is basically that firms, subject to a couple of state variables, want to maximize their present discounted value of dividends, or profits if you want. Dividends, as you see down here, dividends are given by the return to capital minus new investment into capital, plus the return to bonds. These are the two assets, bonds and capital, minus new investment in bonds, plus asset market activity. And we'll get to that asset market activity in a second. Before we do that, and this asset market activity is really then captured by these additional constraints of the problem, which are grayed out at the moment. Let me first talk you through kind of the state variables which you have seen. So the first one is, there are these idiosyncratic investment efficiencies. So we need some heterogeneity here, right? Some trading motive to talk about liquidity, safety, and asset markets. How we get that is we have these idiosyncratic investment efficiencies. So every firm will draw a certain investment efficiency in a period. And depending on that investment efficiency, it will want to sell capital to invest, or it will, if it draws a very bad investment efficiency, just buy capital and not invest in that period. Okay, so these are the epsilons. Now there are two assets, as I said. If we want to talk about spreads and convenience yields, we need at least two assets. The first asset is capital. We've already talked about that. It's a production factor, but it's also a financial asset. And it's subject to these two financial frictions, which I've described before. So first, there's limited resellability in the spirit of Kiyotaki and Moore. So there will be, every period, the firm will only be able to resell a certain fraction of capital, and that fraction is omega bar. And the second fraction is there's limited quality of capital. So every period, a certain fraction of that capital will just disappear at the end of the period. Now, because of asymmetric information and because this only happens at the end of the period, this will give firms an incentive or a possibility to sell their capital, the bad quality capital that is not worth anything at the end of the period, before it happens. And that will mean that the average capital quality in these markets will be worse than the fundamental quality, because there's all this bad quality capital going around in markets which firms try to get rid of before it happens. Okay? And that will give rise to this quality premium, while the first financial friction will give rise to a liquidity premium in the model. Okay, second asset, government bonds. They are in fixed supply and they're assumed to be perfectly liquid, perfectly safe. Okay, and the spread between the return on capital and the return on government bonds will be on convenience yield. Good. So briefly, last couple of equations. These are the other grayed out kind of constraints to the problem. First, the law of motion of capital. So capital this period will be given by the non-depreciated bit of capital last period, also taking into account these shocks to capital quality, right? Plus whatever a firm invested into new capital formation, subject to this efficiency. So as I said, some firms will be better investing than others, minus the whatever firms decide to sell of their good quality capital, so the asset market activity, in order to invest even more. Plus, if they had a very bad draw, they might just want to acquire, KA, new capital, but that will be subject to this asset quality in the markets, as I described. The problem is, in the markets, you have lots of bad quality capital going around. So whatever I buy, if I buy 10 units as a firm in a capital market, it might be that only 8 of these units are actually usable for me next period. Okay, and that is captured by these psi star. Okay, all linked to the quality friction and asymmetric information. Now, what about the resellability friction? The second one that is given by these two weak inequalities that basically tell us that independent of what I would like to do as a firm, like optimally to do, is I can only sell a certain fraction, up to a fraction of my assets every period, and that's this omega bar of good and bad quality capital. Okay, so that's the model in a nutshell. Let me give you kind of one implication of that, and then we'll move to some results. So as I said, firms at the beginning of the period have this realization of investment efficiency. Some will be good, some will be bad in investing. And now the nice thing about this model is, if you want to kind of start solving it, the heterogeneity kind of boils down to a very simple kind of result, in that you get 3 groups, 3 policy rules basically, and firms sort themselves depending on what realization they had, which is why we can easily solve that model despite the heterogeneity. Okay, so there will be the first group of firms. They have a very bad draw of epsilon, so they're super inefficient in investing that period. In a sense, they got unlucky. So these firms will, turns out, optimally, if you solve the problem, will just accumulate liquidity for next period. So they will buy capital in asset markets, they will buy bonds, and then get ready for next period. So in a sense, there's no point for them in investing. They will just buy used capital and used bonds. Okay? Second group, they have a somewhat reasonable draw in terms of investment efficiency, so they will do some investment. But the investment, the efficiency they draw is not good enough for them to sell everything they have in order to invest into new capital, right? And that is linked to this quality frictions, right? So they might be willing to sell their bad quality capital, but they're not willing to sell the good quality capital they have, because they don't get an adequate price for that in markets. Because in markets, the value of capital, the price of capital is lower than the shadow value because of this quality problem that people buying in markets always know, well, what I buy there might just be bad quality capital. Okay, and then we have this third group of agents for firms, and they will invest and sell everything they got because their efficiency is so high that they're willing to even part with their good quality capital, even at a lower price. Okay, these thresholds are endogenous, and we could talk about more about how they are related to shadow values and prices in markets, and they will vary over the business cycle. But for now, I'll just leave it at that. Because of these ID shocks and a couple of other things which we have in the model, you get this nice aggregation result, which I've highlighted here. Now we'll skip the other kind of bells and whistles here, because it turns out you can actually nicely compress that model, and it nests a couple of other specifications which you might have seen before. And instead, we'll just move to the estimation for now. So these are quite new results. We only kind of got some somewhat decent results over the past couple of weeks. So this is pretty much a preview now. So what we do is we take the model to the data, as I said. It's a fairly large model. We'll use Bayesian methods to do that. We'll use we do use quarterly observations on 9 US macro and financial variables. For now, we restrict the sample to 86 to 2008, so up to the financial crisis. The macro variables are perfectly standard, and we kind of complement them with these 2 additional financial variables. And these 2 financial variables are liquidity and safety premia. These are basically the 2 empirical series I showed you in the introduction. So we're now using them as observables in the estimation, kind of accounting for the fact that they are endogenous. We'll see how the model generates them endogenously, and then we'll back out the structural shocks. And then we'll be able to see kind of how important structural shocks are. Okay? We'll do the usual data transformations you need to do in that. So we have these trends in the model, so we detrend, we demean. We do the same stuff in the data and in the model to kind of make sure that it's consistent. And ultimately, we'll have 9 exogenous shock processes, okay, in line with the 9 observables which we have. Good. Okay, so some very preliminary results, and I'm almost sure they'll change again. So, but I think they gives you some indication of where we're going here. So here, this is a unconditional kind of decomposition of the variances in the model for a couple of endogenous variables here, output, investment, consumption, etc., into these 9 structural shocks. Now we won't have to kind of, there's no need to care too much about all the shocks here. We just focus on the 2 financial shocks for now. So this would be our structural quality shock, and this would be our structural liquidity shock. Okay, so these are the 2 financial shocks if you want. If we look at output and investment, the first 2 rows, and just the bold numbers, we see that financial shocks here kind of explain around 20% of output fluctuations and around a bit more than 30% of investment fluctuations. So they're quite significant, okay? Now, crucially, I should say, the bulk of that contribution of financial shocks, as you can see here, is really on the quality side. So financial shocks do matter, but it's really shocks to asset quality, so safety and asymmetric information. It's less thin financial markets and liquidity that matters. And I'll illustrate that in a second. Now, if we look at spreads, if we look at the convenience yield down here, we see that financial shocks are even more important. Fair enough. Financial shocks drive spreads. That's fine. But we also see that it's now the pure liquidity side that is really driving that. And it does so in combination with something else. And that illustrates the endogeneity of these series, right? This something else here, this additional shock, is the supply of safe assets. So it's not just shocks to the 2 financial frictions, it's also the supply of safe assets or government debt in this model that really matters for these spreads. Again, not a massive surprise, I assume. Now we could also zoom in on the 2 subcomponents of convenience yield, and again, get a very similar picture, but I'll leave it at that and use my last 3 minutes to just show you historical compositions to kind of illustrate what I just said. So this was the theoretical part. Now we'll look at some variables over the business cycle. So this would be observed output growth, GDP growth, that's the black line, over the sample from 86 to 2008. What we see is that, and decomposed into these different shock categories. And now I have grouped them basically into 5 groups to make it easier to interpret what's going on. So first observation, markup shocks, productivity shocks, the demand side is mattering over the business cycle, right? These are the blue and the orange ones, and they are quite important here. In addition, financial shocks, the yellow bars, are also important, in particular in times of crisis, okay? Again, all not too surprising. Now the novel bit is that we can zoom in on the yellow bit, right? We have these 2 subcomponents of financial shocks, and that's new. So if we do that and get rid of all the other stuff, we get what I indicated before in that variance decomposition. It's really shocks to asset quality and safety that is relevant over the business cycle. Okay? You Can do the same for investment. Investment, more volatile than output. Other than that, very much the same story, other than financial shocks are even more important. Again, given the structure of the model and that the investment process is really linked with the financial frictions, probably not too surprising. Again, if we zoom in on the yellow bits, we see same story. It's really quality shocks that matters here over the course of the business cycle for output and investment. Now, the reverse, if we look at the spreads, it kind of turns around. We see that fiscal policy, the supply of safe assets, and financial shocks are important. But if we zoom in on these financial shocks, it's now really the liquidity shocks. It's the liquidity side, the pure liquidity side that matters for these spreads. Okay? I'll leave it at that, skip the other stuff. As I said, I'll also skip the liquidity puzzle. And I'll just conclude here by saying we'll try to give you a motivation of this project. It's still very early stage, and in terms of result, fairly limited so far. But we'll try to give you a sense of what the model can do and why it might be interesting to employ a model like that. Showing you some very first estimation results. And in terms of next step, what we're currently doing is we're kind of zooming in on the fiscal side, right? As you've seen, the fiscal side, the supply of government debt, the supply of safe assets really matters for the spreads and for for the spreads. And we were trying to be a bit more rigorous in the modeling of that. There are also some other observables one could consider in the estimation to kind of get a bit more discipline in that process. And that's really the interesting bit. I mean, this contribution of different shocks might be interesting, but there's other stuff one could do with an estimated model like that. And that stuff would be looking at the financial crisis again in detail, seeing what kind of shocks drive the financial crisis, talking about the role of credit easing, quantitative easing, and then also looking at the more recent episode of the March 2020 liquidity crunch and COVID. And I think there's quite a bit of value in doing that in this kind of model. That's all. Thank you.
And we now have Matthias Rottner from Bundesbank to give a discussion.
Yeah, so first of all, thank you very much to the organizers for the chance to discuss this paper. I really enjoyed reading it. I think it's a great paper. Also, I mean, Alex said it's a bit early stages, but I think it's even nicer in such a context to discuss a paper, because then maybe the authors will take some of the input in or not. But yeah, it's a great chance to talk about this paper here. So let me also shortly summarize the paper from my point of view, so how I would interpret it. So, and it is about dissecting the role of liquidity and safety, and the goal is to understand what is the role of these two drivers for financial crisis as well as the business cycle. And the motivation comes from the fact that market liquidity is very important, and I think there has been a lot of studies out, and I think of course, it's very important, but they point out it's potentially a bit too broad of a notion. So we need to go more into detail to understand what is really going on. And to do this, their strategy is to use like a very elaborated, rich macroeconomic model, where they have a distinct role for liquidity and safety, so that they really can disentangle liquidity and safety for this, or fundamental liquidity and safety for this broad concept of market liquidity. And a bit more precise, so they take a tractable heterogeneous agent model framework with multiple financial frictions. And then they go the step further, because they're really interested in the quantitative results, so they actually estimated with Bayesian methods for the US. And so based on the estimation, they can then analyze what is the role of liquidity and quality shocks for the business cycle for financial crisis. And even though you stressed a bit that the results are a bit preliminary, I think there are already two very interesting takeaways already. So it seems that really quality shocks are the much more important driver for output investment. So they have a much larger role than these liquidity shocks. And the other one is that policies that are aimed at easing liquidity, maybe they are not so effective for the economy, because actually the quality shocks are the more important one. Okay. And so the main idea of this paper is really that you want to decompose the convenience yield of government bonds, or you can decompose this convenient yield of government bonds into two components. On the one hand side, you have the liquidity premium, which they connect to the resaleability of assets, or this, they call it also fundamental liquidity in the paper. And then you also have like a safety premium, which is like related to some asymmetric information and the quality of assets. And they use this macro model to really like decompose the convenience yield, but also to square the data with it. And the framework they use from Dong and Wen, they use this heterogeneous firm setup with two financial frictions that really allows them to have this focus on liquidity and quality. They put it into a medium-scale New Keynesian framework with all the bells and whistles that you kind of would expect. And then they go this step further because and estimate the model for US data. And because they estimate and have this rather large model, it really allows an in-depth analysis of the fundamental drivers of safety and liquidity, of the safety and liquidity premium, kind of like through the lens of such a structural model. And then they can really connect this to the business cycle. But let me also have a few comments on the paper. So let me move on with this. And I think the first one is because really the focus of this paper is there's a shortage of liquidity versus a shortage of safety. And then actually you can see that these both components are highly correlated from 85 to 2008. I think Alex has shown a very similar picture before. And so for me, like also thinking a bit from a policymaker's perspective, how important is actually this distinction between liquidity and safety? And I think that the authors could do a little bit more in their paper by looking the estimation. What would I find if I only have a scenario with liquidity or safety? Would I really lose like much? I'm sure you will find that it's very important to separate, but I think you need to a bit more emphasize in the paper that is important. And I think the other one is really like to think how this richer setup changes the effectiveness of policy. So I think there's some primer in the paper that you want to do this. But I think here really the question is that can policies that stabilize liquidity, which they're usually often implemented, can they actually like have some counterfactual or unintended impact of the role of quality? So can they have to a shortage of quality? I think if there would be some result like this, that I think it would be like super exciting and very, very important. And then let me come also to the second comment. It's like basically about the analysis and the scope of the estimation. So I think the finding is that financial shocks are an important driver of the business cycle. This is not a too new result. It's, for instance, also in line with Cristiano et al. And I think because you use these different two shocks, I think it's important that you a little bit more emphasize how should we think about this resaleability and quality shocks. So, I mean, maybe like showing more and discussing how do the shocks propagate with some IRFs. But I think another component that would really enrich this paper would be to link this shock to some empirical quantities, if there's some opportunity to do this. And then another comment is, so at the current stage at least, the estimation covers only the years 85 to 2008. But the point is, first of all, if you look at the correlation between these two spreads, the correlation is much larger in this sub-period compared to over the entire time, like between 62 and 2021. So I think maybe there's more going on that you don't fully capture. I did not understand reading the paper why you limit yourself to this short period. And I think not only that the dynamics seem a bit different, I think it also really limits what you can later do when you go to policy and doing counterfactuals. For instance, I mean, you cannot put the role of the zero lower bound in, and nominal rigidity is also talking about like fiscal policy. I think that would be quite interesting. And also, I think a very interesting spin for this paper could be really to look about the pandemic era measures of the Fed and Treasury through the lens of such a model. And let me come to my last point, and this is about like thinking, okay, now we have thought a lot about business cycle, but how should I think about financial crisis in such a model? And this is an estimated linearized model. And then I'm asking, so, or is it like sufficient to account for the dynamics of financial crisis? Because I think like dry up of liquidity, we think about financial crisis, and we think about nonlinear dynamics here. And the paper basically makes a horse race for this, how important are shocks as a cause of financial crisis. But I think potentially you could think about like making some more endogenous dynamics, so including occasionally binding constraints or multiplicity of equilibria to better capture this idea that financial crises are endogenous instead of like exogenous events, or to some extent endogenous. And let me also do some shameless self-advertising at the end. So I mean, and coming from this nonlinearity, so in my own work I have looked at this financial fragility, or like kind of also like what we've talked before about this growth at risk through the lens of such structural models. So you can actually build such nonlinear models with endogenous financial crisis, and then you take them to the data. And what is so interesting about this is that you, first of all, you really have like this structural measure, but then you can run this policy counterfactuals. And I think in your context, it would be very nice if you have this policy counterfactuals, and then you see how do they actually affect the endogenous financial fragility. I think that could be very interesting element. And then so I think another strength of your paper is really it's not that you have like a small model that you estimate, but that you have a larger model. And I mean, I think there's also, I mean, it's quite tough to be honest, to bring such models to the data. I mean, and I think, but I think the future is there potential some other ways to do it. So you can use some machine learning techniques. And I mean, kind of in joint work with Hanno Kase and Leonardo Melosi, we actually estimate like a nonlinear Hank model using machine learning techniques. And actually this developed approach also applies to large nonlinear models. You can use it for such models with endogenous financial crisis. Okay, so let me summarize this paper. I think it's really interesting. I really enjoyed reading it, and it sheds light on the flight to safety versus the flight to liquidity. And the authors really have a thorough quantitative perspective on this. I think future research should or could evaluate a little bit more the policy counterfactuals in more detail, and potentially you want to think a bit more about nonlinear dynamics. Maybe they could potentially extend the analysis of the paper. Yeah, thank you very much.
Right, and now we have time for a few questions. So yeah, please raise your hands. Andrea?
Hello? Can you hear?
Yep.
Okay, great. Andrea Yellow, Board of Governors. So very interesting work. I was wondering whether you can give me some intuition about how you identify separately these two shocks. I'm thinking that while it's true that the two series you use are very correlated, the low frequency component of the two series is very different. There is actually a trend in the convenience yield that you don't see in the triple B spreads, for example. So I wonder if focusing just on the variance decomposition of business cycle frequencies here is not doing you a favor in terms of finding out what is the effect of the convenience yield shock, which might be visible instead at lower frequencies. And I wonder if the impulse responses will reveal that in terms of what is the propagation of these shocks through the system be more persistent for the convenience yield versus the risk shock. Thanks.
I think we can answer as we go along if you're comfortable with that.
Okay. Thanks a lot for the question. Also, thanks to you for the discussion. Let me just start with 2 points regarding the discussion. I mean, tremendously useful points. Just would like to mention 2 things. First, I mean, regarding the robustness of this, so this is early stage. So in a sense, there are many things we haven't tried yet. I think one thing, and it goes in the direction of your first point, is would be to, instead of using the 2 premia as observables in the estimation, just using the convenience yield. Might be one way of kind of having a bit of a robustness exercise where you just have one broad measure, and then you look at the implied series for liquidity and safety, compare that, what you get empirically, and see whether that is something meaningful, right? And whether it's close to what we estimate here. So I think in a sense there's some ways, and this also goes a bit in the direction of what you raised before, that there are many things one should try and kind of keep in mind. Another point regarding the sample. So in a sense, you raised this point about the sample, and then later on said, well, there are some nonlinearities. In a sense, our attempt was to kind of preempt that by using a very restricted sample, kind of at the cost of not being able to talk about the financial crisis and the recent years, as a benchmark at least. But clearly, I mean, the paper would be much more interesting and hopefully will be much more interesting at the point at which we kind of include these nonlinearities. I mean, there are ways of with low cost, kind of including a zero low bound, following the approach of Jacovelo and others, and kind of estimating that model then. And that might give you some kind of, some options to estimate the model up to the COVID crisis. So there are a few things one could work on, and many of the things you mentioned are actually on the list. Good. And now regarding the point about the low frequencies, I think it's a very fair point. I mean, the honest answer is so far we haven't really dealt with it. We were kind of taking the data, we were looking at business cycle frequencies, we're kind of extracting the shocks, and we're showing you the shock decomposition. We do have some impulse responses, some very early ones. We're working on that, in particular with respect to the counterfactuals. And I think there's quite a bit to learn about the transmission in the model, and then hopefully get a reasonable kind of outcome. And if we don't, I think, yeah, that's definitely something to go back to and think about, right? Yeah, so it's a very fair point. I'm afraid I don't have a much better answer now, but thank you.
Nina? Sorry, we just need a microphone down the front, if that's possible.
Hi, Nina Bayarchenko from the New York Fed. So I guess my question in some ways related to Andrea's question, but how do you think about the fact that the quality composition of corporate debt in the US has changed dramatically since the start of your sample, both for the overall composition as well as for the investment grade? And then in terms of the shocks, I'm not sure what a safety shock that is not accompanied by a liquidity shock actually looks like in practice, because again, if you think about secondary market trading, of course, when the quality of debt decreases, liquidity of debt decreases as well.
Yep. Again, two very fair questions. Regarding the first one, I'm afraid don't have a very good answer at this point. I mean, the thing is, what we're doing here is we're taking this decomposition in Krishnamurthy and Wissing Jorgensen, and it seems like that with like a very macro Anglo Keynesian kind of audience, people are very happy with that decomposition, and they're kind of happy with taking this as a measure of liquidity and safety. But in a more finance-oriented audience, it's very different, and people ask about risk. People ask about the exact components. I think ultimately we'll need to investigate that a bit more, and don't have a very good answer at this point. We're taking this as a benchmark for now, but yeah, we'll have to do some more research in terms of the composition and how it changes over the sample. My impression was that it seems like a fairly straightforward approach to kind of use it, but maybe we can talk about it afterwards. I think there might be things we're missing at this point. Regarding the second question, could you repeat the second question? I'm sorry.
It was, how do you think about a quality shock that's not accompanied by a liquidity shock? Because in practice, all quality shocks are accompanied by liquidity shocks.
Yes, I mean, that's the beauty of the model in a sense, right? That it allows us to disentangle these two things. Now the question is, what are these structural shocks in the intuitive terms, right? I mean, the shock, that the model gives us these structural orthogonal shocks. I wonder if one could try and think about the two in a sense of adverse selection and moral hazard, in a sense, at least in a model context. So you could think of, say, a pure resellability shock, so a shock to pure liquidity if you want, and we're still working on a terminology here. I think it's not ideal to use broad liquidity and pure liquidity, but being that as it is, a pure liquidity shock or resellability shock is in a sense a tightening of your resellability, which means that you're kind of less able to issue equity against your assets, which one could perceive to be a problem of moral hazard, right? I mean, as an idea of you agents are not willing to buy your asset, agents are not willing to invest in your asset up to 100% because you're supposed to keep some agency in kind of the project going forward. On the other hand, the other kind of shock, the pure quality shock, if you want, in the model, it's fairly straightforward what it is. I think in kind of a narrative sense, we think of it in terms of adverse selection, in the sense that this is really about the fundamental quality of that asset. Now, a shock to that quality of the asset paired with asymmetric information will have implications for its liquidity. And that's exactly what we're doing in this paper, right? I mean, we're capturing that endogenously. But ultimately, I think the bit we're capturing there on the quality side is a bit more fundamental than that, and it's not directly linked with liquidity. It's more as a one-off shock to, say, the return structure, a one-off shock to the prospects of a project, or realization that that project might not just be not as good as you thought before.
Thank you, gentlemen. I think I'll call Salim and Rustam to the stage, please. Thank you. Thanks, guys.
Thanks.
This is Salim Bahaj, Bank of England and UCL.
Thanks, Reese. Thanks, everyone, for being here. It's great to give this talk. It's joint work with my colleague, Fred, who's also at UCL. And, okay, what we're interested here is how should capital regulation be coordinated across borders? That's sort of our headline research question. It's a theory paper, so we're looking into this. And we all know that, banks operate across different jurisdictions, and when one jurisdiction makes regulatory change, that will spill over across borders. And sort of the high-level question we have is, then what does that mean in terms of externalities and strategic incentives to different regulators? And there's sort of this classic idea which motivates a lot of sort of international coordination in practice, particularly the Basel regimes, which is there's a tendency for race to the bottom. Right? That's the idea. The idea is what they're actually in my head, which is that, to the extent that if you cut capital requirements, that gives banks in one jurisdiction a competitive advantage. They can go out and steal market share, both at home and abroad. And to the extent that regulators care about the market share and the profits of the banks they regulate, that gives them the incentive to undercut one another, right? You get a race to the bottom, okay? And that kind of motivated, as I said, the original Basel Accords, and what we sort of agreed was that we'll have common minima, right? That's Basel I. We won't undercut each other, we'll have a fixed capital requirement, and no one can deviate and go below it, right? And then the rulebook has sort of grown since then. We've gone Basel II, Basel III, and over time we've had more and more complicated regulatory regimes, and national discretion sort of crept back into the regulatory framework, right? And particularly for macro Peru. We heard about that this morning with Nelly's keynote, okay? And you think about actually sort of the CCYB, the Council of Capital Offer being the marginal instrument. These are slightly different tools, right? They are reciprocated, okay? And I'll explain exactly what I mean by reciprocation on the next slide. But the point that I want to get across in this paper is that when you have reciprocation, that really changes this game, okay, the coordination of capital requirements. And in fact, it sort of, it kills off this market share externality, this competition for market shares amongst banks. What instead you get now is competition for capital for regulators. They want to attract bank equity capital to their own country. Okay, so it changes the way we sort of see externalities in terms of the coordination of regulation. Okay, and that's sort of what I'm trying to get across with this paper. Okay, so just to start, I want to explain what I mean by reciprocity and how it sort of fits into the regulatory framework. So this is our classic home country regulatory rule that you would see in Delache and Marquez, for instance. It just says that, look, imagine a bank at home, and that's lending both at home and abroad. Then the home regulator will choose some capital requirement gamma, okay, which will be saying that if you lend X at home and X prime abroad, gamma of that must be funded by equity, okay? And if the home regulator can cut gamma, then the bank can expand both at home and abroad and steal market share. That's the basic idea behind this. And then, sort of your simplified way of thinking about Basel I and Basel II is that just fix gamma internationally, no more incentives to deviate. Okay. Basel III is sort of slightly different, since we have these CCYBs, which can be changed nationally. Okay, but they're reciprocated in the sense that this CCYB prime here, which is a capital requirement on foreign lending for a home bank, is now set effectively by the foreign regulator, in the sense that I'm a regulator in France. I say French lending must have a CCYB of X%. The UK regulator reciprocates that when it regulates UK banks. Okay, so you have this sort of effective foreign capital requirement on foreign lending. Okay, so that's the idea behind this, and that changes things, as I said. And what we do in this paper really have a sort of very, very simple, stylized model to explore what this means for the coordination of regulation. Okay, so it's a static model. All markets are competitive. All agents are risk neutral, and there are going to be two countries, home and foreign variables will be marked with a prime. Okay, and in each country there'll be a set of competitive firms that will combine capital and labor to produce output using a simple technology function with curvature parameter alpha. Labor is inelastic in both countries, and it's immobile. So that's what makes it a two-country model in a way. And in both countries, there's a storage technology which all agents have access to. There's a unit gross return. Okay, and that basically pins down interest rate of 1 in the model. And then we have banks. Okay, and banks sort of makes this model interesting. It's different from Alexander's presentation, which have banks in our model, so we're sort of talking about banks directly. So these banks are mobile. They operate across borders, and they lend to firms to fund fiscal capital in both countries. Okay, and there's sort of three unique features here, which makes banks interesting in a way. One is they have, or they face at least, an upward sloping supply curve for bank capital. Okay, and that supply curve is global. When banks want to raise more equity, they have to go out and raise in a global capital market, and that raises the cost for all other banks. Okay, and the slope of this supply curve will be 1 plus Z star, where Z star is an endogenous variable in equilibrium. And the reason they go out and raise capital is they face a capital requirement, which says that for every X lend at home and X prime lend in foreign, they must have a certain amount of equity. And you have two capital requirements, gamma and gamma prime. Gamma is set at home, gamma prime is set abroad. That's sort of this establishing this reciprocity regime within the model. The last feature that we're going to have is that the other source of funding is deposits. Okay, and these are going to be insured with no fee. And that ensures that there's two things happening. The first is that these requirements will bind in equilibrium. And second is that banks will perfectly specialize. Okay, and the reason for this is that if you insure deposits, you essentially endow the banks with a put option on their assets. And to maximize the value of that put option, banks want to minimize the diversification, and they'll specialize as either a home or foreign lender. Okay? And you can interpret that in two ways. You can think about there being sort of bank holding companies that have a local subsidiary in each country, okay, and that subsidiary lends at home and lends abroad with their own separate capital and own separate balance sheet, subject to their own capital requirements. Or you can think about individual standalone banks that specialize in lending in a particular country. It doesn't matter in our model. Okay, the latter probably is more realistic. The former is more realistic. The latter is easier to explain. So I'll stick with sort of this idea of standalone banks lending in each country. But the net result of that is that one of these requirements will be irrelevant when it comes to each specific bank. Okay. So the first thing we do is just some simple comparative statics, and that's going to basically solve for equilibrium given a pair of capital requirements, gamma, gamma prime. Okay? And so the key object here is going to be the return on equity in banks specializing either at home, so R, or in foreign, R prime. Okay? And the equilibrium is such that there's a unique pair, n star and n star prime, that sets the return on equity equal across these two countries and equal to the slope of the supply curve for capital. And these are key objects. These n star and n star prime is equity capital allocated to funding lending in either country, okay? And when I say sort of competition for capital, what I mean is that a regulator can change gamma, or gamma prime, the foreign regulator, and change the allocation of capital in the global capital market, and that will change lending that happens in their own economy. Okay, so how capital, these ends react to the requirements ends up being a key object. Okay? And the point is that, dn d gamma, so how the amount of equity allocated lending at home reacts to a change in the home capital requirement simply depends on whether, by raising that capital requirement, you can raise the return on equity at home. Then capital will flow into home. So a natural reaction. So you get this result here. The sign of dn d gamma depends on the sign of the return on equity in response to a change in the capital requirement. Okay? And that means actually there can be spillovers. So first thing is that assume that this derivative is positive. Then this inflow of capital can come from two different sources. Okay? It can either be new issuance, so the banks specializing in lending at home can go out to the capital market and raise new equity, or there can be inflows from abroad. Okay? And those inflows from abroad are a spillover. We can reallocate capital from foreign to home. Okay? And you can simply write dm prime d gamma. So how does the foreign allocation of capital change with respect to the home capital requirement? Simply this expression here, where spillover is some endogenous term, so SP for spillover, between 0 and 1 times the influx of capital to home. Okay? And which margin we see being used simply depends on the relative elasticity of these different sources of supplies, right? So, in terms of this new issuance, if that supply curve is perfectly inelastic, all the adjustment must come from foreign, and so SP is equal to 1. If it's perfectly inelastic, we can just adjust entirely through the capital market, and SP is equal to 0. So we can sort of think about these relative elasticities as governing how big the spillovers are. Okay? But the other point I sort of started from was that dr d gamma actually is positive, right? So an increase in the capital requirement at home raises the home return on equity. And that's kind of, in a way surprising. We don't think of tightening regulation typically raising returns, not least because we have deposit insurance here, so there's a subsidy in the return on equity. But actually, it can happen, and quite easily, in fact. And the intuition simply is that all else equal, by tightening capital requirements, we generate scarcity events in the economy, okay? Because we have a sort of a downward sloping aggregate demand curve for capital. So essentially, by tightening capital requirements, the regulator essentially dampens competition, and that raises returns. So if you imagine a situation where we start in a world where capital is abundant, and we have sort of perfect competition, in a way we're sort of at the marginal cost curve, which is 1 in this model. You tighten regulation, you restrain lending, we start moving up the demand curve for capital. Okay, we're exploiting the fact that the return to physical capital is downward sloping. And you see a situation where, as we move up this demand curve, we increase rents until the point where we reach a point that monopolists would choose. We've maximized the available rents from constraining quantities. And once you go past this point, any further constraint in the capital requirement, any further tightening of regulation will actually reduce rents, reduce return equity available for banks. Okay? And the implication of that is that for any given capital requirement, gamma prime, so for any given, foreign capital requirement, gamma prime, there's a return maximizing home capital requirement, which corresponds to the point where lending's where the monopolist would choose. Right? We've maximized our home return, okay? And if we're to the right of that return maximizing point, so sort of where this black line is on my picture, raising the capital requirement further would push us closer to the optimum and raise returns, and therefore attract capital to the home country. If we're to the left of that point, raising it any further would reduce returns and lead to a capital outflow. Okay, so that sort of signs the gamma. Which side are we from the return maximizing capital requirement? Okay, just one quick remark. This is a return maximizing, not pure profit maximizing requirement, because it ignores the cost of raising equity in the first place. Okay, banks don't want to sort of have us raise the capital requirement. It's more or less bad for them. All you're doing is raising scarcity events to compensate for the excess cost of equity. Fine. So we take this sort of simple comparative static idea, this sort of positive analysis, and embed it in a policy game. Okay, so our welfare functions are very straightforward. So X here is aggregate lending in home, big X. Okay, and our welfare function is going to be economic surplus, so that's sort of a surplus from lending, minus a loss function. And in our baseline calibration, the loss function is simply just lambda, some positive number, times the expected losses from bank defaults in the model. So don't worry about exactly where that expression comes from, okay? And we're going to think about symmetric Nash equilibrium. So that's the equilibrium where we maximize home returns subject to the foreign policymaker playing the same strategy, and a collaborative optimum when we choose a symmetric capital requirement to maximize both countries' welfare. Okay? And what we're ultimately interested in here simply is whether is gamma Nash greater or less than gamma col. So we play a strategy where we have tighter regulation if we don't cooperate versus if we do cooperate, and under which circumstances we see either case. Okay. And actually, we can look at the externalities very, very simply here. This is just writing down the first law condition for the collaborative policymaker. They say, look, let's maximize the joint welfare of both countries. So we take into account the marginal benefit of raising the capital requirement at home, plus any cost or benefit of that change in foreign. Okay. The red part is what the competitive policymaker would set to 0, so that's the sort of Nash solution. And the blue part is an externality. So if that's positive, we'd have gamma Nash less than gamma col. Okay? And actually, you can open up the externality and derive it simply as being dm prime d gamma. So that's the capital flow from foreign following a home capital requirement change, multiplied by essentially the social value of capital in foreign. And it turns out that actually this term here, this pi prime, n prime, is always positive. Okay? And that's simply saying that foreign would actually like to have more capital allocated to it for any given capital requirement. And the sufficient condition for that is simply that tighter regulation raises welfare, holding lending fixed. So there's no cost of tighter regulation in terms of reduced lending, then you benefit from it. And that will always be true. Okay? And what this means is that if this pi prime, n prime is positive, then the sign of the externality is pinned down by the sign of this capital flow, whether the n prime d gamma is positive or not. Okay? So it's the same as whether when we get gamma Nash less than or greater than gamma col, where we see cooperation having tighter or looser regulation than the Nash policy, simply depends on whether the capital requirement is greater or less than the return maximizing capital requirement, which govern the direction of the capital flow in the first place. Okay, so we're sort of going back to what I showed you a few slides ago. Okay, so when will that be true? So I have a simple closed form example to show you when that will happen. I guess I have a couple of minutes left. This example has a binary TFP distribution, so now risk is purely binary, and there's a fixed default probability of 1 minus Q. Okay? And we're going to make capital perfectly inelastic across both countries. Okay? So there's just n plus n prime equals a constant. And that means that picking gamma col is the same as picking the total quantitative lending that happens in the economy. Okay? We can write down a collaborative first law condition as simply being I set the marginal product of capital, MPK call, is equal to 1 plus the marginal deadweight losses those loans generate. Okay? Return maximization boils down to this expression here, which sets the MPK times a constant equal to 1. I'll explain that constant in a second. And that means you can break down the condition for whether gamma col is greater or less than the return maximizing requirement as this expression here. Okay? So 1 plus lambda times 1 minus q is greater than q over alpha. So how do you interpret this? So remember, if we see gamma col greater than gamma hat, it means that a tightening of capital regulation at home would cause an outflow and a negative externality on foreign, so you see a race to the bottom. Okay? So when is that true? When deadweight losses are large, so lambda is high. Okay, and that's a situation where you want very, very tight regulation, so gamma col is going to be high. When there's lots of incentives to shift risk, which is what the Q is picking up here in the expression too, and also when loan demand is relatively elastic. And that means there's relatively little gains from restricting quantity, so gamma hat, gamma col, quantity, so gamma hat, gamma col is relatively low. So that's what's happening here, okay? There's a fourth force which sort of is lost when you have this binary distribution, which is that, oh, I guess I'm almost out of time, but I've got 2 slides to go, okay? Give me a break. So when you allow the distribution to be continuous, then the quantity of capital starts to matter. So it's actually how much you actually have in total. And if you sort of look at that, you see that when capital is particularly scarce, that's a situation where actually you want to have very, very, so you're trading off between deadweight losses and the amount of lending, and actually gamma col ends up being tighter than the return maximizing level. And so any further tightening of regulation will lead to outflows. So that's also a situation where you have gamma Nash less than gamma col. Okay? Putting it all together, you get this sort of policy prediction, which I sort of summarized with this picture. So imagine this is a business cycle. You can think this being sort of the stock of capital available in the economy, if you wish. And so what you see is that, you know, in boom times where capital is abundant, where deadweight losses are low, where incentives of risk shifts are low, then we see a situation where there's a reason for regulation to be overly tight if you don't collaborate, because you can suck capital from abroad by raising your capital requirement. That sort of offsets some of the costs of tighter regulation. When you're at the bottom of the cycle, the opposite is true, and you see gamma Nash less than the collaborative level. Okay, so let me just conclude. So the overarching point here is that we're in a new regime. We now have, you know, time-varying capital buffers in the form of CCYB and reciprocity. Competition among regulators does not mean necessarily we have a race to the bottom. And what we do in the paper is simply, you know, first have a very simple analytical framework to study regulation in this environment. We make the point that changing requirements can generate flows in both directions. And if you have inflows, that generates an incentive for excessively tight regulation. And actually, this whether it's inflows or outflows can vary over the cycle, and that has implications for the setting of the capital buffer. Okay, so thank you. Sorry for going over time. I'll hand over to Rustam.
And we now have Rustam Jamal of Oxford.
Oh, I can't see.
Okay. Thank you, Salim. Great paper, great presentation. Thank you, Reese, and the organizers for inviting. So, to summarize briefly, the research question of the paper is on the impact of reciprocity in international capital requirements on the flow of capital across borders. And when we say capital, we mean equity capital of banks. And also on the strategic incentives of regulators to potentially under or overcut each other in terms of capital requirement setting. Reciprocity is essentially, what it means is wherever the lending takes place, the capital requirements of that jurisdiction will define the parameters of the loan. authors conduct positive and normative analysis. So the main result of the positive analysis is that there could be capital inflows and outflows from domestic capital requirement shocks, if you will, or tightenings. And then the result of the normative analysis is that intuitively domestic regulatory changes impose positive or negative externalities on foreign countries, and essentially anything can go, and pricing the externality is not obvious. The bigger overarching question is, are there gains from international coordination? In this paper, the answer is yes, because of the violation of the Tinbergen principle. So in a way, if you have fewer policy instruments that you have policy targets by construction, there will be gains from coordination. So that will be one of the points of one of the comments I will raise. So quickly on the positive analysis, in equilibrium, what will happen in this simple no arbitrage two-country economy is that a return on equity of banks will equalize across countries. That's a feature, but it's also by design, by assumption, essentially. There will be direct and indirect effects from shocks to gamma, the parameter that governs the capital requirement. The direct effect is such that higher capital requirements, return on equity falls, that capital flows out. But there is also a non-trivial indirect effect that goes through the diminishing returns channel, which is essential for the paper, that the, aggregate lending can fall, total revenues can go up because of diminishing returns to capital, and because banks essentially, they privatize, so to speak, indirectly, implicitly, the production function of the firms, their return on equity will also fall, and that will lead to inflows. And which channel dominates, it's not obvious, and it depends on situations. So in a way, it's nice because the paper can speak to both, and it's also not nice because it's quite complicated. The normative analysis, that's the beauty of the paper. It's quite nice. And it's also quite complex because there are a lot of moving parts. So the way I think of it is I think of it two states of the world. Boom and bust, high omega, which is high equity, high bank capital, and low bank capital. And if bank capital is sufficiently high, so there will be an incentive for competitive regulators to overcut each other, because there will be a race to the top. Then the gamma naturally is greater than the gamma of the collaborative outcome. So that's something Salim mentioned. So it's not necessarily always the race to the bottom, but in the crisis, potentially where what we're really concerned about in terms of macro-pro, there will be a race to the bottom. There will be an incentive for regulators to undercut each other because higher gamma imposes a positive externality on the other countries. So you want to do the opposite. So there are also useful parameter statics in the paper. So the model is quite compact, but it's also very rich. So you can talk about preferences for financial stability. You could potentially generalize bank capital, make it an exogenous dynamic variable, so you sort of make it more quantitative in a will. You could think about bank market power. You could generalize the number of countries from 2 to multiple, so you can have a potentially continuum of countries. The tragedy of the commons will apply, such that the more countries you have, the bigger the incentive will be to always deviate, because there will be more economic gains for the same financial cost. So my comments are essentially consisting of 3 points. There are 3 essential regularity conditions that give the authors most of their results, and I'm going to test them. Diminishing returns to lending, the idea that capital requirements always bind in equilibrium, and the fact or the assumption that bank return on equity equalize across countries. And there are also some minor points about market power and the lack of endogenous responses of fiscal or monetary to macro-pro. So the key assumption for the indirect effects of macro-pro on return on equity goes through this diminishing returns to lending channel. That's not obvious, right? There could be economies of scale, so that is a testable thing. And actually, people have done it. People have tested whether there are diminishing or increasing returns to lending. And there is literature, so I'm just citing this paper, Willick and Wilson, without going too much into the detail. If you look at this table, and if you look at the column for revenue, and if you compare the number versus the 1.1 benchmark, if the number is less than 1.1, there are diminishing returns. And if the number is greater than 1.1, there are increasing returns. So if you look for 2006, for the biggest banks in the United States, there is strong support for diminishing returns in revenue. For 2015, it's mixed. So there are some banks exhibit increasing returns, others in decreasing returns. For the European banks, because US does not have the countercyclical buffer in place, so you can say, why are you looking for US banks? It's a good question. For European banks, the support is generally in favor of diminishing returns, that banks are too big to manage more generally. So the diminishing returns to lending assumption can go through, and that's important for them to get the capital outflow story. Without it, they could come up with a different assumption, I suppose, but that's currently the one that gives them that. And the second assumption is capital requirements always bind. It's in an assumption also as a result of all the deposit insurance friction that they impose. Of course, the fact that there are sort of occasionally binding constraints, the fact that they're there, they already have an effect, even if they don't bind in equilibrium, because you can expect them to bind at some point. But the fact that they bind in equilibrium is not obvious, because a lot of papers don't do that. So it depends on the model and also depends on the choice of the modeler. We can look at the empirical distribution of capital ratios by European country, and for 2021, the ECB total capital ratio requirement was about 15%. So if you look at the cross-section, that's the green bar. For most countries, the capital ratio constraint appears slack. Granted, it's 2021, in the early years, the constraint was more binding, there was capital shortfall in the early years of the implementation. But as of now, maybe it's less of an issue, but the broader comment is that the constraint doesn't seem to be binding all the time for all the countries. There is also rich heterogeneity in the country-specific Lagrange multipliers on the constraint, if you just look at this slope. So it would be nice sort of to generalize the capital requirement, the way they deal with the assumption that it binds always. And finally, returns equalize across countries. That's the result of the fact that they do not have any financial frictions. And they don't have any financial externalities, which is important because those externalities could overlap with the capital flow externality, either amplify or dampen them. I understand why they don't have any financial frictions. They really want to zero in and sort of double down on the capital flow externality, so they don't want to have any other messy things. But it could affect their results. So if you look at returns on equity of banks in 2019 across Europe, there is little evidence that these returns equalize. Granted, it's a snapshot. It's hard to think about equilibrium in a two-period model. What is a short-run model, a long run? Maybe over the long run, returns actually equalize across countries. But, and also these are return on equity in percentage terms. I have no idea what that means. If converted to welfare or consumption terms, maybe this heterogeneity is massive, or maybe not. But either way, potentially this assumption is quite strict. So some minor comments. I think the discussion of bank market power is a tangent point in the paper, but that could be one of its strongest points. I think there is a lot of evidence on the rise of bank market power around the world, so maybe a more involved discussion of that is warranted, and currently it's a bit unclear what the implications are. And also there is no endogenous response of fiscal or monetary policy. So that is not a problem, but potentially if you think of a fiscal capacity constraint in the background, that could be binding in equilibrium, and if the fiscal side wants to subsidize domestic bank equity capital, that could kind of kill the violation of the Tinbergen principle, and then there will be no gains from coordination, which is the whole point of the paper. So potentially you could try to introduce it and make sure that the results dampen but not completely vanish. But And also, there is no monetary policy, and there is empirical evidence on the interactions between macro, crew, and monetary. So in conclusion, it's a really nice paper. It's superbly written. It's a pleasure to read. Compact, elegant framework on a super policy relevant question. My comments are mostly designed to encourage the authors to generalize some of their ideas, but specifically the way they handle the capital constraint and also the absence of financial frictions.
If you fancy responding initially, give people time to think of questions.
Okay, sure. I'm happy to. That's a great discussion. Thank you so much, Rustam. I really enjoyed hearing that. So I mean, there's a lot there. So I'll just remark on a few things. Probably the most relevant one. I mean, the remark on the capital requirements being binding. There's a couple of things. First is that I don't know what the local supervisors were doing. Right? It's not just an ECB level decision what those requirements are, even in Europe. So I think it's kind of that's perhaps part of the explanation. It's also a voluntary buffer point, and there's a lot of evidence that we do have quite well identified studies now within the EU showing those requirements are binding. Right, people shift the requirement, and it's a stress test or something, and banks react. Having said that, I mean, we probably could do more to allow for a voluntary buffer, which is endogenous in some way, something more dynamic or something like this. You're absolutely right on the Tinbergen principle. If you can just subsidise bank capital, there's no coordination problem, so that would fix the problem absolutely. Luckily, we don't do that. Apart from actually, we kind of do because there is a subsidy in the model, right, which is the deposit insurance, but it's perfectly proportional to capital requirement. So we kind of dodge it in that way, where the subsidy is linked to the regulation. So we're kind of cheating and by allowing for that to move in the same direction. So it's not. I guess if you had variable deposit insurance, where degree of insurance is also a policy choice, you can actually get close to replicating the Tinbergen principle. That's not in the paper, but it's something we thought about. Market power is also a good one. So if you have a fixed markup, all you do is sort of push. So imagine you sort of reduce market power of a fixed market. You push the starting equilibrium towards a monopolist point faster, right? And so you're already closer to being on the other side of the sort of the peak in the return function. And therefore, once you go across that point, any further tightening would actually just lead to an outflow and be a permanent situation where there's a race to the bottom in that situation, which I guess is the point you were trying to make. Yeah. Okay, I'll stop there. But fantastic discussion. Thank you so much.
So we have time for a few questions from the floor. While you think of it, maybe I'll start the ball rolling. It's a fascinating paper. On the empirical side, I was really going to make a comment. I'd be interested in how the sort of international banking corporations behaved within bank, but with their local presences in different. I think that would be an interesting analysis to do to see how they within bank do they respond to these things, rather than comparing across banks, where obviously the world is much richer than what you have currently. But you can probably diff out a lot of that.
That's true. Yeah, we have
the IHCs in the US, for example. It'd be interesting to see how they fit in with the international activities of their parent.
Yeah. So the prediction we have, I think, that emerges in this is that you're going to have much fewer branches and much less subsidiaries. That'd be sort of the thing that you'll get. So basically, you want to be much more like sort of separating your balance sheet out if there's no gains from arbitrage because of reciprocity. The stylized fact I have in my mind, but this is quite an old one, is that that's happened. We've seen more subsidiaries growing. Whether this is the only explanation is something I couldn't speak to.
We have a few. David? I can't see any other hands going up at the moment. Don't be shy. But David,
do you hear this? Yes. It's really interesting papers, Salim, and I agree with your basic point that you started with, that the introduction of this reciprocity idea, and it was by design that it does change the kind of incentives to vary capital requirements. It makes me more willing to hike, I think, in in a boom scenario, which I think is what your model implies. I guess my question was built around the observation that some countries have chosen to adopt reciprocation. So in Europe, it's kind of mandatory and it's written in the CRD4. Whereas in other parts of the world, you're not entirely clear whether it's happening, and it seems like it would be a voluntary thing at best. Would your model say anything about the incentives of a country to drop into the reciprocity framework or not?
So, yeah, the issue, one issue with the model is that the non-reciprocal framework is a perfect race to the bottom. Everyone just goes to the cheapest country to have to raise capital. So actually, it's kind of so bad that it's obvious you want to have reciprocity. I imagine if you added the frictions that Rustam was talking about, where actually there wasn't free capital mobility, then that would go away and there'd be more of a trade-off, particularly for the local regulator. Yeah.
George?
From dynamics. How would you incorporate dynamics into such a model? How difficult would it be?
So the key sort of state variable here would be the stock of capital available, like this sort of endowment of capital that the banks have internationally, right? So you imagine a world where banks take losses and make profits over time, and the stock becomes a state variable. You end up with a picture which is very similar to the last one I showed, where you have a cycle where that black line is the amount of capital available, that's your state variable, and then the cyclicality of the capital requirements follows the red and blue line that I had on the presentation. I mean, I kind of think it's not a huge extension. Now, having a much richer model, like medium scale model with other frictions, that would be a different story. But we have a might simply one where profits and losses accumulate over time, and that becomes a state variable.
Tremendous. Thank you very much, gentlemen. If I could ask Shahini and Veronica to come to the stage, that would be great, please. So Shahini is at UCLA. Pleasure to have you here.
Okay, I'm starting a timer. So I recognize that I'm standing between you and lunch, so I'll try to keep your mind off food for the next 20 minutes. My name is Shahini, I'm at UCLA, and the title of this paper is The Geography of Bank Deposits and the Origins of Aggregate Fluctuations. This paper is joint work with Songjin Park and Nishant Vats, who are 2 PhD students at the University of Chicago. So the motivation for this paper comes from the simplified diagram of a bank's balance sheet. On the asset side, we have various types of loans, securities, and other assets. And these long-term illiquid assets are financed primarily by liquid liabilities in the form of demand deposits. Now, this liquidity transformation is critical for financing long-term illiquid assets, but it's also a key source of vulnerability for banks in the economy. In this paper, we introduce a new source of financial fragility, which is the geography of bank deposits. We posit that the geography of banking assets and liabilities can make the economy on aggregate more susceptible to idiosyncratic shocks. So what do we mean by this? Well, banks collect deposits across geographies and then allocate lending activity. So concretely, loans in Los Angeles might be financed by deposits from Kansas City. And that means that if there's a localized shock in Kansas City, which reduces the supply of funding, it can transmit to distant areas. Now, this problem is aggravated if bank deposits exhibit geographic concentration, and that's what we empirically test in this paper. The idea is that if you have local exogenous shocks in areas in which deposits are concentrated, it can account for aggregate fluctuations, and that's what we refer to as the deposits channel of aggregate fluctuations. So the research question we ask is, can local deposit shocks account for aggregate fluctuations? Now, the classical economics answer to this is no, idiosyncratic shocks cannot account for aggregate fluctuations as implied by the central limit theorem. But two recently developed lines of inquiry in macroeconomics challenge this view. The first is the granular hypothesis put forth by Gebex in Gebex 2011, in which he argues that when economic activity exhibits fat tails and there are finite samples, the central limit theorem breaks down. And the second hypothesis comes from Asimoglu, Carvalho, Daglar, and Tabasalehi, in which they argue that idiosyncratic shocks are amplified in the presence of a network structure. This paper combines both of these hypotheses. So first, we show that bank deposits are geographically concentrated, exhibiting fat tails. And second, bank internal capital markets provide a mechanism for the amplification of idiosyncratic shocks through their network structure. Okay, so the overarching objective of the paper is to understand the geography of bank deposits and how idiosyncratic shocks can account for aggregate fluctuations. There are 4 key findings in this paper. First, bank deposits are geographically concentrated, and this is a new fact that we introduced, that about 30% of bank deposits come from a single county. Second, we construct novel bank-specific deposit shocks by combining the geographic concentration of deposits with local natural disaster-induced property damages. And we use these shocks to show that these local idiosyncratic deposit shocks can account for aggregate fluctuations. And specifically, the transmission of natural disasters into economic growth occurs through the deposits channel, which negatively affects bank lending. And lastly, we argue that financial frictions are critical for the aggregation of idiosyncratic shocks. This includes lender constraints, regulatory constraints, the stickiness in bank-borrower relationships, informational advantages, and the opacity of informational lending across different regions, which we'll talk about later. Okay, so the first fact is that bank deposits are geographically concentrated. So note that this is a within bank concentration of deposits and not within county. So using summary of deposits data from the FDIC, we identify the share of deposits coming from each county for each bank. So let me be specific about how we construct this figure. We take a bank like PNC Bank and we look at where PNC raises the greatest amount of deposits. And then we rank those counties on this x-axis here. So county number 1 refers to the county in which the bank raises the greatest amount of deposits. County number 2 is the county in which PNC raises the second greatest amount of deposits, and so on and so forth. And the y-axis indicates the share of deposits. So here we have 3 lines in red, blue, and green. The red line is taking the blue line is taking the simple average of the share of deposits coming from each county across all banks. The red line is taking a weighted average by weighting the share of deposits by a bank's total amount of assets. And the green line is plotting the regression margins after regressing the share of deposits on the county number while accounting for a county cross bank and bank cross year fixed effect. And we find that regardless of the methodology, the largest deposit county accounts for 30% of bank deposits. Now, you might be concerned that perhaps the geographic concentration of deposits isn't new, perhaps it's driven by the smallest of banks, the largest of banks, maybe the largest deposit county is it's all New York. So we do a number of robustness checks in which we show that the geographic concentration of deposits is there from 1994. We see that there's concentration both for the smallest of banks as well as the largest of banks. And we show that the concentration doesn't vary across bank characteristics. So this includes percentiles of deposits, loans, liabilities, and equity. And I'll show you very quickly, we find that the geography of the largest deposit county is dispersed across the United States. So it is not all New York City. And then we address with some measurement concerns regarding the FDIC summary of deposits data. So next what we do is we switch gears to try and understand how natural disasters affect deposit growth. And we identify natural disasters or a disaster shock using the county level amount of property damages incurred per capita. So this is exhibiting a heat map of the property damages per capita across counties from 1994 through 2018. And you can see that some regions are prone to natural disasters like the Gulf region, and some places in the Northwest are less susceptible to natural disasters. And we then tabulate the hazard types, and you can see that some events occur very frequently, like wind and severe storm, but they don't incur nearly as high damages as less frequent events like hurricanes and earthquakes. Okay, so what we do is we try and understand what is the immediate effect of a natural disaster on deposit growth in a particular county. And so here we're regressing deposit growth in a county at time t on the disaster shock that's experienced in the same time period. And we account for county-specific variables and changes that occur in the state over time through this innovation in fixed effects. And we find that a 1 standard deviation disaster shock is associated with a 0.07 to 0.11 percentage points decline in deposit growth, which is comparable to the 25th percentile. And for reference, a 1 standard deviation disaster shock corresponds to a loss of $570 per capita. Okay, so far we've established that there's an immediate decline in deposits when a county experiences a disaster shock. So naturally, the next order question is, how persistent is this effect? So here we're studying the impulse response function of deposits to a disaster shock in a particular county. And you can see that when a county experiences a disaster shock, there's an immediate decline in deposits, and this effect persists through 10 years. And so what this suggests is that local disaster shocks negatively affect local bank deposits, both in the short run and in the long run. We see that this effect is permanent. So then what we do is we construct novel bank-specific deposit shocks by taking the county level amount of property damages per capita and weighting it by a bank's share of deposits in a particular county. And then we establish 2 key properties of these bank-specific deposit shocks. First, that these shocks are idiosyncratic, and second, that these shocks are important, and I'll tell you what I mean by that. So for a shock to be idiosyncratic, the shock shouldn't be foreseen or anticipated. And so here we're regressing the bank-specific idiosyncratic shock on a multitude of bank-specific variables. And that includes loans, assets, equity, cash deposits, hedging assets, dividends, and income. And from these univariate regressions, you can see that there's virtually no explanatory power for any of these variables in explaining the idiosyncratic variation in the idiosyncratic shock. And the point estimates suggest that there isn't any robust pattern in terms of the statistical significance or economic magnitude of these variables. So it suggests that bank-specific characteristics can't predict the bank-specific deposit shock. Now, even if you don't buy that, we then further try and understand how idiosyncratic these shocks are really. So what we do is we plot the kernel density that's associated with the AR1 coefficient of these bank-specific deposit shocks. And we also plot the kernel density that's associated with the R-square from regressing the bank shocks in pairwise regressions. And you can see that both of these kernel densities are centered around 0, suggesting that the shocks lack temporal dynamics and spatial dynamics. So there's very low cross-bank correlation, and these shocks appear to be transient, which are 2 properties you might think are associated with idiosyncratic shocks. And then, despite that these shocks are idiosyncratic, they are important in the sense that they can predict declines in deposits and liquidity creation. So here we're running a Jorda projection in which we're projecting deposits in the left figure and liquidity creation in the figure to the right on the bank-specific deposit shock. And we find that a 1 standard deviation deposit shock results in an immediate decline in deposits by 0.97 percentage points and 0.19 percentage points in liquidity creation. And these effects wane over time, which you can see in both of these panels. So then after taking this bank level shock, we then extract aggregate shocks and granular shocks using the GIV methodology of Gebex and Koyen. So we take our bank level shocks and then we aggregate it to form aggregate shocks by weighting the bank specific shocks by a bank's share of lending activity. And then from that aggregate shock, we extract granular shocks by taking out equal weighted shares from these aggregate shocks. And intuitively what we're doing is we're trying to remove the effect of common factors so that the granular shock reflects the idiosyncratic deposit growth of large banks after taking into account common factors. Okay, so here we're plotting our aggregate shocks over time. Why are we doing this? Well, we want to make sure that these aggregate shocks actually reflect fundamental changes in the microeconomy of a region rather than just reflecting spatial noise. And so we conduct a narrative analysis in which we find that, yes, our aggregate shocks do reflect natural disasters that occur in the same year. Oftentimes, these disasters coincide with other major natural disasters, and they can also span multiple states. And these aggregate shocks are also nicely correlated with the insurance payout that's associated with natural disasters, which suggests that indeed the aggregate shocks reflect deposit shocks that originate from natural disasters. Okay, so what is the main message of this paper? The main message is that there's a negative relation between bank deposit shocks and GDP growth, and that aggregate shocks can explain variation in economic growth. So we codify this relationship in a regression framework. And here we're regressing GDP growth at time t on the granular shock at t-1. And we find that a 1 standard deviation granular shock reduces economic growth by 0.05 to 0.07 percentage points. So this is our main result, that aggregate deposit shocks can explain aggregate fluctuations. Now, how much variation do these shocks explain? So to answer this question, we regress GDP growth on several lags of the granular shock. And we find that collectively, the granular shocks can explain 3.3% of variation in economic growth. So the next order question is, well, is this large, is this small? How does this compare to other macroeconomic shocks? So next what we do is we run a horse race between our granular shock and other macroeconomic shocks that are commonly used in the literature. This includes oil shocks, monetary policy shocks, uncertainty shocks, term spread, government expenditure shocks, and the Gebek's granular residual, which is used in his 2011 paper. And we find that the granular shocks can explain as much variation as other macroeconomic shocks, and the effect of the granular shocks is robust to controlling for other macroeconomic factors. And so you can see from the R square, the shocks explain as much variation, and the point estimate remains stable and statistically significant even with the addition of different macroeconomic shocks. So then we study the long-run response of GDP growth to this granular shock in the figure to the left. And what we find is that there's an immediate effect of the deposit shock on GDP growth, which slowly wanes over the course of roughly 5 quarters. Now, the next concern is perhaps we're actually capturing a direct effect of natural disasters on GDP growth rather than deposits. So to examine this hypothesis, we run a Jorda projection of GDP growth directly on the natural disaster shock. And we find that there's no quantitatively relevant or economically meaningful effect of disasters on economic growth, which lends credence to the hypothesis that natural disasters affect economic growth through the deposits channel by negatively affecting deposits. And this GIV setup allows us to estimate the aggregate elasticity of economic growth using a 2SLS specification. So the extant literature so far has relied on cross-sectional estimates to try and understand the question of how deposits affect economic growth. Now, the issue with using cross-sectional estimates is that there's a missing intercept problem, which is that oftentimes aggregate variables don't exhibit cross-sectional variation. And so without that missing intercept being properly identified, the aggregate elasticity that's measured from cross-sectional estimates can provide unreliable estimates. So here, in our 2SLS specification, the first stage is in the even columns and the second stage is in the odd columns. We first regress deposit growth on our granular shock. And the granular shock is an instrument for deposit growth. And then in the second stage, we then regress economic growth on our instrumented value of deposits growth to come up with the deposit elasticity of economic growth. And we find that a 1 percentage point increase in deposit growth is associated with a 0.87 percentage points increase in economic growth. So to understand whether this magnitude is reasonable or not, we then also try and understand what the loan supply elasticity is of economic growth. And we find that a 1 percentage point increase or decrease in the loan supply results in a decline in economic growth by 0.14 percentage points. And that's comparable to the existing literature, which suggests that the magnitude of 0.8755 is well calibrated. And using this setup, we then estimate the money multiplier to be 1.18. Okay, so far we've established that local deposit shocks affect economic growth. But the question is, what is the mechanism through which shocks to deposits affect economic growth? Now, we argue that this occurs through the bank lending channel, and in particular, the reduction in bank lending is what explains how shocks to banks affect economic growth. So we use micro data from small business lending and mortgages to show that the mechanism through which this occurs is bank lending. And in particular, we're able to exploit differences in lending types to show that loans which are more likely to be funded by deposits funding will experience greater reductions relative to those that are less likely to be financed by deposit funding. So let me just very quickly speak to these results. Our identifying assumption in our empirical analysis here is that banks face identical investment opportunities within a county. Now, a weaker version of this identifying assumption is that any friction which creates a wedge between investment opportunities to different banks within a county is unrelated to an idiosyncratic shock that occurs elsewhere. And then we control for the time invariant importance of a particular bank in a particular county by including county cross-bank fixed effects. Okay, so that's the identifying assumption. I won't go through all the results in the interest of time, but I will highlight that jumbo mortgages in the United States can't get securitized, whereas conforming mortgages are securitized due to the efforts of the government-sponsored enterprises. And so non-jumbo mortgages are more likely to be funded by bonds relative to jumbo mortgages, which are more likely to be funded by deposits. And here we include very conservative fixed effects specifications in which we compare jumbo and non-jumbo mortgages, which are originated by the same bank in the same county in the same year, and we find that the lending cuts occur more for jumbo mortgages relative to non-jumbo mortgages. Now, it's in order for idiosyncratic shocks to generate aggregate fluctuations, we highlight the role of financial frictions. And in particular, we find that banks which are more constrained and operate closer to the Tier 1 capital ratio magnify amplification of these shocks. We find that banks tend to cut lending in areas where they lack informational advantages and they're less likely to extract rent. So these are areas where they either don't have a bank branch or they don't do much of their lending activity. And then we also find that borrowers which are more constrained experience greater reductions in lending. And this is because they often have sticky relationships with banks, and the stickiness of bank-borrower relationships can impede their ability to find new creditors quickly. So to conclude, let me just quickly say that we do a number of robustness checks. But there are three key ingredients that are necessary to explain how the deposits channel can generate aggregate fluctuations. First is that deposits need to be geographically concentrated. If deposits are not geographically concentrated and a large disaster hits a particular county, it's not going to wipe out deposit funding or have aggregate effects. The second key ingredient is that there needs to be a large disaster, which is what we're highlighting in this paper. So even if bank deposits are geographically concentrated and all of a bank's funding comes from a given county, if that county experiences some rain, it's unlikely to wipe out the deposit funding, and there's unlikely to have any kind of, it's unlikely to transmit to the aggregate economy. And the third key ingredient is that there needs to be large banks which experience reductions in deposits. If small banks experience a reduction in deposits, then it's not going to transmit to other geographic regions through internal capital markets. So we run a placebo test which highlights that we need these three key ingredients to explain the story, and this lends credence to the hypothesis that natural disasters affect economic growth through the deposits channel. Okay, so 3 points of the paper. First is that we document a new source of bank fragility, which is the geography of bank deposits, documenting a new fact that 30% of bank deposits come from a single county. Second is this deposits channel of aggregate fluctuations, that shocks can explain 3.3% of variation in economic growth. And lastly, financial frictions are crucial for magnifying idiosyncratic shocks and generating aggregate effects. Thank you.
And we have Veronica Rappaport from LSE's discussion. I'd also point out that Shahini and indeed Rustam earlier were part of our Young Economist Prize last year from QCGBF. And it's good to see them back.
Well, first of all, thanks the organizers for inviting me to discuss this paper. Really interesting paper and great presentation. The big question of this paper, the broad question is really how do shocks to bank propagate to the rest of the economy and result in aggregate fluctuations? And on this, I want to highlight the three main points of the paper in kind of a different order. First, banks' geographical distribution of deposits is very skewed to the point that on average, and not only on average, really even to, which is surprising to me, even for the big four American banks, 30% of bank deposits is in a single county. Second, idiosyncratic shocks to a county, and in particular, they look at the new measure for county deposit shocks, natural disasters, and the value of property damage, how they affects lending by geographically exposed banks, like those banks that are, which have deposits concentrated in that area. And finally, they want to see how that idiosyncratic bank shock ends up affecting economic growth. That is very ambitious, and they estimated an elasticity of growth to deposits. I'm going to go through each of these 3 points, probably focusing more on the third one, which is the more controversial of all. First, there's mounting and increasing evidence that there are trade-offs against bank diversification. We always thought of banks as having a diversified portfolio of commercial loans, having a diversified sources of borrowing, not necessarily because their deposits are diversified, but because they have access to interbank lending or different markets. And we are learning more and more that that is not the case, that there are forces to trade off against diversification. What we know more is on the lending side. Turns out that the portfolio of loans, in terms of geographic location of the firms, or in terms of the type of loans they do, mortgages or commercial, what type of, within commercial, collateral, no collateral, or even within the activities of the borrowing firms, is concentrated. So banks appear to be specialized. And in this case, they look at the cross-county distribution of deposits. And what I'm going to emphasize, it is also true for the top large national banks. We do expect smaller banks in the US, there are many regional banks, to be concentrated. And once you have a bank that is concentrated, or it's regional in the sense that it's mostly a state bank, well, not surprising, there are few counties in a state that can account for that type of activity. So that is not surprising. But as she explained in the presentation, the top four large national banks are also characterized by concentration of deposits. So the first question is, what is the benchmark? And the benchmark in which we have to compare the distribution of deposits really depends on the question. If we want to say whether a bank is skewed or not skewed towards different geographies, probably the right benchmark is the balls and into bins kind of distribution. That should be the null hypothesis. If a bank has activities in one state, well, what is the null hypothesis relative to how the activity in one state is concentrated? But as said, larger counties are expected to account for big shares of deposits, especially for regional banks, but that is not the whole story. In here, also the very large ones are concentrated. And that probably a lot more is could be done in terms of how are nested correspondent accounts treated, internet account. They discuss something in the paper how about some robustness using the county of the headquarters, but it's so surprising that also the 4 large banks, even removing the headquarter county, are concentrated, are probably a little bit more into what are deposits would be really nice. But for the purpose of this paper, I think what they do is perfectly right. For the purpose of the paper, they just want to see how exposed a bank is to a shock in one particular county. So without getting into the benchmark of distribution of deposits, they just look at the distribution of at the exposure of a bank to a shock to a county. So let me show a little bit what they. Oh, it's really sad little red dot here. But basically, what they look is they look, for example, at lending, and I go to the second point of the paper here. Shock to a county affects lending by exposed bank through this deposit mechanism. How is it that they look? They look at lending by a bank in a county at a given point in time. They absorb all these fixed effects, and they look at deposits by instrumenting it with the share of deposits that a county has represents in a particular bank, and this measure of per capita value of property damage by natural disaster in a county. There's a big literature on lending channel after heterogeneous funding shock to banks. They do not go much into that literature because they try to get into the macro consequences, but I advise them to look into it because you see a lot of refinement that's been done about this type of literature, and they emphasize how to deal with the usual caveats. Of course, local shocks, some of them, I will remove the word idiosyncratic from here because some of these shocks are not idiosyncratic at all. They're really big shocks. Are likely to correlate with economic activity of the county, with collateral, with consumption, with wealth, and all that fits back into credit demand by firms or clients in that county. And of course, the idea is, well, these fixed effects account for that, for the demand, but that is only true if we think that that demand changes proportionally to all banks in the same county. And on that, we have a lot of problems because, well, if the bank's portfolio is not balanced in terms of deposits, why would we assume it's balanced in terms of lending? In the sense is, well, if different banks are specialized in some type of deposits, they also might be specialized in some type of loans or firms, which react differently to these shocks. So even in counties that are not affected by the shocks, we are talking about clients that prefer to borrow from a bank that has a lot of presence in another county. Why is that? Probably because they have connection to that county, and that is something we establish in terms of international activities of firm. So my suggestion on this is just follow some of these shocks, the big shocks. What happens with the banks? What happens with the balance sheet? What happens with the non-performing loans? Are these banks' geographical distribution of deposits correlated with that of lending or type of maybe we have that correlation both in terms of lending and then we see that. There's something about looking at the particular shock that allows us to say whether identification is well done or not. The fixed effects are not a magic bullet again that allows us to forget about the identification. We unfortunately need to get into that. And then we get into the final point, which is really controversial to me because it looks at growth and deposits. And of course, every type of movement you can think of is in that correlation in between growth and deposits. We just imagine them going together for 1 trillion of different reasons. So everything is against us when we try to identify beta there in a causal way. So how is it that they do it? Well, this thing here that I kind of point is what we had before, which is the shock to the bank given by the exposure of deposits to a county and the shock to the county. And now we are weighting that by the importance of that bank in lending. the share of that bank in total lending in the U.S. And that is our shock, if you mean. But well, of course, whatever shocks is happening to a country has a direct effect on growth. So how do we account for that? Well, with its equal weighted impact. The idea is that whatever is happening to that shock, if we put equal weighted in terms of bank and deposit presence in that area, it's accounting for all the commitment between that shock and growth. And that identification assumption is strange because we say, well, all commitment between growth and these shocks, other than through the lending channel, is accounted by this equal weighted measure. So the assumption really is that heterogeneity is one-sided. Shocks affecting deposits do not have heterogeneous real effects. So value-weighted and equal-weighted, differences only can be driven by the credit channel. But those weights are telling us a lot about the nature of the shock. The deposit shocks that count in these effects are the very large shocks to really top county banks. But these shocks, what are they? Are they oil shocks? Are they shocks that destroy the insurance industry? Are they really an idiosyncratic shock? Is this the mechanism that goes through them? So just to conclude, this is a super interesting paper, very, very interesting. My only concern is, well, the usual. Just look at one shock and see whether the effects that drive that shock fit the identification assumption or the opposite. Find a counterexample that does not fit and think whether it's likely that that counterexample is pervasive in the real data. Hopefully that would fix ideas of whether the methodology is sound. Well, thank you. Sorry, I ran out of time.
Feel free to respond immediately, and then we'll go for questions and comments.
Sure. So thank you, Veronica, for the very thoughtful and insightful discussion. I think it gives us a lot to think about in the next iteration of this paper. Let me just make 3 quick comments because I know we're running a little bit short on time. On the first point about what might explain the geographic concentration of deposit, that's something that we haven't investigated, and we've been so far pretty agnostic to the factors that can lead to geographic concentration, and it's difficult to think about an appropriate benchmark, but I think that's the next step in thinking about how should we think about whether this concentration is too high or too small, or what it should be, what a frictionless equilibrium would look like. The second point about measurement issues is well taken, and I think part of the analysis that we can do is limited by the data that we have, which is the summary of deposits data. And sometimes the data doesn't cleanly identify which accounts reflect internet accounts or which ones reflect different corresponding accounts. So we've done this headquarter analysis to try and get around that issue. We've limited the analysis to banks that operate in more than a single branch, and we've done our best to try and address the measurement issues, but at worst, this would understate the results and bias the results downwards by attributing a change in a geographic region where a natural disaster didn't hit. So in some sense, the estimates might provide a lower bound, but we are limited by the data that's provided. On the second point about demand, this is a major challenge of causally identifying the effect of the deposit shocks on lending activity that occurs elsewhere. And you're right that we use a number of fixed effects to try and control for demand, and that there are strict identifying assumptions, but some of these assumptions are relaxed when we do more granular cross-sectional tests, in the sense that we do a test in which we compare small borrowers of small business loans to large borrowers of large business loans, and there we can control for county, cross-bank, cross-year fixed effects, and also control for county, cross-bank, cross-small fixed effects, which directly gets to the heart of the concern that perhaps there are some banks which specialize in a particular type of lending, or they might be particularly important to a specific county. But overall, I think it makes a lot of sense that we should dig deeper into the data to try and understand what do these shocks look like, how do they affect particular counties, and conduct some case studies to understand where the exceptions lie and where to better understand the mechanism of how things actually occur. Because so far we've shown this in numbers, but it would be nice to better have anecdotes and supporting evidence behind these numbers. So thank you very much.
I'll just slip in one quick question, or maybe two. Is it, we haven't met, but is it George? Yes.
Thank you. Is it on?
Yep.
George Selgin from the Cato Institute in DC. I have a comment really about the paper. I find it very interesting, and I think the results are also important. But my comment concerns the way it's couched as a discovery of a new source of financial stability or fragility, pardon me. And the reason I'm troubled by that is because, from my perspective as a monetary historian, the fragility of the U.S. banks as a result of the concentration, geographic concentration of their deposits and their assets has been a notorious fact of U.S. banking history for 2 centuries. Don't get me wrong. It was so for most of this time because of unit banking, which very easily explains the concentration in question. And sure enough, banks failed because of shocks to particular crops and all that is very common. So what I think really, if it were me and I were motivating your paper, I wouldn't say you've discovered a new source of financial fragility. I would say that you have discovered what is just as interesting, in my opinion, which is that the introduction of branch banking, since the 90s especially, hasn't eliminated this source of fragility. So my suggestion, I'm sorry it's not a question, but my suggestion is that you might couch your results that way rather than as discovering a kind of fragility that has never existed or been known to exist in the past.
I think it was more a comment than a question, so I'll move. No, it's excellent. And Martin?
Thank you very much. Martin Wheel. I was wondering how plausible you find the finding that bank deposit shocks are permanent in areas prone to natural disasters. No, the disasters are all one way. You don't have a positive disaster, so it would mean that the supply of deposits would over time dwindle to zero. So that seems to me to suggest that the effects are actually temporary, despite your statistical findings.
So I think the concern is the plausibility of whether deposit funding is permanently wiped out. Am I understanding your question correctly? Yes. Okay. So there's past work by Cortez and Strahan in which they show that when a natural disaster hits a particular areas, imagine Hurricane Katrina hits Louisiana, that region usually experiences increased demand for credit. And the reason for that is that the region often needs funding to reconstruct and rebuild after a major natural disaster. And what they find in that paper is that because there's a demand for credit, the increased demand for credit is transitory. It lasts only about a year, and then demand reverts back to what it was before the natural disaster hit. In contrast to that, what we're highlighting is the supply side of funding. And the idea that we have in mind, I mean, what we find in the evidence, what we find in the data is that when a natural disaster hits, there's a decline in deposits and that this effect persists through 10 years. We haven't looked beyond 10 years to understand whether there's reversion back or whether it goes fully down to zero. But the idea is that people often take money out of the banks in order to self-insure against shocks that they think might occur in the future. There's some migration, so capital migrates out of particular areas, but that's what the literature has shown so far, and that's how we've rationalized the findings.
Rustam, I'm going to let you chat offline if that's okay. We're going to head to lunch. Anybody else with questions, of course, Shahini will be around. So thank you very much for an excellent session, all the speakers and discussants. So yeah, the lunch will be in the area you were in previously, and hopefully we'll be back here fairly promptly at in just under an hour. Cheers.
Thank you very much.
On monetary theory, and so let's kick off straight away with our first talk. So we're going to have Maxi Gunewich, who will present his paper. Let me give you the floor. Maxi.
Okay. Thank you very much for inviting me. Thank you very much for making it possible that I can present this from my living room on such short notice. Can I just quickly check? I can't see anyone. Can you hear me all right?
We can hear you. And actually, I should probably mention that Maxi was supposed to be with us in presence, but unfortunately, he's got COVID. I hope you're feeling okay, and this is not too much. So thanks a lot. You know, especially big thanks for being here virtually and still presenting your paper despite the COVID.
No, of course.
So
I'm on the way back. So thank you very much for making this possible. Okay, so I'm going to be presenting my paper, Money Talks, Information and Seigniorage. And so what I want to think about is, I want to think about currency competition with firms. And so I'm going to be considering firms, producers of consumption goods that issue money. And I'm going to say this brings two benefits. And the first one is information. So one aspect about these currencies that are being issued by firms is that they're being issued by some centralized entities. And so transactions are also being verified centrally, and that generates a huge amount of data. And if we realize that almost every economic interaction that we have involves some form of payment, then the amount of data that can be generated really is enormous. And the second benefit that accrues with currencies is seigniorage. So consumers are going to hold some assets which are dominated in terms of interest by other assets, for example, bonds. And so this cost of money is going to become seigniorage income to the issuer. And so I want to think about these private centralized digital currencies issued by firms who have profit motives, who have competitors, and the main example is the now folded Facebook's Diem, which was meant to be issued by a consortium of 100 firms, and that caused a lot of policymakers and academics to worry what this potentially means for central bank policy autonomy, and that's what I'm going to want to be thinking about. So a lot of the things I'm going to be saying generally also apply to, for example, Alipay tokens, although, of course, payment technologies in China are very much subject to very stark regulation, so that's going to interfere with some of to the degree to which these results apply. But just to highlight, we have Alipay, which belongs to Alibaba, that has more than 1.5 billion users, and Alibaba is effectively Amazon, and so potentially, some of these firm currencies are already big and in circulation and very much important in terms of transactions. And so I want to think about what it means for central bank to be competing with these firms. And that's the first motivation. The second one is existing models of currency competition. And I'm going to be taking a macro view here. And very often in these macro models, there's this assumption of perfect substitutability. So they think about a world in which Bitcoin and the pound are perfectly substitutable in terms of settling transactions. And then you get some stark results. You get portfolio indeterminacies, you get fixed exchange rate if all currencies are valued in equilibrium. And then as an outcome of that, what you have to have is a decoupling of token price and monetary policy, because you're only going to hold two tokens, say the pound and Bitcoin, if they have a fixed exchange rate over time, which they give you the same transaction services. And this will then induce inflationary pressures because it incentivizes entrepreneurs, issuers of private currency, to be printing a lot of that money. And so that doesn't quite match up with what we see in terms of Bitcoin supply and so on and so forth. And also it's a very stark prediction that we get these inflationary equilibria. So I wanted to revisit this with firms. And secondly, with private currencies, they're very much an outcome of coordination. Yeah. So at any given point in time, and maybe this is why we've seen Bitcoin, lose so much value recently, is we can coordinate on no longer valuing Bitcoin. So there's a sunspot crash risk. Money only has value if we expect it to have value tomorrow, and that's why we're willing to accept it in exchange, if we believe we can use it in exchange tomorrow. And so that can go away if we coordinate on not valuing money. And with firms, there's less of a coordination problem here, because the issue of that money will also be part of the transaction on the receiving end. So they are very much incentivized to accept money and, can act as coordination device to make sure that firm money continues to be accepted. Okay, so what I want to think about is how do the two benefits, information and seigniorage, affect issuance and acceptance of private centralized digital currencies, and I want to think about monetary policy consequences. And in order to do so, I'm going to develop a benchmark economy in which firms engage in imperfect competition, and here information is going to shape the degree of currency competition. And in particular, what information will do is it will limit the degree of interoperability. So in other words, firms are going to be reluctant to accept other firms' currencies. And then in that world, given this first result, the central bank in this benchmark economy loses policy autonomy and is actually going to be forced to implement the Friedman rule. It's a very stark outcome, and so then I'm going to be breaking this benchmark model by introducing a notion of private currency market power. I'm just going to show you one today, but there's two notions in the paper. Okay, so let me give you an overview of the setup. So there's a unit measure of consumers, and they can be of two types, one being a low type and one being the high type, and then they derive consumption utility. And that type theta basically affects how much they like consuming consumption goods. So in equilibrium, what will happen is that at any given price, high type consumers are going to demand more of the consumption goods, so it's actually going to be more profitable to sell into these in equilibrium. Consumers consume, they supply labor, which is needed to produce, and they form portfolios of bonds and money. And I'm going to be modeling information in a relatively crude way, but I think what it captures in the essence that, firms don't perfectly know consumer tastes. So I'm going to say that this type is unobservable initially. And that's going to be a notion of information that I'm bringing into the model, because later on, private currencies allow you to uncover these types. And then I'm going to introduce a requirement for a medium of exchange. So in particular, my consumers are going to be subject to a cash in advance constraint. They need to hold money in order to purchase consumption goods. And when you get money, you get seigniorage. So this cash in advance constraint is going to introduce a notion of seigniorage. And next, I'm going to give firms market power. So in particular, in any given time period, consumers are going to have to choose a firm which they visit, and once they've chosen this firm, they're locked in with this firm for any given time period. And then the model has a couple of further assumptions to make the model tractable. So I'm cutting off price purchase history, so it's an OLG model for consumers. I'm going to assume that there's some quasi-linear utility, as in Lagos right, which basically makes the money distribution degenerate and makes solving the model a lot more easy. And there's two firms. Let's call them F and let's call them G. They produce the consumption good, and they have the option to introduce private currency. That's a choice, whether they want to introduce it or not. In any given time period, firms set a price P, and they are producing at some constant marginal costs. Now, firms have the ability to send advertising messages, but in limited capacity. And what advertising messages will do is they will direct consumer search partially, and only if it doesn't, and advertising will only affect consumer search if it doesn't make consumers worse off. So consumers are not behaving irrationally here, but it's going to be basically a tiebreaker. If consumers expect to be locked in with these firms, once they've made a choice, this gives firms market power. And so they're going to be choosing a firm which they expect to charge the lowest price. If they're indifferent, advertising can be a tiebreaker. What firms also do is they may introduce private currencies, and so they might set private monetary policy, just the growth rate of private money tokens. And so initially for this talk, just say there's public money, call it the dollar, and there's private money, call it diem, and the squiggly line is the diem symbol. And we're going to assume that whenever private currency is being used to settle transactions, it reveals consumer types. So this just captures the idea that, these transactions being verified centrally, it generates some data to the issue of money. And I'm going to allow firms to decide which currencies they want to accept. And that's basically the setup here. There's a government in the background, but it's very passive. Okay, So in this benchmark model, I'm going to make an assumption that there are no network effects. What do I mean? Consumers perfectly anticipate which currencies each firm accepts. So if, for example, Amazon should not accept diem, then consumers know this and they're not going to show up with diem holdings at Amazon and then thus can't do purchases. So this is one of the ways I'm going to be breaking the benchmark, not in this talk today, but it's in the paper. But I basically, generalize this assumption in the paper. But for now, no network effects. And then the first result of the paper, firms actually don't accept competitors' private currencies. And the intuition is the following. It's not optimal to generate information for your competitor, right? This information is being generated if you accept private currency. It allows your competitor to learn which are the high valuation customers of yours, and then they are going to use advertising to attract them away from you. And so you don't like that, and so you don't accept competitor payment technologies, currencies. And we have some real-world analogs for this. So actually, Alibaba does not accept WeChat Pay. WeChat Pay has more than 1 billion users, so this is a huge payment technology, and Alibaba doesn't accept it. Similarly, Amazon does not accept Google Pay or Apple Pay, for example. Again, also very big technology providers, Google and Apple, for payments. Now, for the benchmark result about monetary policy, one thing is important to realize, and that is, if you have to hold money to consume, then the opportunity cost of money acts like a tax on consumption. And so to illustrate, let's take a look at the cash in advance constraint that consumer I faces with firm J. Well, this is actually a typo. It should be consumer J with firm I. Apologies. So what do we have on the left-hand side of this constraint? It's consumption expenditure, the price P that this firm is setting, and then times C, the consumption level of my consumer J. And what we have on the right-hand side is accepted real money balances. So M is a vector, gamma is a vector, and phi is a matrix. M being nominal balances, phi being the vector of prices of money in consumption goods, and gamma being a vector of acceptance policies of firms. So effectively, you can think about if gamma was just equal to 0, every element was equal to 0, this firm would just not be accepting any kind of money, and you couldn't bring any real money balances to these firms. If there's only one element, which is 1, and all others are 0 in this gamma vector, it implies that only this one currency associated with that one element in that vector is being accepted by firm I. Now, if holding money is costly and its only purpose is to purchase consumption goods, then this constraint is going to bind in equilibrium. And what it will also do is the opportunity cost of money, and let's call it tau I, what it will do is, just like a consumption tax, it's going to scale up the price P. And what I've given you here is my consumer's optimal demand, given their type, given the price they face P, and given the opportunity cost of money tau that they are subjected to. And the idea is the following. If I purchase consumption from firm I, I'm going to have to pay the price P once to the firm, but then I'm going to have to pay it another tau times to the issuer of money, because money is going to be proportional to my consumption expenditure, and holding money is costly. And what is this opportunity cost of money? It really is the interest rate. Yeah, you could, if you didn't have to hold money, you could have held bonds, and bonds would have paid you interest. So that's exactly what captures the cost of money here, and it scales up the price. Now, with this first result that I've given you, with this proposition, DM holdings are going to be bound from above by firm F's transactions. So firm F, think of Facebook and their friends, their consortium friends, they are the ones issuing DM. Because the other firm doesn't accept it, basically any DM holdings in this economy must be associated with firm F transactions. So what is now the optimal price and private monetary policy that firms implement? And so let's think about a dollar transaction. What happens here is that the firm sets the price, but it's the central bank setting the interest rate and thus implementing this opportunity cost of money tau. And my firm's maximization problem, conditional on consumers showing up, is the following. I have my price that I set P, there's a marginal cost I produce, and then what I have here on the right-hand side is my consumption function. And turns out that there's a P tilde that maximizes this expression. What if now there's a transaction happening in private currency, so DM? Now it's the firm choosing both price and private monetary policy. And they're both also the recipient of income, of revenues, and of the seigniorage tax, if you want. And so what they're maximizing is, they're maximizing their profits with respect to the seigniorage adjusted price. So the price that is being paid by consumers once, and another tau times in terms of the seigniorage tax. And turns out it's the same P tilde that maximizes this, yeah? So with firm G, what we have is, they just take this tax as given, they set price P tilde. With firm F, who engages in private currency transactions, what they will do is, well, they set the same price for the full seigniorage adjusted, consumption tax adjusted price. And so in other words, what they do is, they opt to remove the seigniorage tax on private currencies. And the intuition is the following. If you set a profit maximizing price, then you do not want to set a tax on top of that, because that effectively makes your price too high. And so you remove the seigniorage tax, you fully internalize the effect of the tax on your profits. And there's actually many ways you can remove the seigniorage tax, and that's something called currency design equivalence. You can implement the Friedman rules, or something like zero interest rate, a constant decrease in the money supply. You could give price discounts if actually the money supply is growing, or you could pay interest on money if you want to do that. What happens to central banks? Well, consumers, producer and currency choice, they do choose which currency, which firm to visit, and thus also which currency to use. It induces currency competition. And now with that previous proposition, if actually the seigniorage tax of the government is strictly positive, consumers prefer to use the private currency because they get these discounts. And so the only way government money can be held is, and is being valued in equilibrium, if the central bank removes their seigniorage tax, or equivalently sets the interest rate to zero, or in other words, it implements the Friedman rule itself. And we know this policy is associated with deflation. You have to reduce the money supply. And also actually this is associated with efficiency improvements, right? So this is actually second best. The only thing that remains is this market power distortion, this monopoly distortion from firms, consumers having to choose a firm in any given period. In the interest of time, I'm going to skip this, but basically I can think about, whether firms are not from digital currency areas, and there's actually some information as a negative externality because they steal your customers. Seigniorage is actually a positive externality because it disciplines the government, right? It makes the government remove their seigniorage tax, and that's also good for my competitor. But I'm going to skip that now in the interest of time. So how do I break the benchmark? One of the ways I'm breaking the benchmark is by looking at firms forming currency consortia, but they're being dominated by one firm. So in this benchmark, I was thinking about, think about big conglomerates competing, which supply the entire range of consumption goods. But now think about, consortia, which supply here 2 consumption goods, but you think there's many of them. And there's a leader and a member. And the leader of this consortium, think about Facebook and the DM consortium, they decide on private monetary policy, but both share the consortium's dividends equally. So firms actually had to pay $10 million to buy into the consortium, and then also had an equivalent share of 1 over 100 in terms of dividend claims. Now the leader trades off maximizing their own product profits, which you do as in the benchmark, but they could also implement a seigniorage tax, which would now be a seigniorage tax on the members of the consortium, right? So the total profits are the product profits. They're giving up some seigniorage tax because that goes to the member, but they're also receiving some of the seigniorage tax because the member is now being subject to DM inflation, and effectively the tax, which was previously just a tax on your own transactions, now is a tax on somebody else's. And then the result is actually that you do implement strictly positive seigniorage taxes whenever the member's transaction share exceeds the leader's transaction share. So in other words, if the consortium is sufficiently big in terms of transactions which are not being generated by the leader. And the intuition is the seigniorage tax base, not connected to your own product profits, that is large. And so that makes you want to tap into it. Yeah? You can maximize your very own product profits by setting tau equal to 0, but then you're not tapping into that seigniorage tax base generated by other firms. And so if that tax base is big, you want to tap into it and set strictly positive taxes. And I could do some comparative statics. There's actually a scenario in which now public currency disciplines private currency, because there's an upper bound which you can possibly do. Your consortium members need to want to accept your currency and not move away from the consortium and be subject to the government's tax. So there's an upper bound. And information may actually be inflationary if it leads to a relative increase in the consortium members' transaction share. So Facebook generating revenue through advertising for its other members in the consortium, that would actually be inflationary because it increases the seigniorage tax base.
Maxi, sorry, I'm jumping in just to say that you have 2 minutes left, but I see
yes,
you're
perfect.
Very close.
Yeah.
Okay.
So the literature review, I'm not gonna say an awful lot. Basically, on digital currencies, this really is exploding. But what I think I'm contributing is I want to think about firms issuing currency, and that competes with government money. And so that's kind of new, because otherwise firms just issue money in isolation, and there's some demand for it, and it doesn't compete with government money, or it's just it's Bitcoin and other cryptocurrencies, for example, competing with government fiat money or bank deposits. And I think about information and private currency market power, and so that's what I'm bringing to the table. A very quick discussion. So the central bank, so this benchmark result is a no seigniorage result. So firms remove their seigniorage tax, so the central bank is also forced to remove the seigniorage tax. But instead of setting zero interest rates, you could also pay interest on CBDC, and that would equivalently remove the seigniorage. And so that might be a role for CBDC. And beyond that, you can expand the model and have credit card companies which charge transaction fees, or you can introduce banks which have, there's deposits, they might pay interest, but it's still dominated by bonds in terms of interest payments. The no seigniorage result would also apply to them. So the paper also speaks to the CBDC bank disintermediation literature, which is very big as well now. Okay, so contribution. I'm thinking about firms issuing money, competing with government currency. Information breaks the usual indeterminacy, which is present in other models of currency competition. And in the benchmark, the central bank loses policy autonomy, but maybe there's a role for CBDC, moving around the interest rate, but not generating any seigniorage. So it's more a no seigniorage result. And private currency market power, I've showed you one way, it induces inflationary pressures. So maybe Facebook actually wouldn't have been the worst outcome for central banks in terms of policy autonomy as issuer of private money. Okay, that's it from me. Thank you very much.
Thank you very much. Thanks a lot. So your paper will be discussed by Tai-Wei Hu from the University of
Yes.
You have the floor, Tai-Wei.
Thank you. Okay. Okay, thank you very much for having the opportunity to discuss this paper, Money Talks by Maxi. Sorry. My name is Tai-Wei. Right, so let me begin with what the paper does. What's very interesting about this paper, as a monetary theorist, it talks about two kind of biggest nightmare we had. These big tech giants, they know everything about us, but now they also control money. So that's sort of what this paper is really about. It's really about firms that can issue money, but also can somehow collect information. It's built in an old traditional model with overlapping generations. And the key trade-off Maxi has been focused upon is a trade-off between seigniorage revenue and market share. Given these are sort of these two biggest nightmares, you feel there shouldn't be anything good out of it. But very surprisingly, the result says these will disappoint the central bank to do something that we all monetary theories say the central bank should do, but they never do, namely implementing the Freeman rule. So we'll talk about that actually, having Amazon or having Facebook and control the Fed. It's a cool idea. But the basic idea is that these firms are going to have incentive to make their money cheap to hold in the sense of opportunity cost. And as long as central banks still want their banknotes to be valued, they have to follow suit. Otherwise, rate of return equality will kill their money to be held. Second thing that has been kind of interesting from the paper is talking about the first mover advantage in issuing currency. So when I first look at the paper, it's super cool. You kind of get everything you want, talk about very trendy thing. But for the rest of the discussion, we'll talk about, as a theory paper, the kind of assumptions you would need and what's the underlying sort of structure that give you kind of the result, and maybe think about sort of how should they predict a multi-universe, or how that related to the universe we live in right now. So the model, it's a very stylized model, having 3 generations in each, 3 periods for each generation, young, adult, and old. And one thing that's quite interesting to talk about its role later on is that it has quasi-linear preferences. Called the Maxi allows a very popular model by Lagos and Wright. And there are actually 2 goods in the model. There's a credit good, there's a money good. And there are 2 firms. Actually, I have a question about what it's called F and G, I guess it's Facebook and Google. But and the underlying assumption that they can issue currency is a question mark. We talk about who can actually issue the currency. And more importantly, they supply the goods to the consumer, and they can choose which currency they have to use to buy their own goods. And that's going to be a crucial assumption to get the fancy result we see earlier. And there's a nominal bond and currency in the background, of course, the dollar. So one key sort of element in this paper is scenario revenue. And one thing interesting is that in the model, the assumption is that firms actually required to hold bond when they issue their currency. And think about the seniorage revenue they get, that they're holding bond, which pay a higher interest rate. While when they issue currency, they usually don't pay interest. We'll talk about that later. And the difference will be what we call, or what Maxi calls seniorage revenue. But one thing that the repo into mind, it doesn't seem that different from the bank. They collect your money and they lend to others and they take the difference. We'll talk a little bit about whether this is exactly inside, outside money. And one thing that comes to a monetary theorist like me is, do we have a quantity theory of money, and how should we think about this? And as I mentioned, this current formulation feels more like depositing money. And why this will be important and interesting is a question that Max actually addressed a little bit in the second part, where the currency actually circulates. In his current formulation, the currency doesn't really circulate, but you just go and adopt the company's currency and buy it, and that's it. So that's very important for these results. So let me say a few words about information. So when I come to paper, I had in mind that, it's like Amazon going to know all my transaction habits and get to me and give me a really bad price because of that, but that's not exactly what's going on in this model. Here, what's going on is that because the way that the CRA utility is set up, the monopoly pricing actually is independent of the type. Instead, information is such that, as Maxi emphasized on the advertising part, that I'm allowed to get a bigger market share if I have a better sort of a better currency. There's also a symmetry between these 2 firms. And in the formulation, the paper is not super clear about this. It seems that only F can issue a currency. In the appendix, talk about how to think about really currency competition. But that part, it's really important, but it's not so much discussed. And my intuition is that it will be really useful to have a level ground for the 2 firms and think about how this can work. And related to that, the underlying assumption, because directly search, is that firm can charge monopoly price, which drives the intuition that they actually don't want seniority revenue because they can get all the surplus essentially without price discrimination. They cannot do. But if there is an oligopoly that they actually compete on prices, a lot of results will be more like what the second part will be. So here are my comments. I really like the idea. I think it's really cool. but the formalism, I think, somehow is not the best way it can be written. One thing I think is an important issue as mentioned is the decision to introduce a private currency. And sort of one thing that's sort of related to model and related to how we should think about these technical giants, should we think about this as some firm can really control, like you buy everything from Amazon. Lucky we're not in that world yet, as much as my wife buying from them. But when you think about a world where different firms have sort of different local power, even to some extent monopolistic competition power, this kind of thing will be slightly different. And the other thing I think will be very important for this work especially is instead of doing some sort of steady state analysis with quasi-linearity is more or less a set, but really looking at transition dynamics when you have these giants introduce currency, what will happen, people may speculate, and so on and so forth. In terms of welfare, as mentioned, the firm that can actually issue the private currency will implement the Freeman rule. And this seems a good idea, but there are sort of two big issues. One is that there is a need of lump sum taxes, and of course when you look at the real world, by the way, this assumption, this result really tie with the assumption that you can buy from these guys only. And again, if you think about whether there are many suppliers and so on, and you want currency for many other things, the result will be much qualified. And the second thing that is very important, as mentioned a couple of times, the monopoly power is very important. And it seemed to me, if I'm a regulator, the first order thing is try to get away with the monopoly power than think about currency. But that's sort of an important trade-off that the paper is fairly silent about. This is a little niche, but it's actually important for the result. I'm say a few words about these assumptions. So the ECRA utility, but make a lot of interesting issues disappear. Think about screening different consumers and how firms may exploit consumers. That tension is not really there. And the other thing would be really cool, I feel, is to think about distribution of money holdings, which a lot of people try to do. And thanks to the quasi-linearity kill all this interesting thing. And the insight we have from the literature is that we like OLG model because we don't really need Lagos-like quasi-linearity. But the paper kind of wear the two, and you feel, why do you want to do that? You kind of want to relax and allow you to say more things that exploit more the simple thing with the OLG structure. Now, one thing I do want to say, and think it's more of a controversial critique for this paper, is that when we think about these giants, you think about WeChat, you think about Facebook, they don't exactly sell things directly, rather they provide a platform for people to transact with one another. Now, Brinner's more like the typical model we see in monetary theory with random matching and importantly bargaining. And I somehow feel for this paper sort of to think a little more, to expand, it has to take that into account and think about not sort of just buying from the firm and that is this nice but simple result that I don't want to tax you because I want to buy from me. Is it just to think about I allow a platform to have monopoly over the platform, and that's going to be, I think, much more interesting. But maybe I'm asking for another paper, so I'm not sure this is too useful. But this incentive for firms will be very different. And one last thing I want to say, is that this paper is probably sold as a solution to the indeterminacy we know a long time ago was in Krenken and Wallace, but it might be sort of useful to have more micro-funded model, like what Max is talking about in the end, where people have a little more freedom to choose what they want or why they have to use specific kind of currency, not using all other instruments that are actually available in the real world. So a little bit more endogeneity than sort of the old school CIA restriction. And another thing that the recent first literature on digital currency, a lot of them have been talking about the idea of bubbles, especially speculative trade. Just mention one example by John Rosito, who talked about actually the competition of different platforms. And that could be cool to put information into that discussion. Let me conclude, it's a very nice idea. It's a new angle to look at currency competition with a new trade-off, but hopefully Maxi can get a little more general and clean results. I will stop there.
Thank you, Taiwei. Maybe, Maxi, you want to respond? Let's thank for now both of them. And then I think, Maxi, maybe you want to respond for just a couple of minutes. And then we'll take
Yes.
a few questions from the floor.
Yes, I'm happy to do that. First of all, thank you so much for the discussion. That was fantastic. I think so. I can say a few things. So first of all, I think what he's really given is a lot of suggestions for other papers. I mean, I'm already doing a monetary model with firms issuing money, and then the idea being here that information is used against other firms in this advertising game, basically, that makes you steal market share. And I think that's already quite a lot, if not maybe even a little bit too much. And so by looking at some of these other things which you suggested, which are super interesting, for example, price discrimination, which would also break the benchmark, I think that would be super interesting, but maybe not in this paper. So I think this is really inspiring for other things to be thinking about in the future. I agree with you. I mean, maybe a few things I need to do and make it a little bit clearer. So it doesn't actually matter whether firms back their money with bonds or not and contain interest, or whether they just issue money. I mean, so they just issue money, and that's kind of in the background. I agree. It's somewhere in the appendix how exactly the money growth manifests itself in a higher seniorage tax. Yeah, I mean, both firms here can issue private digital currency. I mean, I'm not restricting that, and it's in a simultaneous choice game, but there's a first mover advantage because of this positive seniorage externality, this disciplining of the government. And that's why you may get equilibria in which potentially, you have one firm issuing money and getting the information and the seniorage, and the other firm only getting the seniorage gain. And so that's a first mover advantage. Facebook not actually selling any goods. I fully agree with you. And that's why I have this extension, breaking the benchmark. And Facebook not selling any goods is nested in that. And it's actually a particular, so it corresponds to a particular transaction share associated with this consortium leader, and that is 0. And so it's actually nested in that benchmark. And I fully agree with you. And that's kind of why I said at the end, maybe Facebook issuing money in terms of central bank policy autonomy was not such bad news for central banks, because effectively that would be exactly what allows them to maintain their central bank policy autonomy. And I agree with you that this Friedman rule result, you need imperfect competition, so you need market power on firm side, and which obviously is a distortion in terms of welfare. And so you're completely right to point out that you get this result because firms have to make profits and extract rents. So thank you for that.
Thank you very much, and thanks for the response. Do we have some questions from the floor? So let's start maybe with you back there, and then I'll ask Reese. Thank you.
Thank you very much, and for the presentation. My question is regarding the fundamental motivation of the paper. You seem to be presenting private money as if it were something new. Obviously, today, most transactions are conducted in private money, which is bank money. So I think you need to distinguish what would really make firm money, and I think it was in your response to the comment made, what is really different about firm-issued, non-bank issued money and bank money. And for me, that is quite critical, because we do live in a world today where all transactions are effectively bank-based and not central bank money-based. That, I think, is the key point. Then, how is money being issued? Again, you said it's somewhere in the appendix, but I think it's key typically money is going to be issued against something where, you know, a type of money market type arrangement or stable fund type, you know, stable coin type arrangement. Again, there is no money creation, it's just a substitution of monetary aggregates effectively. And I think that also needs to be part of your story. And then on the information content, if it were so valuable to have that information, today Amazon knows, of course, what it is being paid, for example. But if it were so valuable, well, then they could purchase that information from the card networks or from the banks. If they're not doing it, it's either because the information is actually not that valuable, but I think you need to discuss it a little bit more. What makes it so attractive for non-banks to issue their own settlement medium effectively? Thank you.
Okay, thank you very much for these. Let me take them. Bank versus non-bank money. I mean, the difference is with these non-banks, these consumption producers, they want to sell you goods. And so banks don't want to sell you goods. They want to sell you deposits. So like a payment technology, if you want. And then you know that they take some seigniorage out of it for that, right? Because you don't get full interest payments on your deposits, but they're actually dominated by other assets of similar maturity that you cannot use in payments. And that's really what makes it special and what generates this result. It's that you're dealing with a producer of consumption goods that now also issues money. And that really is the fundamental difference. How money is being issued, it's being issued just like in all these other Lagos-Wrighty models in a lump sum manner, in, you know, just being thrown into some consumer's budget constraint, and then you decide on how much you're going to want to throw around, and everybody meets in these Walrasian markets and, you know, decides how much money to hold, and firms basically decide how much money to issue, and that will determine, you know, the money growth rate, and thus also the seigniorage tax effectively. So I'm not doing anything special on that dimension. It's just like in all of these other monetary models where the government drops it lump sum. But yeah. So the last question on information, I couldn't hear all of it. The middle bit I couldn't quite hear. But could you quickly repeat that for me, please?
No, it simply meant, I meant to say, if the information were that valuable, and therefore it is attractive for non-banks to issue their own monies, why are they not purchasing that information today from the banks or the card networks? And then Amazon, of course, already knows what information, what payments is being made for its goods, so it already has a lot of information there.
Okay, so that's a super interesting point. They do purchase this information, right? Google buys information from MasterCard. Your brick and mortar stores purchases like crazy, like loads of amounts. And so they're already purchasing this data. And so I agree with you that you can potentially also purchase this that way. And so I agree with your criticism. I'm kind of taking it as given that suddenly, so I started working on this in 2019 when Mark Zuckerberg was doing the rounds at the central banks, and we suddenly had this private money and people were worried about it. So I kind of took that as given that, you know, that is something we're competing with, issued by a firm that generates information, maybe now also in payments. I mean, we have to say, okay, why can't I just, you know, just completely buy that information purely from some intermediaries? I mean, that's a very good question. I do believe that Facebook and other firms have other reasons, network effects, to tie in people that makes them attractive to them to issue their own money. But yeah, I mean, that's a very good criticism. Thank you.
Thank you. And so thank you, Maxi and Taiwei. In the interest of time, well, thank you. And we'll call on stage our next two speakers and discussant. So Marco Pinchetti from the Bank of England, who will present the open economy macroeconomics of central bank digital currencies, and Tim Jackson from University of Liverpool, who will be his discussant. So Marco, please, the floor is yours.
Thanks a lot, Francesca. It's really an honor to be here, and thanks a lot for accepting our paper and inviting us to present. This is a joint paper with Michael, who is at the Bank of England as well, and Marco, I'm at the Bank of England as well. Pulcha is at BIS, and Andre is a former ECB and Bank of England colleague who passed to the dark side, unfortunately. As many of us are affiliated to international institutions, it's my duty to remind that the views that we express in this paper are solely our opinion. They do not represent the views of the NPC or the bank. And in particular, I would like to stress here that this work has nothing to do with the CBDC consultation paper that the bank is going to release in September. It's a completely different thing, and in case there is somebody from the press in the room, just for you to know that this is a workflow which has just completely separate from that one. Currently, many central banks are investigating the option to issue a central bank digital currencies. And essentially, all central banks in developed countries are doing that. There is progressively a rising amount of research works that are trying to investigating the benefits and the risks of central bank digital currencies, and the literature is progressively converging towards the idea that central bank digital currencies are welfare improving in closed economy. However, the open economy aspects of CBDCs are not yet well explored, and this paper tries to fill this gap. So what we do in the paper is essentially two things. First, we study the role of CBDCs in open economy, and second, we evaluate the trade-off between open economy risks and benefits. Before starting and repeating this acronym 1 million of times, let's agree on the idea of what is a CBDC, given that the concept might not be so familiar to many of you. So central bank digital currencies are a new asset class and a means of payment which provides access to the central bank's balance sheet. It's available to anyone in the economy. It is hence universal, available to banks, firms, and households. It is denominated in national currencies. It is issued by the central bank and remunerated at a certain interest rate, and coexist with the current banking system and competes with bank deposits. That's how we interpret it in our model. Obviously, there are several design hypotheses under study, so other works might make several different assumptions. That's the sort of things that we have in mind here in this paper. So the closed economy aspect, as I previously mentioned, I've been studied extensively by the previous literature. CBDCs give lower transaction costs. They endow the economy, the central bank, with an additional stabilization tool in some setups, which is represented by the CBDC interest rate. But the open economy aspects are yet to be studied and discussed. So certainly there is a huge potential for this means of payment to reduce international cross-border payments, and this statement is validated by the fact, well, it's accompanied by the evidence that cross-border fees are currently much higher than domestic fees, and according to the World Bank, they are between 4% and 8% currently. This data refers to remittances, so a particular kind of payment, but certainly I don't think it's questionable that they are more expensive than domestic transactions. And in terms of policy concerns, the idea is that the introduction of CBDCs is certainly welfare improving on the payment efficiency side, but can be accompanied by risk to volatility of foreign exchanges and capital flows. And in the survey of the BIS, which interviewed several central bank officials, it turned out that effectively these concerns are present and at this kind of level. So it's policy-wise an important topic. So what do we do in the paper? First we study the transition of a non-CBDC economy to a CBDC economy. Second, we analyze the open economy properties of CBDCs in terms of macro volatility. So we analyze what is the volatility of standard macro aggregates in presence of a CBDC. And we analyze essentially the role of CBDCs in terms of its interaction with foreign shocks. In particular, shocks to the foreign demand of domestic liquidity. Okay, this is our model. Obviously, I'm not going to go through all the equations because we've got 20 minutes and you don't want to get bored. But essentially, the main architecture of the model is conceptually relatively simple. It's actually not, and Tim knows it, but this is how I'm going to present it. And so we have 2 countries, we have 2 households, 2 banks, and 2 central banks. Households have access to deposits and loans at their bank and at the other country's bank. In addition to that, households have access to CBDCs as an asset which serves a purpose which is comparable to the one that bank deposits serve. The model is a 2-country new Cayman, medium-scale 2-country new Cayman model with international banks, gross capital flows, liquidity frictions, and a monetary effects in determination mechanism. Essentially, a monetary effects determination mechanism means that exchange rates in this framework are not just determined by the ULP condition as we know it in the literature, but also by liquidity yields, by convenience yields. So here we have households which obtain liquidity services both from bank deposits and CBDCs, and they are imperfect substitutes. We have financial investors which they were not in the previous chart, but they do not really play a role. They're just like a modeling device to make the market work in this setup. And we have the government, which operates a standard and fiscal monetary policy, and importantly, in addition to that, a CBDC monetary policy. So the government here issues central bank digital currency and swaps it for government bonds, right? Right, so the effect of the introduction of a CBDC here is in some way similar to a quantitative easing, to the extent whereby the government buys government liabilities and exchanges it for liquidity. However, there are some features that distinguish this operation by the quantitative easing, which is essentially the policy that's underlying the CBDC interest rate. So this slide is to explain you how CBDC policy affects the economy here. So we have essentially 2 policy rates, the interest rate on CBDC, which is the lowest, and the policy rate, the standard policy rate. These are the steady state values. So in the model, the monetary authorities are moving not 1, but 2 rates, this one and this one. And therefore, by moving these 2 rates, they will shift all the retail and wholesale banking rate that we have in the model in different directions. So in a way, we can interpret this style of management of monetary policy as a corridor system. So how CBDC works in the model in terms of sheer modeling. So the main friction of the model is a liquidity tax, as in Schmidt-Groh and Uribe. And essentially, this means that agents have to pay a tax every time the consumer invests. And this tax has similar effects to a consumption tax. So every time I purchase a good, I will pay a certain amount in a liquidity tax. This is to proxy the transaction costs that we have every day in standard business activities. And the liquidity tax depends on the transaction cost technology, which is S. The transaction cost technology, in turn, depends by the amount of liquidity in the economy. So it's proportional to the amount of consumption and inversely proportional to the amount of liquidity in the economy. CBDC issuances, by introducing liquidity in the economy, they lower these transaction costs. So here is how, these are the 2 main equations to understand how agents hold liquidity and choose to hold liquidity in the model. So we have a first aggregator, according to which essentially agents, they obtain liquidity by combining liquidity expressed in domestic currency and liquidity in foreign currency. How do these 2 composites are formed? Here, we have this equation whereby agents, they combine bank deposits and CBDCs to obtain liquidity. Let us now pass to the applications of our model. We have 4 applications here: the transition of from a non-CBDC economy to a CBDC economy, optimal simple rules, a counterfactual studying macro volatility in a CBDC environment, and the role of CBDC in response to flight to safety shocks. So here we're going to study the issuance of a retail CBDC, equivalent to the 30% of GDP. The mechanism, for those who know the paper, is similar to Verdier and Kumov, 2021. Essentially, the issuance of CBDC lowers interest rates, lowers the liquidity tax, and therefore increases GDP and efficiency in the economy. In addition, here we study the effect on the exchange rate, and here the main insight is that excess supply of domestic currency, which occurs via the CBDC issuance, depreciates the real exchange rate. Right. So what we observe here is that the CBDC to GDP ratio, so here we have two lines. We have the red line, which is essentially the steady state value after the transition, and the blue line, which is the transition dynamics from the non-CBDC economy to the CBDC economy. So we have here that the government, by issuing CBDC, lowers the defaultable stock, the stock of defaultable debt, increases GDP, inflation doesn't change, it's steady state, and we have lower interest rate in steady state. In particular, when we go to analyze the open economy, the important item here is the real exchange rate. It's another insight which we derive from this model. The exchange rate here is expressed in terms of positive value, it's a depreciation, and we have that this extension of credit and this increase of money supply in the economy implies a depreciation of the real exchange rate of the domestic country of the issuer. In the second part of our analysis, we analyze three main questions. So first, we analyze whether it is optimal to use CBDC rules to stabilize the economy, whether how should policymakers combine the use of standard monetary policy and CBDC tools, and whether it is better to operate a CBDC quantity rule or a CBDC interest rate rule. We do this with a search grid, trying to investigate the shape of the welfare function. Here we have, on the left-hand side, the response of the CBDC rule to the amount of credit in the economy. So in this class of model, we have money creation via the central bank and also via bank loans. So essentially, in this economy, it is optimal to target the amount of credit generated by the banking sector in the economy. Obviously, we should expand on this, but there's not much time to expand on this. 5 minutes, right, perfect. And here we've got, so on the left-hand side, the response of the CBDC rule. On the right-hand side, the response of the standard Taylor rule. This is the welfare level. And we see that effectively it is optimal to combine these two instruments, to use these two instruments to stabilize the economy jointly. We also study an interest rate rule, and we also observe that using an interest rate rule delivers a higher amount of welfare in this economy. So we've answered now our three questions. Is it optimal to use CBDC rules to stabilize the economy? Yes, it is. CBDC standard monetary policy and CBDC policy are complement, and the CBDC interest rate delivers a higher welfare level. So third exercise that we do a counterfactual. What we do here is estimating a version of our model without a CBDC. So we follow the Bayesian methodology widely used in the literature by papers like Smets and Waters or Cristiano Motta Rostagno. And we estimate the model without CBDCs on a classical standard US macro series from 1990 to 2019. Once we have recovered the parameters of the economy, we introduce CBDC and we study how the shocks behave. So here we should expand on this part. For now, I just have let's say a preview, whereby we study the fluctuation of the economy in presence of this additional stabilization tool. We see that when CBDC is managed via a countercyclical policy rule, output volatility declines, inflation volatility declines. lending spreads, they increase because the CBDC rule, what it does is exactly moving the spreads up and down to stabilize the economy. Credit to GDP stabilizes and the exchange rate as well. So we have that essentially the introduction of CBDC here does not just stabilize the domestic variables, but also the open economy variables. Final exercise, we study a flight to safety shock. What is a flight to safety shock? It's a shock to the demand, to the foreign demand of liquidity denominated in domestic currency. So not just to CBDC, but also to bank deposits and CBDC of a certain economy. And here, effectively, it's a shock to the portfolio preferences. The two functions, the only two equations I showed you before, we have this S, and this essentially this means that agents will move their liquidity from one country's deposits and CBDCs to the other country's deposits and CBDCs. Right. What we attain here is that in absence of CBDCs, the economy is subject to large fluctuations. So we have large fluctuation in GDP, in inflation, and the other macro variable. In presence of CBDCs, this volatility is reduced. In particular, it is reduced, so in the red scenario, whereby the CBDC interest rate is fixed, while when with the green solid line with black markers, we have that the results are mixed, and there is a trade-off between stabilizing the closed economy dimension and stabilizing the open economy dimension. So this is the optimal rule. So it's not necessarily optimal for a given shock, but it is optimal consider the volatility of all the shocks. So to conclude, and I hope I was on time, we have studied the role of CBDCs in open economy within a rich model with banking and liquidity frictions. We've shown that as in closed economy, CBDC issuances lower interest rates, they lower liquidity taxes, they provide a central bank with another policy instrument, and they make bank deposits less volatile. Something I didn't touch on the presentation, but I wanted it to be in these messages is that the presence of CBDCs contributes to insulating the economy from foreign shocks, and that is because essentially foreign shocks to the demand of domestic liquidity, they are partially absorbed by the banking sector, but partially absorbed by CBDC. Therefore, in this setup, the bank deposits are less volatile. We observe that in the transition, after the transition, exchange rate volatility is lower, and in terms of policy insights, interest rate rules are preferable to quantity rules, and standard monetary policy and CBDC are complement. And that's all. Thank you. I have to apologize with him because I sent him a version of the paper which was really preliminary, so I perhaps will be on different pages. But
I was about to say, yeah, it's a new challenge trying to discuss a paper. The version I had was a bit older, and so the estimation, the optimal policy, that was new for me as well. So I will try and react to that. Right, okay, well, yeah, so obviously it's an important topic, central bank digital currencies are kind of big, and obviously this, the open economy aspect is something that hasn't been studied as much. Clicking. There we go. So yeah, what they do, it is a big model, it's a complex model. We have these kind of two countries, financial frictions, and the key thing here is this, the cross-border flows. We can actually look at those, kind of how these flows are going, which is a much touted advantage of CBDCs. It's kind of break this monopoly of cross-country transactions. So yeah, the big thing here, which is something that is relatively less studied, is that households can both hold home CBDCs and foreign CBDCs. So they really can hold both, so it's easier to transact. They also have CBDCs as a substitute for deposits. Obviously, we know that's something that we study, but in some of the other open economy CBDC literature, that doesn't happen. Don't we have banks in here? So we have, in this paper, we have both banks who are kind of intermediating, but also this open economy measure. Yeah, the banks can lend at home, they can lend abroad, and to each other. So this is obviously constrained by regulation. They have to put kind of some fairly tight rules on these, which I have some issues with. But the main thing is this diagram again, it's a complicated model. There's a lot going on. There are banks doing these 3 different things. We have CBDCs with households. It's good to be able to consider all these complex dynamics, but again, one of my kind of criticisms, I guess, of the paper is there is a bit of black boxiness effect to this. If you throw too much in a model, it's a bit hard to see exactly what's going on. Okay, so one of the key results, so basically I'm going to present the results that I've seen. One of the key results that I think they say is that the CBDC it reduces the investment volatility for a capital inflow. So that's this idea that if you're getting kind of money coming into your economy, the fact that you have CBDCs is an extra instrument to be able to kind of balance that flow. So it's kind of the opposite of what we worry about, which is that you can get these flight out of countries. They're saying that when you have CBDCs coming in, we can get CBDCs, the policy allows it to absorb the shock. So on investment, we can see that, let me get the way around, black is with CBDC, red is without. And what's happening here is that when there's a capital inflow, the ability for CBDCs to kind of cushion the blow, that's this difference here. And so that's better. What's kind of odd is that the expansion changes to a contraction. There's this huge change, a very strong change in what's happening. So rather than a capital inflow leading to an increase in GDP is what we'd expect, we actually get a decrease. And I think they say in the paper that this is due to the version that I saw, I'm sure it's better explained now, but it was due to a kind of relative an appreciation. But it needed better explanation as to exactly why. I mean, I get this thing, that there's some intuition there, but why it should shift quite so much from an expansion to a contraction, again, I'm only talking about the version of the paper I saw, it wasn't really explained. So that was something that just struck me as a huge difference. Now the way that CBDC is introduced is very similar to the previous paper, this Bardi and Krumov paper, and it strikes me, rather so much as an introduction of CBDC or new technology, it's really a monetary stimulus. You've got a load of new money that you've issued. It's being used to buy back government debt. So government debt we can hold all this government debt. The central bank is then earning a spread because it's issued these CBDCs. It's getting paying a return on those, which is lower than the return it's getting from all this government debt. It gets the spread. It can then rebate them to the government. So the central bank is earning a spread. Now that's how CBDC is introduced, and it's a huge one. 30% of GDP is big, right? So the implication of this is we get long-run GDP increasing by 3%. Welfare was still being calculated when I got it. I'm assuming it's going to be a good thing. Increasing long-run GDP sounds like it would be good for welfare. But my question with this is this really a benefit of CBDC, or is this just for saying, hey, monetary expansion is really good in this model? We've got monetary expansions are great. If we have, in this particular model, we have non-neutrality. Therefore, are we really testing CBDC, or will we get the same results with the reserve-funded expansion? I think that's the true test here, really. Rather than if we have a benchmark of rather than no expansion versus CBDC expansion, how about CBDC expansion versus reserve expansion? What's the difference? Shameless self-advertising, we get equivalents in our model. So in the model that we have, we actually say they're exactly the same. We get kind of outputs. We basically do QE with reserves versus QE versus CBDC, and we basically get, it's kind of a boring result in this paper, that they're exactly the same. You get aggregate exactly the kind of equivalents. There are some little interesting bits that might be different, but in general we get equivalents. So I'm assuming you wouldn't get equivalents in this model. I'm assuming that there will be some reason that you wouldn't have this, but I think that's the right benchmark, rather than no CBDC versus CBDC, reserves versus CBDCs. I'm assuming that you've got this, that the CBDC rate is lower than the reserve rate. That means that the central bank is making more profits because it's issuing CBDCs and earning bonds, and if it's paying higher rate to reserves than CBDCs, the profit it's getting from this purchase is higher, so I'm assuming that it will work better. But yeah, I think showing that would be really help a lot. This one, again, slightly different. They've got this rule. Again, in the version I had, the paper was just implemented. Now they've done a bit more work on kind of playing with the parameters to look at optimal policy. So yeah, it was a kind of feeling of why did this, so you've done work on the changing the parameters, which is great, that's kind of the first step. I guess I wondered why these particular rules, they feel a bit out of the hat, like why exactly? And yeah, I guess the thing I really want to see is the actual optimal policy, the full, not just optimal simple rules, the full Ramsey problem, what is the optimal policy to do? Just as a benchmark, what is the optimal? I feel that's, every referee is going to say that, like when you've got all these kind of complicated universes of rules, what's the optimal thing to do? Okay. I got nothing. It's stuck. Oh, there we go. Okay, next point was that households love central bank digital currencies in this model. They really love them. So we saw that the convenience yield on CBDC is 50 basis points over deposits, which is big. It's kind of parameterized, it's built into this model due to the preferences. But, I mean, obviously there's no data on this really. We don't really have seen CBDCs, but 50% deposit spread is, I mean, I'm going to keep my money in deposits if I'm going to earn 50% more, 50 basis points over CBDC. And moreover, households are happy to hold a lot of this. So 30% of GDP has been issued as CBDCs at an adverse spread of 50 basis points, and yet households are happy to hold it. It's built into the model due to the preferences, but that was a bit of one, I wanted to kind of question that one. It was really like, really, would households be happy to hold this much CBDC? There's this kind of assumption that it can be issued and just held, but I think that needs a bit more justification. Why is CBDC so much better than deposits in this model that the central bank can happily issue 30% of GDP at an adverse spread and still be able to be held? So I think that's important because if the welfare results depend on that, I think that's the issue. What happens if they were perfectly substitutable? If you had deposits and CBDCs being kind of equal, does the central bank still earn a sufficient spread to generate the welfare gains? I'd like to see that. Finally, and this is kind of a general point, I'd really like to know which aspect of the model gives rise to the results. I know we've got a big complicated model, lots of frictions, and I get why we have all these frictions. We want to be kind of accurate to the data. We want to see kind of all these kind of complexity. But what we're really good is to turn them all off and then turn them on one by one. Then I can see what's happening. If you could turn them all off and then reintroduce them individually, then we can see where it's coming from. So always in these papers, I'd like to see like what happens if you start with in the RBC, presumably nothing's going to happen. We've got money neutrality. We have if we just have price rigidity, we've got a new K model. Do you get a new Keynesian model? Do we get the same results? Which bits of it, which of these parts, how much of this can I get rid of and still get some of the results? And some kind of decomposition, it would just, when you've got a model this complicated, I think that's the way to do it. You have a simple version, then you build it up and you can show the difference. Personally, that's just how I like to read a paper, but that maybe other people like their big models. Model validation, I think you've done that now, you've done estimation. So again, in the version I had, it was just parameterization, but I think that seems to be, you've dealt with that one. Some of these equivalences, you've done monetary policy, so obviously you can deal with that. Yeah, it was just, why is CBDC resistance not more inflationary? Obviously, you've got a new Keynesian model, so inflation in the steady state is still kind of fixed, but it felt like if you were issuing 30% of new money, I would expect to see a lot more inflation. And so I kind of wondered why you've got that, why we're not getting Ricardian equivalents. I'm assuming it's because of some of the assumptions, but I just kind of wanted that spelled out. That's me done. Okay, that's done.
So before we take questions, maybe you can take 2 minutes to answer just briefly, and so that then we can still collect some questions, Marco.
Sure. Thanks a lot, Tim. This was a tremendous discussion, and from probably the right person to get it from, given that you're really working in this field. I have to say that I really appreciated the spirit of your discussion, and many points are really well taken. It's great that you showed that the equivalence results, so we don't have to do it. And the Taylor rule is essentially an average inflation targeting rule, but we have now switched to a more traditional sort of setup. And in terms of why, you mentioned so many points. I spent 1 hour tackling all of that, but just let me say thank you. But let me say, I wanted to ask you, why it's not inflationary? Yeah, it's like in the model, like in the steady state, it's not inflationary because of the central bank targeting, a certain level of inflation, and therefore, the steady state of the model is pinned down by the target, and then in the transition there is the action of monetary policy which stabilizes that. So it's like, obviously, if this was an helicopter drop, this would be very inflationary, but like this is a sort of a balanced transition. So there is like the effect of monetary policy, of why is monetary policy counterbalancing the money issuance? So it's sort of a sterilized operation. Okay. That's the answer.
All right, then maybe we can take some questions from the floor. Okay, David, please.
Thank you. Very interesting presentation. I also thought the discussant was really, really good. Made a lot of good points. And I wanted to react to one of the comments you got in the discussion, which is around this idea that you could use CBDC as an additional instrument to deal with an investment boom. And I had a similar reaction to what you said, Tim, which is around, there's also kind of macro-prudential policies that people think about as dealing with that sort of problem. I'd call them capital flow management policies, where you may try and charge a different interest rate on capital inflows that are held in your domestic banking system. So again, I guess it's a question about what the right benchmark is that you're comparing the introduction of CBDC to, and should macro-pru be part of that benchmark policy?
Thanks, David. It was certainly a great question. We didn't think of introducing a macroprudential policy, but it's definitely a very important tool. That's what we currently do in central banks to manage this kind of phenomenon. But we know that policies are often can complement each other, and therefore, hopefully, So I'm not sure. I'm not sure why these two policies should have different effects, and whether they should be complements or substitutes. And it's an important and interesting question that deserves to be investigated in further works rather than answered on the tip of the tongue. How do you say? So yeah. So.
Thanks. I see a lot of our questions popping up. So Alexander, maybe first, and then thank you.
Another thing that came up in the discussion was this similarity between QE and CBDC in your model and how you implement it. Could you tell us a bit more about how they are similar and how they're different?
Right, so they're different in a way that QE is a temporary operation, the CBDC issuance is a permanent operation, and QE is not sterilized by the operation of in the transition by the interest rate, and therefore it's uncontroversially inflationary, while the CBDC issuance can be compensated, as we've seen at least in our simulations. It can be compensated by some interest rate response and some CBDC rule response, and therefore the inflationary effects of the transition can be smoothed out in this sense. But they are similar in the way this operation is conducted, in the sense that effectively what the central bank is doing in the model is purchasing government bonds, and that's why they are similar. Certainly, other authors have explored different options whereby CBDCs they purchase cash or bank deposits, but this is what we do, and yeah, there are good reasons why we do it, but yeah, maybe we can discuss this.
Yes, I think we have another question, please.
Thank you very much. Look, I think I've been involved in the most important CBDC projects at the moment, and I'm surprised the way you set this up. I mean, the fact is, we try to avoid in every project precisely that CBDC is not seen as a substitute for bank deposit, and there's no reason why it should be. The very strong assumptions you make, particularly regarding interest rates on CBDC, is precisely what central banks are not trying to do. If you look at the e-krona in Sweden, Project Accenture is implementing, it's precisely not to impose interest rates, because we don't want these effects, right? We want it to be a transaction medium and not a store value. And I think a lot hinges in your paper on this extremely strong assumption. First of all, extremely high adoption rates, 30% of GDP, which I think is extreme. But then the interest rate. And when it comes to retail CBDC, it's mostly about zero interest rate. When it comes to wholesale CBDC, which in any ways is the more interesting bit, and you can look at Project Jura, for example, we did with the Central Bank of France and Switzerland, we concluded last year, where you have an open macro model. There the effect we're looking at is mostly efficiency gains. And I think that is where the juice is, I have to say. I think you are inflating the effect by these extreme assumptions.
Thanks for your thoughts. This was very interesting points. I think, I think that the scenario whereby there is no remuneration and the interest rate is nested into the model, but obviously most of the exercises that we do, they are within that area. And I think that you're right that many of the policy discussions are going in that direction, and it will be certainly interesting to explore those in other papers and in further research.
Great. Thank you, everybody. Thank you to all our speakers and all of you also for your questions. We now have a break. We have a 20-minute break, and we'll be back at 3:10 with the monetary policy session. So, see you soon. Thank you.
already running late. That's fine. Okay, so we'll now start the monetary policy session. There's been a small rearrangement. We're going to be starting with what is scheduled here as the third paper. So we have Vitatis Velaitis from the EUI. So you have 20 minutes, Vitatis. If you can maximize your slides, we'll get going. Thank you very much.
Thank you. Okay, can you see my slides now? Is everything okay? Can you see the slides?
Absolutely, you can go now.
Because if I do this, I cannot see what's happening in the room.
Right.
So let me start. So thanks a lot for putting our paper to the program. It's a joint work with Luke Schmidt at the University of Southern California and Alessandro Villa at the Federal Reserve Bank of Chicago. And just we need to say that what we present here is our personal views and don't represent the views of the Federal Reserve System or the Federal Reserve Bank of Chicago. So let me begin by motivating this paper. Recently, we have seen an unprecedented stimulus packages and rising levels of government debt. In addition, for example, this is due to COVID, which was the largest fiscal shock since the Second World War II. In addition to that, we are seeing supply chain shortages because of the virus and rising energy prices due to war. And because of that, debt to GDP ratios are increasing and are expected to reach 200% in the medium term. But what is more important is that in response to these shocks, inflation is now back. And so in this paper, what we ask, since inflation is back now, we ask, how should the governments optimally manage their portfolio of nominal and real bonds? And should the government actually issue more real debt? Just to give some background, what I'm talking about is what is known in the US as the Treasury Inflation Protected Securities, which are a fairly recent fiscal instrument, but has grown in some popularity over the last 20 years. And now they constitute roughly 8% of the total US debt portfolio. What we do in this paper, we develop a DSG model of optimal fiscal and monetary policy, where government optimally manages its portfolio of long-term debt in the presence of inflation concerns, where government can issue two types of long non-state contingent bonds. One is nominal, which is unprotected from inflation, and real, which is protected from inflation. And in addition to that, inflation has a real cost as prices are sticky, as is typical in standard New Keynesian models. And what do? We characterize first the optimal policy when the planner can commit to a full sequence of allocations and quantities. And second, we characterize the optimal policy without commitment. What does this mean? Well, in this setting, we assume that there's a different planner in every period, and we look for a policy such that these planners in each period behave in the same way. So what is the basic mechanism that we are after? Well, first of all, what is the nominal debt? Nominal debt is such that can be inflated away and would help the planner to relax the government budget constraint. But on the other hand, if the planner uses inflation too much, these bond prices contain inflation premium. And if inflation is used a lot, such debt becomes more expensive. On the other hand, the real debt has higher prices, which are also more stable, but at the same time, it constitutes a commitment ex post, meaning that if such debt has been issued, it cannot be inflated away, and it will not help the planner to achieve the relaxation of the liability side of the constraint. So what are the results that we find? We find that government exploits inflation fluctuations to create and uses debt portfolios to create insurance for the household sector. So we find that it manages risk by holding a leveraged portfolio. So on the one hand, it borrows in nominal debt whose prices are more volatile. At the same time, it has precautionary motives, meaning that it wants to hold assets that pay off in inflationary times. So in this way, it buys insurance from inflation. And we also find an active role for this policy over the business cycle. We find that it's optimal to rebalance portfolio towards real bonds in response to government expenditure shocks. And when we go to the problem of no commitment, there what we find is that the planner, if you consider 2 periods, planner in the last period has incentives to monetize debt ex post. But then the current government at period 0 internalizes the fact that the future planner will try to inflate away the debt. And this gets reflected in the prices that the planner at time t0 is facing. And the planner at time t0 responds to this by substituting rebalancing portfolio towards real debt. So the portfolio under no commitment is not as leveraged as under commitment. And we show that the quantities that we observe when we characterize the optimal policy under no commitment are consistent with what we observe in the US data. That's just to briefly mention the literature. We build on papers that study optimal policies with only real debt or only nominal debt. And what we do is that we believe we are the first paper that studies such a debt portfolio problem where we have a joint problem with choice between nominal and real bonds and inflation. And we also contribute to the optimal policy literature without commitment. So let me turn to the model. So the model is a fairly standard 3-line New Keynesian model where there are households that maximize utility over consumption and leisure, and what they receive is their after-tax labor income, dividends from the firms that they hold, and their wealth is held in the government bonds that are issued. So, and what do? They they consume, and they choose how much of these bonds to hold, where capital B denotes the nominal bond and lowercase b denotes the real bond, and superscript n stands for the maturity. So n equals 5 would be the bond that matures in 5 periods. And household optimality conditions pin down what is important for the planner is the bond prices, where we see that the nominal and real bond prices include the standard marginal rate of substitution between household consumption. But in addition to that, the nominal bond price includes the expectation of inflation that will accrue by the time when the bond has to mature. So in that sense, this bond is more expensive. So on the production side, there are firms that maximize future dividends, and these firms are monopolistically competitive, and they maximize dividends by choosing prices subject to the demand for the good that they produce. And in addition to that, they face quadratic Rothenberg adjustment cost, which makes it costly for the planner to use inflation. So if planner wants to use inflation, he can relax the budget constraint, but that means that the production side will incur cost in terms of this Rothenberg adjustment cost. And this together gives us the new Keynesian-Phillips curve, which controls this trade-off between the real economy summarized by wages and output and the current and future inflation. What does the government do here? Well, the government needs to finance the exogenous stream of government expenditure, and it can do so in 2 ways. It can charge distortionary labor taxes, or it can use debt policy, where it can issue both nominal and real bonds, where you can see from this inflation term here, it can also use inflation to inflate away the nominal liability. And in addition to that, we assume that there's an independent monetary authority that follows a Taylor rule, and in following the Taylor rule, it responds optimally to deviations of inflation from the steady state target level. So overall, the economy consists of what is produced using labor and some technology scaling parameter, and this is being consumed by the government, the household side, and is absorbed by the Rothenberg adjustment cost. So having presented the model, let me turn to the formulation of the Ramsey problem. So if we denote by S the government primary surpluses, which is the tax income minus government expenditure, and we substitute away bond prices and taxes, we can formulate the following government implementability constraint, which basically simply says that the surpluses need to be covered by new issuance of debts or current holdings of these bonds. And what is important here is that these prices now appear in the planner's budget implementability constraint, which means that when planner decides on the debt policy, it will internalize how it is that these debt issuances affect bond prices through household demand for these assets. So now let's turn to the optimal policy under full commitment. The objective of the planner here is to seek for stochastic sequences for inflation, taxes, both types of bonds, and allocations for consumption, leisure, and wages, such that the household lifetime utility is maximized. And what are the constraints for the planner? Well, the implementability constraint, it has to abide the new Keynesian-Phillips curve, and it has to acknowledge that the monetary authority is independent and follows the Taylor rule. So before going into quantitative results, let me cover the intuition in a 2 periods model. So what does it mean to provide insurance? Well, providing insurance means that we can create such bond portfolio that replicates a complete market's outcome, as denoted here by tilde B. And typically with non-state contingent bonds, it's hard because they're measurable with respect to T-1, but we see that inflation is measurable with respect to S time T, meaning that it is, as long as this is the case, it is possible to provide insurance by there exists some portfolio that can create insurance and replicate the complete market's outcome. So we ask, how can we exploit these fluctuations in inflation to achieve such insurance? Now let me present the intuition in a two-period version of the model that I just showed you. So there are two periods, 0 and T, and government has linear utility for consumption and quadratic utility for hours, such that the labor supply elasticity is constant. Also, for simplicity, let's assume that inflation is now exogenous and moves together with the government expenditure process. So, and then there are two states in the world, a high state and low state. And so say if if government expenditure is low, inflation would also follow and would be low in that state. And assume that initial levels for two types of bond, G and inflation, are given. So in such a setting, we can characterize the optimality conditions for bonds and labor taxes. And what this gives us is, after doing a bit of algebra, we can show that in such a world of some simplifications, but for the two states and two debt instruments, we can show that the planner is able to achieve the perfect smoothing of labor and taxes across two states, denoted by high and low, and also across time, meaning that labor and leisure are constant both across two states and across time periods. Now, if we take a government implementability constraint and substitute leisure with bonds into these equality conditions, what we get is the following. We can show that the optimal position of nominal bonds basically depends on how government expenditure moves with inflation. So say if government expenditure is high, and in such a state inflation is also higher than in the lower state, then optimal position of nominal bonds will be positive. Also, the extent, the size of this position will depend on how G moves between high and low states, as well as how inflation moves between high and low states. And what we call this a cross-state smoothing condition. Next, if we take the cross-time smoothing condition for leisure and substitute it again with nominal and real bonds, we get the position for real bond, which basically is not that neat, but it tells us that as long if nominal bonds are positive, then it's likely that the real bonds will be negative, and the position of this real bond will depend on how current inflation relates to future expected inflation. So if the future expected inflation rises, we're likely to observe less negative position of the real bond. Okay, so now let's turn to the quantitative exercise. And here what we do, basically this problem is non-trivial because we need to solve for 10 policy functions in terms of 26 state variables. And we tackle this problem by using a stochastic simulation approach where we just keep simulating the model until we achieve rational expectations equilibrium following approach by Den Haan and Marcet. And we combine this with machine learning, because since we have this many state variables, we need something more advanced than a standard regression to summarize our dynamics. Okay, so then having solved the model, let me illustrate the workings of the model with the excerpt from a simulated series. So in this exercise, we assume that there are exogenous government expenditures, a continuous process. So there are infinitely more states of the world than the number of debt instruments we have, which means that we can only approximate the complete market's allocation. So what we observe here, so in this simulation, what I wanted to show you, I took the piece of government expenditure process where it falls down for a prolonged period and then starts to go up again for a long time, so that we can see the dynamics more clearly. And then what we observe, what happens with nominal and real bonds. So blue line represents our baseline model with two types of bonds available. So when G is falling, we call it good times. So in good times, when government expenditure is low, it's optimal for the planner to build leverage. It starts to accumulate nominal bonds and also accumulates real assets. Then when the government expenditures start to rise and there's more need to finance it, what the planner can do is that it can start to resort to using inflation, and in this way it starts to inflate away the nominal liability and stops borrowing the nominal bonds, and instead it substitutes to using real bonds more actively. And so we observe that as inflation rises, we observe a fall in nominal bonds price, whereas the real bond price remains stable. So this stands in sharp contrast with the model where only nominal bonds are available, presented with the red line. In such a case, it is, in addition to Rothenberg adjustment cost, it is that in such counterfactual model, it's more costly to use inflation because the planner knows that it will still need to borrow more, but if it starts to inflate away such nominal debt, it will get reflected in its price, and the borrowing will become more costly. Whereas in our two-bond model, it does not matter because the government can just substitute away to borrowing in real bonds. Therefore, we observe that the optimal inflation is more volatile in the model with two bonds. We calibrated our model to the observed average maturity in the US data, which is 5 years. So now we ask then, what is the role of this maturity? What if government issued longer-term bonds? So what we do here is that we resolve our exactly same model under same calibration, but we assume that the maturity is now 8 periods. So what happens in such a case is that we observe that the optimal inflation volatility falls. But does it mean that the planner just doesn't use inflation with long-term bonds? No, it means that the planner's planning horizon becomes longer, and with long bonds, it becomes possible to spread inflation costs across time. That's why we observe lower inflation volatility. And since the inflation volatility is lower, the nominal and real bonds become more substitutable. So therefore, to exploit, to create insurance for the household side, the government needs to hold an even more leveraged position of these two types of debt instruments. But since the planning horizon is longer and the planner can spread the inflation cost through time, the model with longer maturities is related to higher welfare in terms of consumption equivalent. Now, for the last couple of minutes, let me talk briefly about the policies without commitment. So we observed that it's optimal to hold a highly leveraged position of two types of bonds, which is not what we observe in the data. So we asked, is there any real-world friction that allows us to understand what is happening in the data? So we study a model where there's a succession of planners, where in each period there's a new planner which optimize taking these initial conditions as given. And the planner seeks to, again, to find policies for two types of bonds, taxes, and also for a technical reason. In this model, we assume that the government expenditure is endogenous, but we calibrate the preference shock in such a way that the observed government expenditure process is the same as in the model with full commitment. And we focus on symmetric Markov perfect equilibrium. So again, take the same model as two periods model as before, but with one difference. Assume that there are two periods and two planners in period 0 and 1. Planner in period 0 chooses bonds, both real and nominal, and planner in period 1 chooses the inflation level. And then game is over. The optimality condition for inflation is the following, which tells us that the higher is the level of nominal debt, the more inflation the planner wants to use. Now, going back in time, planner in T0 internalizes the fact that by issuing more nominal bonds, it will be facing a lower price for this bond. And in doing so, this creates incentives to hold less leverage. So then when we take this our model and solve the same quantitative version of the model, but as I mentioned before, we assume that government expenditure process is endogenous, but we calibrate the underlying preference shock in such a way that the observed expenditure process is the same. And importantly, what we observe now is that without commitment, the planner holds positive amounts of both types of debt, and these amounts are similar to what is observed in the US data. So let me conclude then. What we find in this paper is that when we study the policy under full commitment, we find that it is optimal for the planner to hold leveraged portfolio of nominal and real bonds to create insurance for the household sector. And also we find an active role for policies over the business cycle, where it is optimal to rebalance your portfolio towards real debt in response to expenditure shocks. Under no commitment, we find that future governments have incentives to ex post monetize debt, but current governments internalize such future government behavior, and this gets reflected in the nominal price that the current government is facing. And in such a setting, we find that in order to reduce the ex-ante borrowing costs, that it is optimal to substitute more towards real debt, and such debt portfolio is consistent with the bonds portfolio that we observe in the US. So thank you.
Thanks, Vitalis. We might skip the question section, but we're very pleased to have Sarah Mwabi of Banque de France to give the discussion.
Sure.
Vitalis, can you see Sarah's slides?
I can.
Fantastic.
Well, thank you very much for having me here today. I really enjoyed reading this paper. In a nutshell, this paper is about optimal debt management between real and nominal bonds, so non-state contingent bonds, in the presence of inflation concerns and high debt. In this paper, the monetary authority sets short-term rates following a Taylor rule. Now, this paper is extremely topical in the current context
because it combines both of the ingredients and the concerns of the paper, a high government debt level setup, whereby the debt to GDP ratio in the US is roughly at around 140% nowadays, and a rising inflation rate, which was, last time I checked, 8.6%. And the paper is about investigating the implications of several things. So first of all, the debt instrument that is chosen, whether it is nominal or real bonds, inflation-linked bonds, TIPS, all of these are synonymous in this presentation. In the context of nominal rigidities, whereby inflation has real costs, with debt maturity, because they're introducing long-term debt, they're allowing the government to issue at longer-term maturities, accounting for the level of debt as well, whether we have a low level of debt or high level of debt. And finally, with the commitment of the government to future policies, whether the government is fully committed or not committed. So as you can see, a very rich setup. What I'll try and do is, essentially, I want to give you a little bit of the intuition of the main mechanisms of the paper. And then I'll have a few comments, but they're open questions, more philosophical in nature, not necessarily to be included or amended, but just things that are worth thinking about in the context of the existing paper. So back to basics. How does debt management work, and how does the debt accumulation process essentially work? Let me give you the process of the debt to GDP ratio. The debt to GDP ratio today is essentially the debt to GDP ratio last period minus the budget surplus as a proportion of nominal GDP. And then you essentially have the new issuances, and you get to choose as a government whether you want to issue nominal bonds or real bonds. And you can issue them at a short horizon, so 1 period bonds, or you can issue them at long horizons, H period bonds. The idea is that if you issue nominal bonds, you will notice that these are the nominal bond issuances, and you can essentially inflate away debt, meaning that as inflation rises, the level of debt, the burden of debt is lower for the government. However, this does not hold in the case of real bonds. As you can see, inflation doesn't feature here. And an additional source or a main driver of the debt to GDP ratio, which is key, is that future debt to GDP ratios are in fact affected by future values of nominal and real rates, okay, which are unknown as of today. And so this is going to be important, and I'm going to get back to that in my comments. So let me go through the main mechanisms that are prevalent throughout the paper. The main mechanisms are as follows. The government faces a trade-off between using taxes and inflation to respond to shocks, and the government will have a preference to smoothen taxes, okay? So if as a government you do not have access to real bonds, no TIPS are around, then when you want to finance expenditures, you will do it by inflating away nominal debt. Okay, so you will be seeking more inflation essentially. But this will have two caveats. It might help you with your debt burden, but on the other hand, it will decrease the value of household savings, and it will also decrease the price of future nominal bonds. So this means that the next time the government will have to raise funds, they will have to do it with a more discounted nominal bond, so they'll have to issue much more to raise a specific amount of money. Now let us introduce real bonds in the story. Now, real bonds are a real commitment. You cannot inflate debt away. Why is that? Well, they have the benefit of reducing the cost of borrowing for the government, because the real rate is going to be lower than the nominal rate. However, the government will have to compensate investors, households, in the eventuality that inflation is really high. Now, in terms of the debt maturity and the level of debt, the two mechanisms that were put in place and that were represented were that as your planning horizon is longer, you can split, you can sort of share the burden across a longer horizon, across multiple periods, and therefore you can have a lower inflation rate. So because the horizon is longer, you can buy yourself time. And as the planning horizon is longer, you can have lower inflation. Vice versa, when it comes to the level of debt, you can see higher inflation that occurs in order to decrease the large debt burden. And you can also observe a reallocation towards real bonds once the nominal bond prices are shrinking. So in order to bypass the fact that nominal bonds are heavily discounted, you shift to real bonds. And finally, there was the full commitment versus no commitment story, whereby when you're in full commitment, you exploit inflation to smooth fiscal policies, so to smooth tax. Vice versa, in a no commitment situation, the current government would decrease the borrowing costs by strategically decreasing the future government's incentive to monetize debt, to inflate away debt. Great, so these were the main mechanisms. That was it. So now my open questions. So in recent years, the fiscal authority has been somewhat reacting to the monetary policy authority. How is that so? We just came out of a period of low inflation for quite a while. This came with low interest rates, and there are arguments that explain why there were increases in debt during that period of time, but also increases in the maturity structure of debt during that time. So I'm taking just a quote from the DMO, the Debt Management Office in the UK, but I'm sure that I would have found something very similar coming from the Treasury in the US. So here they simply say that the government announced, in light of evidence of strong demand for gilts, these are the nominal bonds in the UK, and against the backdrop of historically low long-term interest rates, that they would consult the case of issuing bonds at much longer maturities. And so let me give you a snapshot. These are all of the quotes of UK bonds, nominal bonds. I did not have time to do the same for real bonds in the case of this economy, but I know that it's very similar. So as you can see, it's increased. So you have a downward trend in yields. These are across all maturities. So every date here will give you all the maturity interest rates. And you have the time to maturity on the right-hand side. And as you can see, as interest rates decrease, the time to maturity, the maturity structure of debt is rising. And this is true for most advanced economies if you exclude a few Scandinavian countries. Now the question is as follows. If inflation is rising, the central bank should act regardless of the debt structure by increasing interest rates. So the monetary authority will not have a look at the debt structure of the government in order to decide whether they have to act on inflation or not. Now this rise in rates is not reflected on past debt, so it's not harmful for the existing valuation of debt. And this is because accrued interest is based on market rates at the time of the issuance. So it's not based on market rates at every point in time. However, the indexation is based on realizations. And so given that the wedge between nominal and real rates is essentially what is known as the break-even inflation rate, then the decision of issuing tips essentially hinges on two things that are connected. I will speed up, I promise. That are connected: the accuracy of your inflation expectations and the success of the central bank in controlling future inflation. Now, The next point is that you have fiscal and monetary interactions. So essentially, by using real bonds, you render the debt more sensitive to inflation. So you're accentuating fiscal and monetary policy interactions, and this can come with complications when the central bank has other considerations beyond price stability, such as a dual mandate, as you have in the US, but even as we've seen more recently, discussions about fragmentation and possibly foregoing some of your price stability concerns over other issues. So just to give you a reminder of what happened during the zero lower bound, the central bank balance sheets grew extensively large and became very exposed to government bond prices, to government bond price changes, but not only, so predominantly nominal bonds, but also real bonds to a lesser extent. Now there's a paper by Del Negro and Sims that stipulates that the balance sheet losses could affect the central bank's ability to achieve price stability. Why is that so? Well, the value of the central bank's assets will fluctuate due to interest rates, credit concerns, exchange rates, any price risk concerns that are occurring in the economy. And there is an intertemporal budget constraint that needs to be met, which is the following one. So essentially, if there is a decrease in the value of the assets, then it must be matched by some combination of either increasing seigniorage or decreasing dividends. Now, increasing seigniorage is inconsistent with price stability. However, decreasing dividends might require fiscal backing. So this means that without the backing of the fiscal authority, the central bank would actually not be able to deliver on its price stability. My final comment is that there are large levels of debt. This decreases the fiscal space. There's a paper by Fleckenstein, Longstaff, and Lustig, which shows that there are large and persistent arbitrage profits by replicating TIPS using many other assets, including inflation-linked swaps, strips, and nominal bonds. And there's another paper that suggests that these large deviations, because they argue that it's they can explain it through other mechanisms, but there's a paper that argues that these differences are essentially showing different exposures to default risk that are present in nominal and real bonds. Why is that so? Because nominal debt can be inflated away, while real debt cannot. So if the government actually defaults, they might have a choice to redeem the nominal bonds, but offer lower recovery rates on the real bonds, which would be costlier at that point in time. So, of course, we're talking about the US, so under the 14th Amendment, the validity of the public debt of the United States will not be questioned, but it still remains a concern that one may have. So overall, I want to say it's a great contribution. I think that it addresses a key question. It's extremely relevant, not only due to today's current climate, but I think it's a very nice economic question to begin with, and it's moving the conversation in the right direction. So thank you very much for giving the chance to read the paper.
If you could respond while the next speaker, Michael, is firing up his slides, if possible.
Thank
you.
Thank you so much for the discussion. I guess most of the points were quite open-ended, so it's just a lot of food for thought, and I would need to think more about it after I see the slides and so on. But it was a very fruitful discussion. Thank you.
Thanks very much. Okay, I think we'll probably move on then. I'm sure Hanno has a question, but he has the floor fairly shortly in the next session, so I'll perhaps defer that. Great. So we have Michael Bauer, Hamburg, to give his paper. Thank you very much.
Okay, great. Thanks, Reese. Thank you to all the other organizers. Great conference, great building. Those pillars, beautiful. Anyway, so I'll jump right in. This is a paper with Carolyn Pfluger from Chicago Harris School, with Adi Sundaram at Harvard Business School. And there's no disclaimer. So the slides will advance here. Okay. So there's this notion in the academic literature and among policymakers that perceptions about monetary policy are at least as important, if not more important, than the actual conduct of monetary policy. There's, for example, a bunch of theoretical results in the literature that show, beliefs about how monetary policy is conducted. That really determines, the efficiency of outcomes. It determines the trade-offs policymakers face, et cetera, et cetera. So this quote by former Chairman Bernanke symbolizes or summarizes this consensus view. Okay, so the public's understanding, the public's perceptions about the monetary framework are totally central. Now, policy rules are a pretty good way to summarize the conduct of monetary policy. I think we'd all agree. There's a lot of, as you all know, a lot of theoretical work, empirical work. You can use monetary policy rules for positive and normative analysis. Now, putting this together with what I said on the last slide, you wonder what is the perceived rule that the public thinks the Fed will follow. Right? So if you use historical macroeconomic data, that is not what you're going to estimate. You're going to estimate the actual rule that describes the behavior of the central bank. But what we'd like to know, I think, in addition to that, is what the public thinks the Fed follows in terms of a rule. Okay, and then there's additional questions you might ask once you know the perceived policy rule. For example, does it somehow line up with the actual policy rule? How does it change? How are beliefs about monetary policy updated? How does it relate to other issues in financial markets, such as bond risk premia or a taper tantrum? Okay, so in this paper, we're going to do something pretty simple. We're going to estimate perceived monetary policy rules using survey data. Okay, we're going to use the blue chip financial forecasts. They're pretty nice. They're available every month. You get a wide cross-section of forecasters, 30 to 50 institutions every month. You got a horizon out to 5 quarters usually, and you got interest rate forecasts as well as the underlying macroeconomic assumptions that they provide as a basis for their interest rate forecasts. So that seems natural place to go to estimate perceived monetary policy rules. Different from the few papers in the literature that have done this, we importantly allow for time-varying parameters. Okay, that seems to us absolutely central to understand, obviously, shifts in the perceptions about monetary policy. And you can do this with this rich panel data of survey forecasts, just because at every point in time you have a lot of information. So as opposed to oftentimes in macroeconometrics, it's pretty difficult to allow for time-varying parameters. Here it's actually very simple. Okay, so we'll basically run separate panel regressions or multidimensional panel regressions or a state-space model. All gives you pretty much the same thing because there's so much information in the data that the assumptions, about the linear model there don't matter very much. I'll show you results for 2 different estimates. Okay. We're going to document that there is pronounced cyclical variation in the perceived rule parameters. In particular, this one parameter, I'll focus on the responsiveness to the output gap. This little gamma hat, that is the perceived responsiveness to the output gap. And we're going to tie this in with other phenomena like the high frequency response of financial markets to macro news, learning about the policy rule, Fed funds forecast errors, etc. Okay. So the data, again, is the blue chip financial forecast. There's really not much else to say about this other than maybe we impute output gap forecasts because you really want to specify a policy rule using measures of slack or measures of gaps instead of real GDP growth. Just because we might be worried that our imputations are problematic, we also use the SPF, which has unemployment rate forecasts and some assumptions about the natural rate of unemployment to get output unemployment gap forecasts, and we get very similar results. But we like the blue chip because it has a higher frequency and more interest rates. Now I should mention, so we're going to tie, well, I'll show you the rule here. So we're going to tie the funds rate forecast here, the funds rate to, okay, so this is a simple policy rule relating the funds rate to, some trend components and the responsiveness to the inflation gap and the output gap. And then if you just write this as forecasts for each forecaster J, then you have kind of the perceived responsiveness that links the macro forecast to the funds rate forecast. Okay, so I'll only show you results for the funds rate forecast, and but it's kind of interesting to extend this with maybe other things that the Fed might react to, like financial conditions. So the nice thing in the blue chip financial forecast is you've got a few other interest rates, for example, corporate bond yields, and so you can think, you can estimate other rules where the Fed also responds to financial conditions measured by corporate bond spreads. That does not affect our results, but it's an interesting extension. So there's an intercept here that depends on perceptions about R star and pi star. And so when we run panel regressions, we're going to allow this to be correlated with the macro forecasts, so allowing for fixed effects across forecasters. Okay, so forecasters can disagree on everything. Here we assume them to agree on the policy rule, functional form, and also on these response coefficients. If they disagree, then at least under certain conditions, what we're estimating is the average perception, the average perceived coefficient across forecasters. Okay, so so we're going to run this panel regression, very, very simple. Okay, so we're going to get this, we're getting this gamma hat, that is the coefficient on the output gap, remember? And that varies a lot, okay? So benchmark, Taylor rule, 0.5, right? Taylor 99 rule, 1.0. Okay, so it fluctuates around these values, but sometimes during some episodes it is very low, drops to almost 0, or here to actually to 0. And so we're going to think about the cyclical fluctuation. So this varies more than you'd think. Perceptions about a policy rule, maybe you would have thought ahead of time that they would fluctuate. Okay, so there's a lot of, so that's one of our key results here, that that there is fluctuations over the monetary policy cycle and over the business cycle, and then we can talk about the zero lower bound. I guess I just emphasize that in this figure that during episodes of monetary tightening, that's really when the Fed is the most predictable. That's when the macro forecasts are most closely connected to the funds rate forecast. That's what you see during this major tightening, started under Greenspan, finished under Bernanke. That's what you see back here during the soft landing that Greenspan engineered. That's what you see here when liftoff starts to come into view and then actually happens. It's what you see here when people started to anticipate a liftoff, but then the Fed corrected them and said, hold on, there's the European debt crisis. There's not going to be any liftoff for a while. But generally, when people expect a tightening, there's connection with the macro forecast. When there's easing, it is quite the opposite. Okay, so this paper is not about inflation, because this inflation coefficient is not very interesting, because over this episode, these 3 decades, except for maybe the early 90s, inflation really was very close to the target, and you don't have a lot of interesting variation away from the target, but that's what you would need to really estimate this response coefficient. Okay, so I hate to disappoint you during these days where everyone talks about inflation. This paper is not about inflation. Not yet. Maybe when we update the data, we'll have more. Okay. Okay, so state-space model. Let me skip this in the interest of time. It looks pretty similar. Okay, it's just a little smoother. Okay, so the cyclical shift is just kind of documenting what I said earlier about during a tightening episode. So when the Fed starts to tighten, the slope is pretty steep. And let me see, this afternoon, am I switching the signs here? Okay, so when the slope is high, right, that is at the end of an easing episode, just when the Fed is about to tighten. That is also when our gamma is very high. That's really when there's a tight connection between the funds rate forecast and the output gap. We're connecting this a little bit here to the credit spread. There's some connection with the recession dummies from the NBR. It's documenting the cyclical variation here. There's I'll show you results for this panel regression estimate and then for robustness for the state space model estimate, which are broadly pretty similar with some differences in the details. Okay, all right. So there's cyclical shifts. I'll just say when the Fed is tightening, the Fed keeps talking about data dependence. Back during Bernanke's times and early during Powell's tenure, there was like every other speech, there was data dependence in the title or in the punchlines. And so this is really what's reflected in these estimates, right? Data dependence means like a high responsiveness in the forecast. Whereas during easing episodes, it's quite different. Okay, so I guess I'll just show you a little bit about the response to macro news. Please remind me how long I have until 15 past? Or? Thank you. Okay, so people run event study regressions, right? Regress the 10-year yield around releases of the employment report, the unemployment rate and the payrolls, on the news component in that employment report, right? And people find big, significant coefficients. Macro news really affect asset prices and interest rates, right? But this sensitivity of interest rates to macro news seems to vary over time. At least Swanson and Williams showed intuitively that it really drops when you get to the zero lower bound. But more generally, there's some evidence that it varies over time, and it seems that the perceptions about the conduct of monetary policy should be a crucial determinant in how bond markets react to macroeconomic news. That's kind of the connection between the two, right? So that's our hypothesis, which we confirm with some very simple event study regressions here. So there's basically an interaction effect. There's an interaction effect of the this response coefficient from our policy rule and the macro news, where this ZT is, think of this as a summary of all the macro news, so that we don't do this separately for every CPI, GDP, and so forth. So it summarizes all the macro news, and if I didn't have any other variables, it would be a 1.0 coefficient, because it's the fitted value from a multivariate regression. But here I'm including that interaction effect, and that has just a really strong positive coefficient. In the paper, we go on to interpret the magnitude of this coefficient, from the perspective of a new Keynesian model and a policy rule. So it kind of makes a lot of sense that the magnitude, but for now, the takeaway really is that if monetary policy is perceived to be more responsive to macroeconomic conditions, those are times when financial markets respond much more strongly to macro news. Okay, so it's kind of a validation of our rule estimates, as well as kind of a more fundamental explanation of this time variation of this event study sensitivity that people have been estimating. Okay, so let me show you one more thing. So you'd think that people update their beliefs about the policy rule in response to what monetary policy does, right? In particular, if during a strong economy, monetary policy is tighter or is tightened more than people thought, that would suggest higher responsiveness and should lead you to upward revisions in this gamma hat, okay? And we'll use monetary policy surprises around FOMC announcements to test exactly that, right? Those are exactly measuring, was monetary policy, tighter than everyone thought? That's a positive or a hawkish policy surprise, and vice versa. So if you have a hawkish surprise during a strong economy, that should lead to an increase in gamma, easing surprise, a tighter surprise, hawkish surprise during a weak economy should lead to a decrease in perceived gamma. That's consistent with simple learning models like the ones I wrote down in my papers with Eric Swanson. So we'll use a local projection with state dependence to check that, where we have a dummy for a strong economy or a weak economy. Simple as that, okay? So going forward, as this, we'll give it some time, a local projection going forward several months, does the public revise their beliefs? And they do in the direction predicted by rational learning. If you have a tightening surprise in a strong economy, then people over a few months then believe that the Fed is more responsive and vice versa in a weak economy. So it's in the direction of rational learning. It's pretty gradual, so a new version of the paper, we're trying to explain why this is so gradual. It turns out not to be that difficult to rationalize that, okay? All right, so if you have, so let me just say 2 words about the Greenspan conundrum, right? 2003, 2005, 2004, 2006, the Fed was tightening a lot, but long rates weren't really increasing as much, right? They were going sideways, even decreasing. So this, together with some evidence where we tie this gamma hat and the perceived policy rule to bond risk premium, the term premium, is an additional explanation for that, okay? So you have a connection between monetary policy surprises, which you get obviously during a strong tightening cycle, and the perceived policy rule. So you'll get revisions to the beliefs of the policy rule towards a stronger gamma hat, more responsive Fed. That, in separate analysis, we show that that's connected to the term premium and actually leads to a lower term premium. There's a significant and robust connection between beliefs about the policy rule and risk premia in bond markets that's also consistent with standard asset pricing logic. So then with this tightening monetary policy leading to a lower term premium, you have an additional possible explanation for conundrum episodes where short rates rise, the Fed tightens, often surprisingly much, and then a decline in long rates and lower term premium, which people have shown is one of the main channels for the conundrum. Okay, so we have an explanation for this channel, so to say. Okay, so I'll conclude here. Simple paper estimating perceived monetary policy rules, straightforward methodology, which we may tweak a little bit more, but the basic idea is simple. And we show that there's a lot of variation in these perceived monetary policy rules, and we connect this to macro news event studies, learning about the rule, a few other things, including bond risk premia. And I talked a little bit about how this can maybe explain a conundrum episode, and of course this is related to forward guidance. Okay, so that's all I have. Thank you very much.
To give the discussion.
Oh, sorry.
Ilaria Piatti from Queen Mary. I think they're fired up on the Adobe. If you hover over... Yes.
Right, so thanks to the organizers for giving me the opportunity to discuss this very nice paper. It was really a pleasure to read it. And, well, Michael has done a very good job presenting, so I'll just spend a little time on an overview of the paper, and then I'll try to provide some comments and suggestions. So the motivation for the paper is pretty clear. So we know that the problem of managing and coordinating expectations in the economy, is now definition of monetary policy. And to the extent that Woodford in 2005 said that not only do expectations about policy matter, but very little else matters. And the argument is that central banks control directly the overnight rate. That is, of relatively little relevance directly to market participants, and then the transmission mechanism from this overnight rate to the prices that matter for market participants, such as long-term rates, depends on expectations, right? So monetary policy is effective only as far as it can shape the beliefs of market participants. So a better knowledge of this belief formation process and the links between expectations about fundamentals and interest rates are of crucial importance for policymakers and for financial markets as well. So what this paper does is to build estimates of a time-varying perceived monetary policy rule from panel data on macroeconomic forecast using variation across forecasters and horizons to identify the policy rule coefficients. And then they use these estimated policy rule coefficients to address the following questions. First of all, when and why there are shifts in this perceived monetary policy rule, and what are the implications for monetary policy and asset pricing. So key ingredients, well, first of all, survey data. They use blue chip financial forecast, so individual forecast about the Fed fund rate, inflation, GDP growth forecast at horizons from the current quarter to 5 quarters ahead. And we have between 30 and 50 forecasters every month, so the panel data is rich enough. And then they assume that forecasters believe the Fed follows a standard, simple policy rule. So, this is the equilibrium nominal rate. Then we have inflation gap, output gap, and so the objects of interest here are this, responsiveness to the inflation gap and responsiveness to the output gap. And in particular, the paper focuses on this gamma t. So these perceived rule coefficients are estimated by basically running panel regressions, so at every month t, exploiting the cross-section of agents, so for different j's, and the different horizons h as well. They have two methodologies, so this separate panel regressions and also state-based model that basically uses some time series model for the responsiveness coefficients and for the equilibrium nominal rate as well. And then Michael didn't discuss it in the presentation, but they also have a simple model to show that the estimation bias is small, and in particular it doesn't affect the cyclicality of the estimated coefficients. So main results are the following. So first of all, there is an interesting cyclicality in the coefficients. So these, in particular, the perceived output gap varies over the business cycle and is consistent with a cycle of quick rate cuts and gradual tightenings. And interestingly, it's a kind of a robustness check, if you like. The estimated policy rule is consistent with the financial market reaction in the sense that the perceived rule coefficients explain the time variance sensitivity of interest rates to macroeconomic news. And in general, the forecasters seem to react rationally to monetary policy shocks, but just gradually over time. And using the estimated coefficients, they can also explain policy rate forecast errors and also partially bond risk premia in that they relate perceived output gap coefficient with expected future excess returns. And this last point is actually consistent with economic intuition and not surprising, because this perceived out-of-gap policy rate is actually capturing a time-varying link between interest rates and the state of the economy. So here are my comments. So first of all, I'm going to talk a little bit about the heterogeneity in forecasters' beliefs. And in the paper, forecasters are assumed to have the same beliefs about the policy rule and about the policy rule coefficients. And Michael also mentioned this in the presentation. The paper argues that in reality, forecasters might have heterogeneous beliefs, in which case the estimate should be viewed as average beliefs about the rules parameters. And I'm not sure, in the presentation you mentioned that there are some certain conditions behind this argument. This wasn't in the version of the paper I read, but it would be nice to understand what are these conditions, because it's not obvious that if forecasters really have heterogeneous beliefs about the policy rule and the policy rule coefficients, then your estimation approach actually gives us an average policy rule coefficient or perceived coefficient. And even if it was really the case, should we care about the average belief or maybe something else? And it's not clear that the average belief is what moves the market. In a related paper with Buraski and Whelan, we actually compute bond risk premia using survey forecast from blue chip. And our argument there is that we should not just use the consensus, this is average belief, but something like just the accurate agents, for example. So try to give more weights to the agents that are then more relevant in the markets as well. And in a previous version of this paper, actually, we also looked at Fed fund rate forecasts, and it seemed to be the case that actually primary dealers were those with the highest accuracy for Fed fund rates, which is actually pretty intuitive. So maybe focusing on subgroups of forecasters, you can say something more about these perceived policy rule coefficients. And here I've done a very simple exercise, just focusing on the forecasters that have a long enough history, because it's a very unbalanced panel, the blue chip financial forecast. I just ran regression of the Fed fund rate forecast on the gap forecast, and you see that the distribution is pretty large. Now, this doesn't necessarily mean that your assumption is wrong. It could also be that the forecasters here at the right end of the distribution maybe are only in the panel in periods where the perception of the policy rule is high, and maybe the guys that have coefficients closer to 0 are in the panel in the other periods. But it would be nice to see a little bit more of evidence that the policy rule perceptions are consistent across forecasters and the policy rule as well. Then you also use the heterogeneity, let's say the forecast across different horizons to identify the coefficients. So just try to look at the link between Fed fund rate forecast and output gate forecast at different horizons, so 1, 2, 3, 4 quarters ahead. You looked at the same data in the paper, at least the version I've seen, and argued that there is enough variation across horizons, but it also looks that the positive link between the two is mostly evident at relatively longer horizons, so h equal to 4 here. If we look at different dates, we actually find similar results. So I was wondering whether it might be also economically intuitive to expect this link, or expect forecasters to rely on this policy rule at relatively longer horizon, so h equal to 4 or 5, while maybe at shorter horizon, they also take into account other short-term factors in the decision. So you mostly focus on the gamma, right? Not much the beta. But you assume that the two, or shocks in the two coefficients are uncorrelated. Now, I was wondering whether it might be reasonable to assume a negative correlation between the two, because it could be that maybe either inflation or growth is more salient. Like, for example, today, we would assume that policymakers look more at inflation forecast rather than growth. And maybe, so, we could expect a negative correlation between the two, also, in the forecasters' expectations. And, well, briefly, obviously, as you also mentioned, the beta could be more interesting in the most recent sample, if you could show that. And I'm gonna just, take one more minute if I can. So the link to bond risk premia, I was just wondering whether, in the spirit that what matters are the expectations about monetary policy, it might seem more reasonable to look at the link between the perceived co-movement between interest rates and macroeconomy and the perceived risk premia, or expected excess bond returns, instead of using ex post realization, right? And I just try to, look at this using the measure that we have in the paper with Burask and Whelan. And it seems that the same correlation is there. So well, I use the slope, not the measure that you have in the paper, but this coefficient on gamma at is actually significant, and with also similar coefficient to what you have in the paper. And actually, compared to just using the slope, the adjusted R square almost doubles, which is consistent also with what you have. I have a number of additional comments that maybe we can discuss separately, but yeah, in general, I would just say that there's a very interesting paper, and it would be nice to dig a little bit deeper into the cross-sectional distribution of forecasters, and maybe also specify a little bit better the policy implications, because you seem to suggest that forecasters understand the Fed's policy and update their beliefs accordingly, just gradually over time. So is there any scope for the Fed to change its communication or not? Yeah, and I'll stop here.
Thanks very much for an excellent discussion. Michael, if you'd like to respond initially, well, perhaps we'll take a question, but perhaps, Andrea, you want to get fire up the slides. Ambrogio, after Michael, you can go respond to it.
Yeah, I mean, if we have time for a little Q&A, I'd rather take questions from the floor than...
Ambrogio?
Yeah, so my question is about potentially alternative explanation for some of your findings. And I think it resonates a little bit with Laria's comments on the role of trade-off inducing shocks. So if you were to believe that the lambda, or the preference of the policymaker changes depending on what is the shock that hits the economy to the extent there is trade-off inducing, then you could have kind of agents learning about the shock rather than the policy rule by, from the behavior of the policy rate and the central bank. And so I was wondering whether you kind of looked into this. That would basically mean sticking some kind of measure of trade-off inducing shocks in the first regression you showed, and see whether there is any relation, or do the same exercise on core inflation rather than, CPI inflation or something along these lines. Thank you.
Yeah, no, this is a great point. We have tried a few simple things to address this about, supply shocks, maybe using oil prices or, financial conditions, credit crunch. So we've kind of experimented a little bit with that. So that was kind of what was behind showing the relationship between credit spreads and our gamma estimate, which maybe supports a little bit this view that some of the variation may indeed be driven by changing compositions of the shocks. But yeah, we need to do more along those lines. Ambrogio, thank you.
And a question just here in the...
Alexander Mihailov from University of Reading. I want to follow up on one of the questions of the discussant. I think theoretically it's important to talk about the link or the correlation between the two feedback coefficients, because for example, in theory, we know about the Taylor principle or the generalized Taylor principle that would apply in your case because you have a reaction to the output gap and to inflation. So it is true that for theoretical reasons, to ensure determinacy, these two coefficients should be negatively correlated, so you can mitigate one of the impacts by changing the other. So I guess you may have an additional dimension in your work which aligns that with theory or just tests it empirically. Thanks.
That's a great suggestion. Thank you. Yes. I did, hopefully we have time for another question, but I did want to say thank you so much for a great discussion. It's really great points. Thank you.
I think we do have time just for one very quick. Is it quick, Alex? Okay.
Thank you. Alex Haas from Oxford. Just wanted to ask, is there a reason why in your simple rules you didn't include an inertia or persistence coefficient? Because I expect that might explain some of the very low coefficients in your estimates on output and inflation.
Yeah, so if you have changing degrees of policy inertia, there could be, yeah. So a constant degree of policy inertia obviously is just going to be a level shift for all this stuff. So yeah, we've done some work on allowing for changing degrees of policy inertia. That makes the whole thing a lot more complicated because then you have all kinds of nonlinearities. Some of the analysis we've done suggests that that's not a big factor driving these changes, but there's more to be done. Yeah, thanks.
Fantastic. So I've made you stand there, Andrea, but thanks for waiting. We were delighted to have Andrea from the Board of Governors to speak to us now. Thanks, Mike.
Making sure the slides work. Thank you so much. Thank you, the organizers, for including the paper on the program. This is joint work with Tyler Pike, who's an excellent grad student at the University of Maryland, and the usual disclaimer applies. I will start with a by now famous quote by Jeremy Stein in 2013 when he was Fed governor. While monetary policy may not be quite the right tool to pursue financial stability, it has one important advantage relative to supervision and regulation, that is that it gets in all the cracks. And since the great financial crisis, a consensus has emerged that vulnerabilities are best addressed through supervisory, regulatory, and macroprudential tools. However, the question remains of whether monetary policy, by means of interest rate changes or balance sheet policies, should respond to the buildup of financial vulnerabilities that pose macroeconomic risk. Generally, this type of assessment is done by means of a cost and benefit analysis. One example of this is Benson's work, 2016, 2017. The costs and benefits that are being compared are costs of raising interest rates to lean against the wind of financial vulnerabilities that can affect the macro outlook, especially in the short term, by weakening it, in exchange for benefits, which could be a reduced amount of macroeconomic risk or depth of a future financial crisis or a recession. Okay? And in Benson's view, when you assess these costs and benefits, the balance really is heavier on the cost side, and his recommendation is that monetary policy should not lean against the wind. The one channel through which this is affecting, monetary policy affects vulnerabilities through one variable, namely credit. Generally, in these simplified models, is credit growth. And so one of the shortcomings of such frameworks is that they lack a comprehensive empirical assessment of the effect of monetary policy on a whole range of vulnerabilities, on different classes of vulnerabilities. And then to look exactly the effect of vulnerabilities on macro risks is another question that usually is not addressed by this type of accounting like Benson's. And this is the objective of this paper. It's to quantify the term of these trade-offs. So what I'll do today is I'll walk you through this analysis where we look at the costs, and these are identified here by this derivative of the effect of changes in interest rates on macroeconomic outcomes, and then assess the benefits that go from monetary policy to vulnerability, so the effect of monetary policy on vulnerabilities, and quantifying the effect of vulnerabilities on macro risks. And these are the two terms here, A and B, that you see as the effect of changes in interest rate on the level of vulnerabilities over an horizon H, times the effect of this change in vulnerabilities can cause to the probability that a macro outcome, for example, GDP growth, be lower than a certain quantile Q, okay? So I'll do this in two steps and then sort of a closing step at the end. The first step is to assess the role of monetary policy in affecting vulnerabilities, and this is done by means of a dynamic factor model, or better, factor augmented proxies, SPAR. What we do is we extract common factors from a large data set of vulnerabilities indicators coming from work by David here. And we look at the interactions between these factors that we extract from the big panel of vulnerabilities and macroeconomic outcomes. And then we look at the transmission of monetary policy shocks, event study monetary policy shocks, to the vulnerabilities by means of these factors, okay? So that we can look at their transmission through the cracks of the financial system. In the second step, we use this reduction in dimensionality that we obtained through the favor to look at the effect of the vulnerability factors in quantile regression settings on growth and inflation at risk. Okay? And then we can then join the two steps together and compare the costs and benefits of leaning against the wind, or better, of interest rate policy in affecting macro risk by means of vulnerabilities. There's a large literature here that we draw from with people in the room. There's work that Nelly mentioned this morning about the term structural growth at risk that is reflected in some of our work. I will not have time to go over the details, but hopefully I'll get the chance to mention this as we go. So, preview of the results. Does monetary policy affect financial vulnerabilities? And the answer here is yes, with some trade-offs across vulnerability classes. In particular, surprise monetary policy tightening does weaken the outlook, on average reduces financial vulnerabilities, but there are some trade-offs. There's a moderate decrease in the asset valuation pressure. So this is the largest effect that monetary policy has on the vulnerability the classes of vulnerability indicators. So there's a higher price of risk here, if you so want to call it. There's a modest reduction in credit growth, if you can think about this as a lower quantity of risk in the system. And there's also a modest slowdown in mortgage debt over GDP ratio. So this is basically a reduced degree of accumulation of mortgage debt over GDP, over which monetary policy has quite an effect. However, so I call this an increased debt sustainability channel, especially on the mortgage side. However, there are some indicators that worsen, and these are indicators of quality of credit. There's a higher risky leverage of risky borrowers in the business side of the non-financial sector, higher debt over income ratios, again, usually for businesses, and deterioration of most debt service ratios, like interest coverage ratios for corporations. Then the result of the second step, and the question here is, can vulnerabilities predict increased macro risk? And the answer is yes. In particular, lower asset valuation pressure predicts higher short-run risk. And the red here throughout this presentation is meant to mean increased vulnerabilities and increased risk. Okay, and the green instead would be reduced vulnerabilities, reduced risk. And in the medium term, however, build-up in credit growth instead predicts higher medium-run risk, okay? So you already see that there is a tension here. If monetary policy can lower asset valuation pressures and can slow down credit growth, there is an intertemporal trade-off, which Nelly described so well this morning, that appears as you use interest rate policy to tame vulnerabilities, okay? So what we find is that 100 basis point increase in the 2-year Treasury yield in the short term weakens the outlook and increases sizably downside macro risk. The left tail of the GDP distribution, the 10 quantile, moves down by around 1%, but this risk dissipates within a year. And instead, in the medium term, when you look at the tail outcomes 2 or 3 years out, there's a moderate yet persistent reduction in downside macro risk, while the left tail of GDP growth shifts up by 0.2% for around 2 years. Okay? So let me talk about the data very quickly. So this is an extensive data set of vulnerability indicators divided by classes that David and some very esteemed colleagues at the board have worked on. And this constitutes a framework to map the heat, as they call it, of system vulnerabilities, okay? The vulnerabilities are divided into classes, and there are, asset valuation pressure indicators. Out of these, there's some price over rent indicators for the real estate market, for example, equity returns, credit spreads, lending standards. There are non-financial leverage indicators, such as business credit growth, debt service ratios for household and businesses, leverage ratios. There are indicators that pertain to the financial sector, and in particular financial leverage, so these are bank capital ratios, non-bank leverage ratios, and indicators of funding risk and maturity transformation within the financial sector, so vulnerabilities that build up in relation to their activity of intermediating and basically creating, intermediating on the liquidity margin and on the maturity margin. Okay, so these indexes, these indicators are then aggregated up to class indexes and overall indexes, okay? And then assessed relative to their historical distribution to create these heat maps. When these indicators are mostly elevated, then you get a sort of a red color for an overall index. This was before the Great Financial Crisis. Otherwise, usually these colors tend to be distributed over a range from green to red. I'll give you an example of this in the presentation. Okay. This is a mixed frequency and balance panel. I am looking at balance sheet indicators that are quarterly. I interpolate these to monthly. There are some of these indicators that have clear trends. I don't presume that monetary policy will be able to affect these trends, so I take those trends out and look at transformed 12-month differences for these indicators. And this is the way we deal with the data. So the dynamic factor model, this factor-augmented VAR, is a parsimonious representation of the dynamics of macro factors and financial vulnerability indicators. The macro variables are policy indicators, the 2-year treasury. Inflation, we use PCE core. For activity, we use a monthly estimate of GDP growth by Caldara and co-authors. We do a number of robustness checks using IP, using unemployment. The results are very robust. So these are the macro observables. There are 41 vulnerability indicators. We leave out those of size and interconnectedness, again, because we don't expect monetary policy to necessarily affect these. These are explained by 4 latent factors in the estimation of the model. And the asset valuation indicators include also typical measures of financial conditions. So, if you're used to the classic VARs like Girdle and Karate, where they control for EBP, those type of indicators are also present in this type of analysis. Okay, so the vulnerability variables, YV, load onto vulnerability factors, XV, and there's a measurement error, eta, okay, for each of them. Then these macro and vulnerability factors are interacted together by means of a VAR with 6 legs. And the structural shocks are epsilon t, out of which I want to identify the monetary policy ones. Okay, so the monetary policy instrument is ordered first, and then I'll use event studies to do that. One important assumption is that the structural shocks epsilon t are uncorrelated to the measurement error eta t. So basically, the financial vulnerabilities interact with macro conditions only by means of the state equation. Okay, estimate this by 2-step estimation. I will not go much into the details, but what I will show you is a PCA rotation, so a principal component analysis rotation, where the factors are rotated to be orthogonal. Okay, as I said, the optimal number of factors here is 4. We're using 6 legs, and the sample period is from 1988 to 2020, February, right before the COVID shock. To identify the role of monetary policy, we look at the monetary policy shock by Miranda, Lipin, and Rico, which is a change in the 3-month federal funds future quotes around FOMC statements that is netted on an information component coming from changes in the Teal-Book forecast. Okay? And then we do a bunch of robustness checks with other shocks. I won't present those today. One caveat here, of course, is that we're looking at the unexpected component of monetary policy and not the expected component. Okay, so this is very standard in this literature to look at the effect of monetary policy, but I want to put it out there as a proviso. So let me show you the factors. These are the 4 factors that come out of the extraction of the dimension reduction from the 41 indicators. As you can see, the factors have very different cyclical behaviors. In particular, you can see that factor 1 tends to grow over booms and peak right before recessions, okay? And it tends to drop pretty dramatically during recessionary episodes. The second factor, factor 2, instead tends to peak during the troughs, so right, not so close to the recessions, okay? I'll tell you in a moment how to think about these factors in the next slide. But let me point you at these irregularities here. The other thing to notice is that the first 2 factors are extracted quite precisely, while instead there's quite a bit of state uncertainty around factors 3 and factor 4. Okay? So how do I think about these? I'm looking here at simple correlations. I'm not structurally identifying shocks to these quite yet, so we might be doing this for a different project, but the What I want to show you here is that factor 1 correlates highly with business debt growth. Okay? Another variable it correlates highly with, for example, is runnability of the financial system balance sheet. So this is not clearly the only variable that it relates to, but I'm trying to here point to the fact that this is a sort of a quantity of risk type of indicator that tends to build up slowly over the business cycle and then reverts during crises. Then instead, the second factor here, if you flip the sign and you look at it as inverting the series, you recognize series like corporate spreads or the excess bond premium or a measure of lending standards from the SLOOS index, for example. So this is, lending standards tend to become loose, and so vulnerabilities increase during booms, okay? But then in anticipation of recession, these tend to deteriorate, okay? And lending standards get really tight. In this case, vulnerabilities are low in the language of Eichmann et al. And then with the following boom, things sort of mean revert, and you go back to easing standards, okay? When it comes to factor 3 or factor 4, these ones are the correlations with the original variables a little bit looser. As I was telling you earlier, so the factor 3 is a measure of speed of adjustment of the mortgage debt over GDP. You can see, for example, in the boom with the 2000s, the debt over GDP tends to accumulate, so the value of the series is positive here. It then sort of tends to taper, and growth tends to come down a little bit, and then it turns negative before the recession until GDP really drops, and then the ratio clearly has to move up. Okay, but it's a little more difficult to find clear cyclical patterns out of these, just to the fact that again they tend to these are ratios that they tend to deteriorate over the over recession periods. Okay, I'm told in 5 minutes, so I'll move on. Effect of monetary policy on macro variables. This will surprise no one. After monetary policy tightening, this weakens the outlook. Inflation comes down, GDP growth comes down around 1%. And financial conditions tighten. This is just to show you sort of in line with the Gerler-Corradi type of specifications. The effect of monetary policy on vulnerabilities, again, through the lens of dynamic factor model. You see that monetary policy tightening slows down that growth. These are standard deviations of the factors here. And this decrease in the growth of credit is actually pretty persistent. Lending standards, so again, this is the negative lending standard, so risk appetite tends to drop, at least in the short term, okay? And the same is true for mortgage over GDP. The effect on the fourth factor is not significant when you account for state uncertainty, so I won't spend a lot of time on that at the moment. Okay. Now, what does this mean for the vulnerabilities in historical context? Here, I'm just shocking the path of the 2-year Treasury in 2005, increasing by 100 basis points to the path. Okay, so this is just the same impulse responses you've seen before, just put in historical context for you to understand what it would mean for an index like David's. Okay, and this is the heat map that I was talking about. This is an aggregation of all the vulnerability indicators. And now, since I can shock the factors and I can shock all the indicators through the model, I can tell you what the evolution of the vulnerability would have been had monetary policy tightened by a surprise 100 basis points in 2005. You see the growth would have dropped by around 1%, okay, quite persistently. Inflation would have been almost unchanged. I mean, the Phillips curve implied by this model is very flat in this period. But the vulnerabilities would have come down, especially in the short term, by means of lower valuation pressure, but then they would have reverted again to the deep red level pre-Great Financial Crisis. So to look at the last bit, I'm going to now focus on the effect of vulnerabilities on macro risk. To do this, I estimate quantile regressions, where the factors, the vulnerability factors, are on the right-hand side, and what I'm trying to predict here is expected growth of GDP, and I do this for 2 horizons, 1-year horizon and 2 to 3 years. Okay, so there's a short term and a medium term. Okay, and we estimate these by minimizing weighted absolute loss functions down here. I'm trying to speed up to conclude. Let me show you the benefits first of using monetary policy to reduce vulnerabilities. This is the medium term. You see here 2 to 3 years. What you see here are the quantile regression coefficients for the 10th, the 50th, and the 90th quantiles of GDP growth, okay, predicted 2 to 3 years from now. And what you see here is that an increase in that growth, so a positive shock to F1, will shift the tail of the distribution of GDP down by around 0.5 percentage points. Okay? So what you see a similar result here for risk appetite. You also a negative effect. I won't spend much time on the other two. Let me focus on factor 1 and factor 2 for now. Maybe after the discussion I can say something more about the others. The typical growth at risk result is also still present at the 1-year horizon. So if you look at deterioration of risk appetite over the 1 year, it actually, so in this case it's a drop in F2, that would also increase growth at risk, okay? So just that the signs are flipped, okay? So the, well, how many minutes I have? 2? Okay, all right. So how do we think about this together? So we have the coefficient from the growth at risk exercise, and we have the impulse responses of the factors on the wake of a monetary policy tightening. So when monetary policy tightens, factor 1 drops, and in the medium term, so it stays low in the medium term, as factor 2 also drops, okay? So multiplying the coefficients of the quantile regressions by these impulse responses, I can get an effect of monetary policy tightening on the left tail of growth over the 1 year and the 2 to 3 year horizon. And what you see here is that while the left tail of GDP growth in the 1 year, with the 1 year horizon drops by around 1.2%, okay? So this, if there's an increase in downside risk to growth in the short term. In the medium term, when you look at the 2-3 year effect, the left tail actually moves up, and moves up by around 0.2 percentage points, okay? All right, let me conclude. Monetary policy shocks affect a large set of vulnerabilities. In the wake of monetary policy tightening, macro outlook weakens. We also have, there's some slowdown in credit growth, risk appetite subsides. This has effects on the tail outcomes of GDP growth, on predicted tail outcomes of GDP growth. Quantitatively, the short-term costs are sizable. In the medium term, however, the benefits of reduced downside risk seem modest. However, they are somewhat persistent. And I'm done.
Thank you very much, Andrea. We now have Ambrogio Cesabianchi from Bank of England.
Right. So thanks for having me. I had the pleasure of reading this very interesting paper, which was very, very thought-provoking. So the question of the paper is kind of a perennial one, which is, should we meaning central banks, think about financial developments that pose macroeconomic risk on top of our standard mandates of output and inflation. And these so-called leaning against the wind policies or approaches imply a trade-off. There is a cost in terms of a slowdown in economic activity and inflation in the short run. In addition to this cost, there is the possibility of actually pricking the bubble, and by your own tightening, you may cause the financial stability concerns you started with. But there are some benefits, which is maybe by tightening today, I reduce the probability of a crisis tomorrow. So there is an enormous literature on this. I actually remember some of the few papers I read back in the day. The discussion actually started in the 90s, of the ones that motivated this literature started a very long time ago. But actually there is a very difficult problem that all these papers try to address, which is to quantify empirically this trade-off that I just mentioned. And this paper is exactly about this, and it provides actually a very smart way to do that. So the starting point for the paper, which I think is actually brilliant, is to start from these two literatures that really didn't speak to each other until this paper came around. And on the left-hand side, I have the monetary policy VAR literature, where you have some kind of shock identification problem. You want to look at what happens to macro aggregates. And on the right-hand side, I have instead the at-risk literature, where instead you make use of quantile regressions to think about what shocks do to the left tail of the distribution of the variable to. So what this paper does is to really link these two literatures by providing kind of a nice bridge between the monetary policy VARs and the quantile regressions, as well as to quantify the trade-off when it comes to look at macro outcomes versus macro risks outcomes. So what Andrea just showed us is that On the left-hand side, you've got basically got the costs. You have a slowdown in economic activity. You have actually some increase in tail risk when you tighten policy today, and in the immediate future, you have some increased probability of bad events. And on the right-hand side, instead, you have a decline in downside risk in the medium run, which is, the curve going up means that the left tail of the GDP distribution shifts up, so bad realizations are less likely to happen. So from this picture, and of course this depends on the preferences of the policymaker, but if you look at the numbers, you may conclude that actually the costs are outweighing the benefits here, and so maybe leaning against the wind is not that much of a great thing. Now I have two comments. The first comment, I'm afraid, is the usual disclaimer of not for this paper type of comments, but I think, first of all, I had to find something to say. The paper is really nice, and it's very hard to, find suggestions to provide. And so I thought I would go for something that is kind of maybe a bit broader and maybe inspiring some future work on this topic. And then if I have time, I have a smaller point. So starting with the approach, what I'm going to do in this slide is to kind of, give you in one slide, hopefully, the intuition for what Andrea and might do. So start with a bivariate VAR with a measure of output or activity and a financial variable. You think of this as one of the factors in Andrea's presentation. Then, you want to identify one shock, which is unobserved, and then the other shock, whatever, it could be anything else. Think of it as maybe a demand shock. Then we know from VARs how to identify the impact of these monetary policy shocks on these variables, which is given by this vector, column vector B11 and B21. You do it whatever you like, sign restrictions, external instruments, and so on. Then, and this is where the bridge comes. So then what you do, you take a quantile regression where you regress where you regress kind of the left tail of the distribution of your output variable on the financial factor Ft. And finally, you can then compute the impulse response of tail risk, if you want, by just multiplying the beta coefficient times the impulse response of the financial factor to the monetary policy shock. And here I'm ignoring dynamics and so on, it's all on impact. And so I think this is brilliant, it's a very neat idea. So then what you have that, you find that this coefficient is negative typically, a tightening in policy reduces these financial factors. You find from this regression that there is a positive relation. I'm thinking here about the short horizon. So today tightening is going to lead to an increase in the risk of a financial crisis. And so once you multiply these two things, you get a negative effect, which means that a tightening in policy today shifts left tail outcomes to the left. So it's bad. It's actually an increased risk. Okay, so all of this is great, and I think, as I mentioned, it's brilliant. My quibble was on this step of the procedure. So this is a reduced form approach, really, because you're regressing an endogenous variable, Ft, actually you're regressing this tail thing on an endogenous variable. And so I was wondering, does this matter at all? Can something go wrong here? And to try and show what can go wrong, here is a different example, where we have now output as we had before, and the policy rate. So this is another VAR. I'm going to identify the impact of monetary policy shocks on these two endogenous variables. And now let me do a thought experiment, which is, let me think about what happens to inflation, through the same kind of logic of what we went through before, okay? So I'm going to regress inflation on the policy rate, reduced form. I'm going to then compute the impulse response of inflation as beta times B12, exactly as we did before, but just simpler because it's all kind of non-tail mean things. So this coefficient is of course positive, because the policy rate when there is a tightening in policy goes up. This coefficient is also going to be positive because unconditionally, in reduced form, the policy rates and inflations are positively correlated because most of the time it's demand shocks actually driving both things. And so what I get here, I get a positive coefficient, which means if I tighten policy, I'm going to get an increase in inflation, which is not exactly what you get in the VARs we mentioned in the first place. So my main comment here is that the reduced form nature of the bridge of this step could be problematic, and I think that's where the future kind of papers that try to do this thing should go. Now, is this a problem for Andrea's paper? Not really, and the reason is the following. The reason is that, differently from the example I just gave you, the unconditional and the conditional correlation in this step here are actually the same. Okay, so you're not going to get this opposite sign that I just shown you. It's just, you know, an exaggeration if you want. And so in a sense, the sign of this beta coefficient doesn't depend on whether you have a loose monetary policy or you have a booming demand. Yet, I think it is important because basically what this beta implies, and remember the beta pins down the magnitude of the trade-off, okay, because you're multiplying this is a key ingredient for the chart I showed at the very beginning, is basically capturing the average response of tail risk to monetary, and in our example where we assume that demand shocks is the only other shock that drives the economy, demand shocks. So if there is a large heterogeneity in how tail risk responds to these two shocks, you're going to actually get the magnitudes wrong, you know, not the sign. So all those impulse responses will have the same shape, but the numbers could be different. So I think that's why this thing matters. Do I have still a minute, or? So then, you know, let me conclude on, you know, can we do something about it? And I'm actually not really sure this is properly kosher, but, you know, this is just one idea. I think one thing that you could do is to just say, okay, let me take the same VAR as I had before, but I'm going to add the kind of the tail of GDP to this VAR in a way which is going to load on fast macro and financial variables and contemporaneously on the shock. So what this system basically is telling you is that you could say, I'm going to estimate directly the impact response of tail realization of GDP on the shock. And this gives me the impact response of monetary policy on tail risk. Then I could use this estimated matrix, you know, transitional matrix, you know, like in VAR, to work out the dynamics of this impulse response that Andrea showed me. And this, to me, is kind of a more internally consistent way of thinking about the problem. And even if you were interested in knowing which of the financial vulnerabilities, what of the financial vulnerabilities matter in understanding the transmission, you can actually shut down, you know, one of these lines in the transition matrix and see what's the counterfactual response of tail risk once you shut down, you know, risk sentiment or whatever. You know, now I just have one F, but you could have more Fs if you want. So this is one option. Another option which is probably a bit more sensible, I think, because I'm not quite sure whether you can actually do this, but you know, we can talk about this later. I didn't have time to think about, you know, how this kind of tail distribution interact with the dynamics. I think it's a complicated problem. Another way to do this, which would prevent this kind of link between autoregressive coefficients and tails, would be to run a simple local projection, but local projection of the quantile local projection, where you regress the tail distribution of GDP growth directly on the monetary policy shocks or a proxy for that. Of course, this will be silent about the role of the different financial vulnerabilities factors, but still it will be interesting to see what comes out of this. I have another comment, but I think, you know, actually Andrea knows about it already. We discussed over coffee, so let me just skip to the end. I think it's a great paper. My take of it is that basically brought some science in this kind of quantification of cost and benefit analysis of leaning against the wind policies, which is fantastic. I also think that the bridging from VARs to quantile regressions is really great. It's also quite tricky, as we've just seen. And I think, you know, there's just room for improvement, which is fantastic for, you know, if you keep on working on these, you know, it's great for the agenda, and I think there's going to be a lot of fun and excitement to work on these topics. So I'll stop here. Thank you.
Thanks very much. Andrew, do you want to respond for a few moments, and we'll take a couple of questions?
Yes, absolutely. So thank you very much, Umberto, for the great discussion. This was really helpful, very insightful. The one thing that comes to mind is this idea of pulling and pushing on a string that we talk about monetary policy. In a way, you're suggesting that since there are other shocks or other factors that might be moving the vulnerabilities indicators, monetary policy may actually not have that type of uniform effect. And so, like, looking at the exact direct effect of monetary policy on the tail risk maybe interacting with vulnerabilities and the state of vulnerabilities would provide more insights. That's kind of how I'm reading your comment, and I'd love to talk more about this. Absolutely, we started doing something like this and looking at the time-varying state-dependent effect of monetary policy shocks, and actually having quantile regressions of the vulnerability factors on the shocks themselves. And we see that actually monetary policy shocks affect vulnerabilities more during downturns than they do during booms. And so in a way, there's definitely more in the dynamic of those series that is not uncovered necessarily just by the monetary policy shock. Yeah. But thank you very much.
Excellent. And a few questions, please. Gulcin? Down here in the...
Thank you very much. So, Gulcin Özkan from King's Business School. My question is about costs of not leaning against the wind, right? So, your result about leaning against the wind being more costly, I think this was pretty much conventional wisdom before the global financial crisis. The argument central to that was, what if there is a financial crisis, we could always clean up after the event. But we subsequently understood that cleaning after the event was very, very costly and probably prohibitively costly. So a full quantification of this would require quantification of that cost as well. I think, I'm not entirely sure, but I think you are doing that in terms of the changes in output, so that's the aggregate cost, but there were also very significant distributional costs. Mm-hmm. In the case of the UK, there is now empirical work relating that to the fiscal austerity and the Brexit. So costs were really immense, and that should be included in this kind of analysis.
Mm-hmm. Yes, absolutely. Do you want to collect more questions?
No, go for it.
Absolutely. There is, I mean, to the extent that we can, through these financial vulnerability factors, predict the quantiles of GDP growth, then we're using realizations. So in a way, we're using data as it unfolded. So those costs, like those opportunity costs of having done something, they're not going to be accounted for. However, if we're thinking about limiting the damage by means of interest rate policy, that gain seems to be relatively small, just by the pure effect of interest rate policy on output. If by keeping interest rates higher, slowing down credit growth, and moving that tail risk for output growth up by 0.2 percentage points for a number of years, will bring the not realization of the financial crisis that is questionable. As I showed you, the indicators of vulnerabilities still moved up to very high levels, even after a surprise monetary policy tightening. So a crisis can still happen. Maybe it's a less extreme crisis, just by a little bit. The point is, if this is the right instrument, and instead we should be focusing again more on macroprudential and other types of regulatory instruments to avoid those events.
Okay, so given I think we have to change the David? Absolutely.
Just picking up your last point, so you mentioned macroprudential policy. So you mentioned macro-pru. I guess my question is, what we'd really like here is some, extension of the work you've just shown us, but also extended to macroprudential instruments. So, what would a countercyclical capital buffer impact, look like in this space, or the imposition of a loan-to-value requirements? Now, I know we haven't got those things in the data, but you do have bank capital in your series. You've got some mortgage debt indicators in there. Mm-hmm. I wonder if you could even do like a crude back-of-the-envelope calculation to see, would that come out positive net present value?
That is definitely on the list of things we want to do, together with the identification maybe of some of the other structural shocks in the background here. As I was saying, that growth factor, factor one, is not necessarily just the growth factor, and there are actually some indicators of financial balance sheets vulnerabilities that map into it. to the extent that we can define, for example, like a shock and supply, shock to the demand or supply of bank capital within the model, then we might be able to engineer something like that. We haven't done it yet, but yeah. Thank you.
Okay. So I hesitate to move on without asking Nina if she wants to say anything, but probably sick of it by now, I imagine. But yeah, exactly. I'm sure, exactly. Well, I'm glad we had such a great session, and we also had from Sarah a really nice revision session as well on bond pricing that will be useful in the panel that's coming up. So hopefully we can all get back there promptly and learn some more. Cheers.
So welcome back for our first panel, the panel of the first day. I am really delighted to introduce this panel on monetary and fiscal policy interactions. I mean, the topic is really kind of crucial to the topic of the conference, which you know, is the role of central banks in a transforming world, and given the current conjuncture of you know, large debt burdens in most economies and big central bank balance sheets and inflation rearing its head, this is really something that we definitely want to think about. So I'm gonna, you know, this is it for me. I just want to hand over the floor to our really distinguished panelists who do not need any introduction at all. So, you know, we'll have Jagjit Chadha, who's the director of the National Institute of Economic and Social Research, who will chair the panel. And our panelists are Hanno Lustig, who is the Mizuho Financial Group Professor of Finance at Stanford University, Ricardo Reis, the Phillips Professor of Economics at London School of Economics, and Silvana Tenreiro, who is also professor at the London School of Economics, but is also an external member of the Monetary Policy Committee of the Bank of England. And so without further ado, I give the floor to you, and I look forward to the panel. Thank you very much.
Thank you very much, Francesca. I love it when someone does your job for you. It's absolutely wonderful. An absolute pleasure to be here this afternoon for lots of reasons, not only the distinguished panel to my left, and also the discussion we're about to have. But I have to start with the lovely observation that the weather has been absolutely wonderful today. England have won a test match with one of the highest ever fourth innings run chases in their history, and the winning runs were scored by 2 Yorkshiremen. It just doesn't get better than that. It just does not get better than that. Absolutely wonderful to start with that. I realise very few of you may know what cricket is, but there we go. Nevertheless, I'm going to enjoy the moment. But I say that purely because in the same way that these 2 Yorkshiremen mastered the field of batting, we have 3 people here who master monetary economics between them, and it's an absolute pleasure to have each of Hanno, Ricardo and Silvana here today. I think the only thing that Francesca missed was I think you're also president of the European Economic Association.
I was.
You were. Okay, forgive me. A little bit out of date on that. But I also want to thank, if I may, David Aikman, Rhys Bidder and Francesca for arranging a wonderful conference. The previous session was also quite excellent. I think what we'll do is we'll run through some questions related to the exam question, monetary and fiscal policy interactions. We've been told we must finish in about an hour from now, so with about 20 or so minutes to go, I'd also like to ask the floor for their questions. I heard some brilliant questions in the previous session that are probably much better than any that I can come up with. So please think about those as you listen, and I'll be, hopefully, are there people with microphones to come round and grab people? And when you do ask a question, I'm sure we all know who you are, but just tell us who you are. Be nice to know where it's coming from. I think, just to be clear for Silvana, I think there's probably press in the room as well, so yeah, so you know that as well. So behave yourselves, I think is the appropriate response when the press are around. So the first question I have is to the panel, but we'll take it in order. We'll start with Hanno, go to Ricardo, and then back to Silvana for the first question. I'll try to randomise it as far as I can. And so the first question is, what have you learnt about monetary policy as a result of the COVID crisis? And I'm going to ask you to answer that in a couple of minutes only.
Okay, great. Well, thanks for having me.
Not at all.
I think, you know, speaking personally, what I've learned from the past couple of years is that models we work on in academia and economics really matter more than I thought in central banking, in the following sense. Central bankers aren't really born knowing what the right model of the world is. They're, like the rest of us, sort of trying to learn what the right model of the world is. And in a way, they're kind of groping around in the dark, learning from new data. And what we've seen in the past couple of years is sort of a robust change in the model that central bankers were bringing to bear when they're thinking about these questions in light of new data, understandably. And I'll talk mainly about the Fed. So the Fed, in 2020, sort of had a reevaluation of its policy framework, and they they basically sort of signaled that they thought that in the past they'd perhaps stepped on the brakes too quickly, and that they'd made mistakes just looking at their econometric models, and that they were going to try and avoid that in the future. And so they signaled that they'd be willing to let inflation run above target for longer, that perhaps they'd be willing to let the unemployment rate go lower for longer. And they were also sort of changing the terminology. Instead of talking about deviations from the natural rate, they were talking about shortfalls of employment from the maximum rate. So there's really a robust change in the view, in the policy view, in the model, the reference model that the Fed signaled it was going to use. And that reminded me of a book that Tom Sargent wrote on the conquest of U.S. inflation and the inflation in the second half of the 20th century. And this is exactly the narrative he tells, one in which policymakers, unlike in sort of the neoclassical rational expectations paradigm, they're kind of trying to learn what the right model is, and he thinks that's the right narrative, not sort of the Lucas narrative, where they just sort of happen to know the right model. And Sargent concludes his book, which I think is sort of prophetic, by saying, I hope I'm wrong about this, because if this is the right way to think about central banking, if they're sort of constantly trying to tweak their model in light of new data, then of course the danger is that at some point they'll be convinced that in light of new data that there's a more favorable trade-off between inflation and unemployment. And then the conquest of inflation will sort of prove to be transitory in some sense, right? And I think that's partly what happened. So what I take away from the past 2 years, and I'll round up, is that that there's a lot of drift in models, which I wasn't really fully aware of before that, more than I thought. And that's perhaps another reason why we should sort of think more, we used to think about this, but think more about rules versus discretion, but from this new perspective, not just in terms of central bankers who sort of know what the right thing to do is, but they can't bring themselves to do it. They're always tempted to do something else, but just central bankers who occasionally wander pretty far away from the right model. And by the way, I'm not claiming that I would know what the right model of the world is, but it does seem like we've ended up in a place where we're pretty far from where we ought to be objectively in terms of, for example, where interest rates are, where inflation is, say, in the Eurozone, to take one example. I'm from Belgium, inflation rate's 10%, and interest rates are stuck at 0. I'm not a historian, but I think that's almost unprecedented. So we're kind of at a pretty remarkable place, and the question is, how do we get here?
Thank you very much, Hannah. It's a drift. Drift is the summary of that, I think, and it'll be interesting. It's not, of course, unprecedented, unfortunately, but it is something that we'll have to wrestle with. Ricardo, what have you learned about monetary policies?
I would start a little bit just like Hanno started by looking at the mission review. I think when the Fed and the ECB, not the Bank of England because it does so more regularly with its remit evaluations, but the Fed and ECB had this very clear, let's think about how we would do things differently now from 2020 roughly onwards. 2020 was around the ECB. And I think a unifying thread in those mission reviews, and one that really permeates across the different dimensions and suggestions that come from that, is a belief that we live now in a world that I will summarize as a low R-star world. Why? Because not only that was used intellectually to support the mission reviews, but because it really pervades the whole mission review. For instance, pick the 2 points that Hanno made. A desire to have positive deviation of inflation from target on an average. Why? Because in a low R-star world, the fear was that we'd be stuck in a deflation trap. Given that deflation trap, we want to promise to have high inflation in the future to escape those deflation traps. Or that we should start looking not at maximum employment, but have a broader view of it. Well, because if you're at a zero lower bound, you're in a secular stagnation world where demand is well below repressed oversupply, so all multipliers are very big, whether it's monetary or fiscal policy. Generally, this fear to deflation trap, these large multipliers, more generally to a tolerance of inflation, which again permeates emission reviews, where the real fear is that inflation is too low. Having it high, good thing. And so you see, I think that when I look at the policy, let me be bold, mistakes, or at least some of the options in 2021, they reflect this. When inflation is rising, good, that's to be welcomed. It won't go much higher because we can always bring it down. Bringing it up, that's what's hard. Inflation going up, great, that's coming with a very flat Phillips curve. We're going to get huge multipliers out of this. Deflation trap is in the past, wonderful. Even if inflation goes to 4 or 5, that just is a conquest. And if anything, not to worry too much. After all, we had inflation at 1% before. But of course, the 4% high inflation became 10% high inflation. The multipliers disappear. The Phillips curve turned out vertical very quickly. And in the end, what it seems is that this low R-star world was maybe not such a good describer of, I think, the data. It's certainly not a good describer of the world the last 12 months, and points to perhaps what led to both the cause of some of the events of the last 12 months, as well as some of the barriers that we're having in reverting that. So what did I learn in the last 12 months? Low R-star, ZLB papers. I see some people here who have written some wonderful papers. They're great intellectual exercises, but maybe we believed in those and falling on hard. Now, maybe we believed those models just a little bit too much. They weren't quite as good guides for policy as they could have been.
Okay, so our view on our star may have to be revised, it seems to me. Give us a whole bunch of new papers to think about, I think. Savannah, what have you learned?
Over the last couple of years, I'd like to highlight 2 lessons. First, how temporary sectoral reallocations can have very large aggregate effects. And second, a little studied channel for policy transmission was very important in the policy response, namely the effect on both demand and supply of firms' cash flows. So let me elaborate on that. The first large effects from sectoral reallocations is, of course, not new, but it wasn't as present in the debate until COVID. The key economic feature of this crisis has been its unevenness. It affected some sectors far more than others. Big picture, we saw an enormous rotation in demand away from consumer-facing services and towards goods sectors. This increase in demand for goods ran up against supply capacity constraints and transport disruptions that caused a very sharp increase in good prices. And this increase in good prices was not matched by commensurate falls in services nominal prices because of downward nominal or price rigidity. So these very large reallocations with very large effects on relative prices can be inflationary in the short term. This large rotation in demand has reversed now in many countries, but the story in the US, which is the most important from the perspective of global goods demand, is a little different. The fiscal boost in the US has been larger than in other advanced economies, and this caused an absolute increase in goods spending that was far larger than in other economies. On top, of course, of the relative rotation. And in addition, the re-rotation back to services has been much slower in the US than in other advanced economies, certainly in the UK, for example, where we are almost back to normal. So bottom line, it's imperative to understand these global sectoral reallocations. From the UK perspective, it wasn't so much about the domestic reallocation, but really about this global phenomenon and understanding how this increasing US demand for goods meeting restricted supply push up on tradable goods prices, of which the UK is a net importer, had a big effect on the economy. The second lesson is important role for policy of corporate cash flows. When there is such a large fall in spending. The initial health response consisted of closures of firms or even entire sectors driven by either mandated or voluntary social distancing. Absent cash flow support, many firms that had viable business models before COVID and were perfectly solvent would have been compelled to close down for good. And this would have left scarring in the economy and hysteresis, affecting the future supply of capacity of the economy beyond the acute phases of the crisis. So cash flows and policies that support cash flows during this deep crisis are important to prevent sustained falls in supply. But let me just say one thing about reacting to what Hanno said, how we got here. I mean, it's not that we like inflation. I mean, it's that we have been shocked by the biggest shock imaginable, because not only was the pandemic, but then there was the build-up to the war itself, and new waves of COVID affecting supply in many parts of the world. So clearly, this is an unprecedented period in terms of the shocks. And models, they don't predict shocks. This is why they're called shocks. And these are not anticipated. These are deviations from the model, from the models. And I think that's a big part of the story. But I agree with Hanno on the essence that our models can be improved. And I think one lesson, which is the one I'm emphasizing here, is that opening up and not working with an aggregate output, but rather looking at the sectoral composition is very, very important to understand inflation dynamics and the evolution of activity.
Okay, so we're inching towards a comprehensive sort of analysis of the recent trends. We've had some drift in central bank thinking, possibly some mistakes about our style, but an enormous churn and rotation in the supply side of the economy, as well as clear sectoral impacts that are working their way through to add to inflationary pressure. Some discussion that this might be unprecedented. I question whether it's unprecedented, and we can find examples from the past that might match the current circumstances to some degree. But I wonder, and maybe I'll start with you, Ricardo, is that a sufficient set of explanations for the current inflation overshoot that we're seeing, or is there something else been going on as well?
I think there certainly may be more things, and none of us was trying to be exhaustive. I think when we look at the causes of the inflation right now, let me anticipate right away, even as that debate is starting, there's going to be, I think, fundamentally three camps.
Okay.
And when I say three camps, I mean because it's going to be hard to reject either of them, and one can take three perspectives. Perspective number one, there were lots of bad shocks, unprecedented shocks, nothing we could do about it, inflation went up. I think there's certainly a lot of truth to that. However, our institutional regime of the last 25 years, which I understand as independent central banks with an inflation target controlling interest rates, is predicated on the belief that the central bank can offset shocks and keep inflation in control. It may not wish to do so, because it may want to trade off inflation with other parts of the dual mandate, but it can do so. I like the analogy where if you ask whether my head got wet in a typical London day, not the atypical one like today, certainly the shock of whether it's raining or not matters, but I have an umbrella, and I either chose to open it or not open it, in whether my head got wet and my hair got wet or not. In other words, there are shocks, but there's also policy responses to it. Now, I therefore, on this first camp, on the it was only shocks, I think it avoids the question of, but why did we not respond in certain ways? And it may just be that we could not respond, it was really very hard. But if you go too far in the it was shocks, then you ask, then why did you control inflation for 20 years, and why do we admire independent central banks so much? Well, maybe it's just because you got lucky and you had good shocks, so you really don't deserve any of the credit of all central bankers writing autobiographies about how they saved the world and kept inflation under control. As well as, moreover, then, are we going to have inflation control next 5 years? Well, who knows? Tell me what the shocks are. So then the whole edifice of inflation targeting central banks gets at least a little questioned. But that's, I think, one camp. Camp number two, we got lucky in a different way. The current regime was unsustainable. Inflation targeting central banks, really, it's all driven, let me give an alternative, by fiscal policy. Fiscal concerns ultimately drive inflation, as in fiscalists or fiscal theory of the price levels. And then it just happened in the last 20 years. It was a coincidence that we had inflation targeting and independent central banks delivering inflation. Maybe, again, I can't reject that. I think there's reasonable views to see that. We're going to see in the next few years. I tend to think that's not the case. I don't think it was a coincidence. But you would say that it was really the shift in fiscal with the increase in debt, the pandemic, that has led to this. Then there's a third camp, which would say, no, the way we think about monetary policy in modern models is correct in terms of Taylor rule, independent central banks can control it. Yes, there are shocks, but one can respond to them. It's just that we maybe used models that could have been improved, misestimated states of the economy, made some mistakes in there, or made proper choices that said, given the very strange set of shocks, the optimal response was to let inflation rise to 8% or 9%, as long as it's very temporary and it will be brought down. I'm much more on this third camp. I think, in a sense, central banks allowed inflation to go up because they thought it was the right choice to do, subject to, of course, control. I mean, allowed meaning, I don't mean literally to the point. And so I tend to go on the third point, but maybe I'm just showing my conservatism in thinking that the last 25 years were indeed a golden age of central banking that will deliver, and fine, there were some issues now, but that we will fix. So I think ultimately I would say judges on these three camps, and here I'm trying to be much broader, following your question. I think then you can put different arguments here, and for sure it's going to mix some form of mix of all three. But I think more important is the debate on which ones these are, because I think that will determine the extent to which we want to change over the next 5 years the policy regime we've had.
Yep.
I think that the policy regime of inflation targeting, independent central banks, setting interest rates, is the best one we've ever had. I think it's a very successful regime. I look at the last 20 years and think it was in response to shocks, good policies. Fundamentally, that was fine. I think we'll go back to that. And I look at the last 12 months as a mix of some misdiagnosis, some mistakes, data revisions, difficulties, combination of models, shocks that were unprecedented, some response to those, but that will be answered in the next few years.
Thank you very much, Ricardo. Silvana, when we met and discussed some of your work at the Dow lecture earlier this year, it was clear, not only from your work but others, that central banks in principle could have responded in a way to stamp on the inflation that we saw, but it was also clear that had they decided to do that, it would have led to tremendous output volatility and loss of employment and an increase in unemployment that, I speak from my perspective, may well have been inequitable given the COVID crisis that many of us had lived through and the impact on those in more precarious jobs. So I don't have to revisit that debate particularly, but is this kind of analysis one that you still subscribe to, that we're seeing a period of overshoot that it is right to smooth and look through wherever possible rather than responding to fully?
Okay, so I'm going to speak from the perspective of an MPC member.
Of course.
So we have a clear remit, and the remit says, asks us to get inflation at the 2% target. But the remit is also clear that, one, at times inflation may depart from the target temporarily in response to shocks, and two, when large or persistent shocks create a trade-off between inflation and output stabilization, we need to balance that trade-off subject to returning inflation to target in the medium term. And the medium term is understood as the policy horizon of 2 to 3 years. So that's what our remit says, and at all times we've been setting policy in line with that remit, which has been framing the decisions. Now, both of these things happened. We have been hit by new, very large shocks, which we didn't know about when we were setting policy 1 year or 2 years ago. And we have also faced a very large trade-off, as you said, Judge. It's such that even if we had known about those shocks, perfectly offsetting their inflationary impact so as to hit the 2% target this year would have generated an enormous recession. And most important, medium-term inflation would have been below the target. So the clearest example of a new shock is the large increase in energy and commodity prices that we have seen. Commodity prices, commodity price fluctuations are very volatile and unpredictable at the best of times, let alone when they are driven by a war, as was the case with the most recent step up in prices. And so for that reason, we at the Bank of England don't try to predict those prices in our forecast. We condition on a broadly flat path for energy and commodity prices. So these movements are a new shock. And again, repeating what I said, our models are not trying to predict shocks. What they help us with is to understand how those shocks propagate through the economy once they have happened. And with that, we can, it can help us with our monetary policy decisions. Now, the rise in energy prices added, of course, to the inflationary pressures coming from other shocks caused by COVID, and specifically this uneven recovery of demand, slow re-rotation back to services, which have kept these tradable goods prices really high throughout this period. Again, we were not trying to predict COVID, because the evolution of it depended on virus mutations and the responses of governments around the world. We were trying to respond the best we could to return inflation to target, to the 2% target, again in the medium term. So in sum, we have faced very large shocks, and we need to respond, and this is our role, by bringing them inflation to target in our policy horizon. Now, but to add to that, and Jack, you were referring to that in my speech back in February. I asked the hypothetical question. Suppose we had known in advance that these shocks were all going to happen. What would it have taken for monetary policy to achieve the target early this year? And the answer was an enormous tightening of monetary policy in the middle of the pandemic, which would have taken unemployment into 2 digits. So that was the trade-off. And this isn't a question of, okay, should we have raised rates a little earlier, November, December, or even 6 months earlier? That's not the question. That wouldn't have much of a difference for the peak of inflation that we're seeing now in most advanced economies. It would have shaped just a few basis points. And importantly, anything that would have made a material difference for that peak would have meant inflation well below target in the medium term, again, against our remit. So even if it had been possible to predict the perfect evolution of the pandemic, energy prices, the build-up to the war itself, the international policy response to the war, and so on, I would not have seen it in line with our remit to have struck a materially different trade-off in response to what is largely, in essence, a temporary shock. For me, any serious case for a substantially different policy has to address the trade-off. How much more unemployment would have been required during the pandemic? Within that, how would that have played out when you have, in the case of the UK, a furlough scheme which was designed to prevent unemployment? So it meant that the monetary policy mechanism wouldn't have worked as always, because you couldn't generate unemployment, which in turn is what feeds into lower wages and domestic price pressures. But more importantly, what would have been the effect on medium-term inflation if you had offset that peak through a massive recession? So I think, these are important questions, and obviously, it's a difficult time for everyone, but we have to acknowledge the sort of the challenge that we're going through. These shocks these are not small disturbances in the models. These are really unprecedented.
They're certainly huge shocks, absolutely, and it's very helpful to have that thought process worked out, both in real time as you approached it, but also to imagine as if we did actually know the future, which we can never know what we might have done. I think it's a very helpful exercise.
Let me add to that, that it's important, the quantitative question, because you can always say, oh, you could have tightened earlier or a little bit more. So give me the numbers, and then we can compare notes.
That I understand. Thank you very much. Hannah, I wonder if I could ask your perspective on how the Fed has approached this same issue. To what extent, we've already heard that obviously it plays a critical role in global monetary conditions. So to what extent is it more culpable than what we might think of as a semi-small open economy?
Right. Well, obviously the U.S. is extremely important. If I were to single out one actor, though, in the U.S., I would single out first the federal government. As Silvana pointed out, they spent more than a fifth of GDP. They weren't very careful about targeting their spending. That's partly because the transfer payment system is not as well developed in the US as it is in Europe, so it's just hard to get the money to the people who need it, but they didn't really try. And I think there's little question that 1.9 trillion package, the last one, was probably enough to tip output over potential output. And the fact that inflation subsequently went up in the rest of the world, that doesn't absolve the US, obviously. That's like saying if an elephant and a mouse jump in a pool, that they're equally culpable. Obviously, the U.S. Deserves a big share of the blame there. I think there was a lot of fiscal stimulus applied. But then the question is, why did the federal government think that they could just spend a fifth of GDP, whereas in Europe, most countries spent less than half of that? Well, I think it's partly the transfer payment system. But, and this is where I'm going to get to Ricardo's R-star point, I think it's partly because a message has been sent by central bankers that R-star is just extremely low, permanently low, and I think some people in academia have also sent that message. We're in this new era of permanently low real interest rates, and a signal's been sent to governments that they can go ahead and spend, and that their fiscal capacity may in fact be unlimited. I don't think that those predictions will stand the test of time. I think we'll come to realize that fiscal capacity is actually extremely limited. But I do think that those messages have made governments more willing to spend and less careful. And I think in the US we were particularly careless. The federal government was handing out money to states who subsequently used it for tax cuts. So, but to your point, I think the Federal Reserve, in sending this message, I think the new R-star estimate now that they arrived at just before the pandemic is 0.5%. So you're telling people that the equilibrium real interest rate at the short end of the maturity spectrum is 50 basis points, and that they can sort of bank on that. That's, I think, in retrospect, that wasn't necessarily the right message. Why not? Well, first of all, what you're looking at is your own shadow if you're the Federal Reserve, because of the decade preceding this, what they've been doing is really drastically interfering in fixed income markets, not just a little bit, right? I mean, to remind people, for example, during the pandemic, the Fed bought more than issuance if you exclude T-bills. The ECB has done something quite similar. So these are not small interventions. That makes it awfully hard to know what our star is. If you're looking back, you're looking at a moving average of what you've been doing. You can use all sorts of Kalman filters, but you're really tracing out your own shadow. And I think what we've seen in the past couple of months is that when the Fed signals that they're going to take their foot off the pedal, then real rates go up quite a bit. And so one lesson I've learned from this is that central bankers aren't very good at really figuring out where these valuations, especially of longer maturity assets, where these are, because they've been really putting their finger on the scale in a big way. And that's part of the danger of quantitative easing. At some point, I think, you lose track of what the market's thinking and where their marginal valuations are. And then when you pull back, you see that, for example, the 10-year TIPS yield in a few months went up by 180 basis points in the US, 200 basis points in Germany. They've come down a little bit now. But those are, by any standard, drastic movements.
Just a follow-up, if I may, and then I'll actually go into the next topic, but I'll allow you to answer first, and then we'll go around. But to what extent has the inflation averaging regime contributed to the problems and interacted with fiscal policy to make things worse in the US, or do you think that's not been terribly important?
Well, I think it is important in the sense that, and actually Tom Sargent wrote an op-ed on this topic in the Wall Street Journal a couple of weeks ago, in the sense that before the idea was basically to act preemptively. If you thought that inflation was going to be a problem, you would step on the brakes, and clearly that's not what they did in this case. I think that is consistent with the idea of average inflation targeting. I have to confess that I don't completely understand exactly what they have in mind because they haven't been super clear about what it is they have in mind. But certainly, again, in retrospect, and I should say, by the way, we have a saying in Dutch that the best sailors are always on the shore, and I'm definitely one of those sailors. So you should take everything I say with a grain of salt here. But I do think that in retrospect, that probably wasn't a great policy change.
Yeah. So related to your point about the huge interventions in QE, and they've been similar in this country, some 35% of GDP is held as bonds at the asset purchase facility. To what extent has this blurred, in an unhelpful way, the lines between monetary and fiscal policy? It just seems to me, listening to you and Ricardo in particular, there seems to be some interaction that's making it very hard to get us into the right space because of what fiscal policy has done, knowing what monetary policy will do, and what monetary policy has had to do to try and help the fiscal policy makers. Are we in the wrong subspace now?
Oh, I think so, most definitely. I think the best example of this is the Eurozone. Right. I think the ECB has probably painted itself into a bit of a corner because now that they've signaled that they want to end quantitative easing, they've seen interest rates go up quite dramatically in some of the peripheral countries. And that, of course, presents them with a dilemma because they understand that interest rates where they are now, that's completely inappropriate given where inflation is, right? If you use some sort of Taylor rule, I know I sound old-fashioned when I talk about Taylor rules, but if you were to use a Taylor rule for the Eurozone, you'd probably say interest rates have to be somewhere, is it 700 basis points higher? And that's not very likely. But even before we've started to really raise rates, you see interest rates in the periphery go up. Now, of course, that's not surprising because the ECB has signaled to Eurozone governments that they had their back. And they've provided easy financing for these governments. And these governments have acted on that, as I would do the same thing if I was a politician. That's not a huge puzzle. And so now, of course, the problem is, where does the ECB go from here? That's not at all clear. They try to muddy the waters, in my view, by talking about fragmentation. I don't really understand what they mean by that. Look, you know, if you have claims to cash flows with different risk characteristics, they're going to trade at very different prices. The notion that the market's wrong and that the ECB is going to have to step in and correct these market misperceptions, that seems like a huge stretch to me. Central bankers don't have a great track record of correcting market valuations. That tends not to work. And so, honestly, I think they have gotten themselves into a bit of trouble there. Yeah. I hope I'm wrong about that, by the way, because I'm a firm believer in the European project.
We all hope, but nobody wants to see further disasters, that's clear. Ricardo, anything add on the monetary fiscal mix or the interaction between monetary fiscal policy having been blurred in a really difficult way in the last decade or so?
Let me add 2 points going back to a previous discussion on whether central banks were behind the curve or not. And I'll comment on the Fed and ECB, not the Bank of England. But I think the Fed, it is my view, and I think if one looks ex post at the data, was somewhere like 6 months behind in raising interest rates and tightening policy. I think just the fact that they're doing it so quickly now is as much as an admission, and that's the case. I think history will say that we may disagree, but whether it was 4 months or 8 months, but certainly 6 months in starting to tighten it. Why was that? Many reasons. We've already talked about some of the shocks and so on, and the reactively versus proactively. But it was certainly, I mean, as part of the discussion, it wasn't that long ago, so I remember it a little bit, was the fact that there was this perception that first, there was a sequencing of policy. First, you announced that you're going to stop QE. Then you actually stop QE. Then you start QT and raise rates. But you have to follow that sequence. But of course, whenever you want to stop QE, you worry how the markets will react. And so you hesitate for at least a couple of policy rounds. And this QE seemed to serve as a constraint to raising rates faster. That was responsible for maybe a couple of months, maybe even 3 months, that is half of the delay that the Fed did. So here's an example in which QE did seem to constrain things. My own view is that I do not see why one has to follow the sequencing act. I see no reason why I can't raise interest rates aggressively, even as I'm doing QE per se, insofar as QE is operating on the length of the yield curve, and after 10 years, and insofar as tightening policy to fight inflation comes exactly with inverting the yield curve, having short-term rates rise very fast, even relative to long rates. So I don't see why we had to even stop QE, and this is especially present when it comes to the euro area. But it did play an important role in doing so. Second, when it looks at ECB, which is how far is it, how delayed it is, to be seen since they haven't raised rates yet. So I think we're going at least 5 to 6 months now, maybe more, since it won't be aggressive. And there comes some of the issues that Anno was raising, which is a real fear of fiscal dominance, a real fear that a much too fast increase in interest rates would cause a sovereign debt crisis. I think that's a legitimate fear. In no way should I say that one should not be worried about that. But it is, let's call the bull by its name, it is fiscal dominance. If you're afraid, if you see, if inflation is 8%, you're not raising interest rates because you're afraid of what that will do to a sovereign debt market, that has a name in economics. It's called fiscal dominance. And the extent to which that is still a work in progress, and indeed they haven't raised interest rates, having to do with, no, first we're going to announce what to do about rates, how to combine stopping in QE with buying at different rates. It's clear that this has served as a constraint to raising interest rates. There's many other dimensions of fiscal monetary interactions. I've written about them, but just to keep it short, at least in these two, it does seem that QE led to a delay in raising rates in a way that, at least given inflation, was, in my view, undesirable.
Thank you, Ricardo. Would you like to add anything on monetary fiscal interactions?
Yeah, on the blurred lines, which was your original question. I think we have again to acknowledge that we're both fiscal and monetary policy, we're responding to the same shock, a huge pandemic shock, and it's natural that they would move in the same direction. And that got many people confused. Okay, is QE happening when the fiscal expansion is happening? Yes, because they were both responding to a common shock, and that's what we teach. Monetary and fiscal policy try to offset these shocks, and it's natural that they move together. So the blurred lines, I think now when the unblurring will show up, because monetary policy, certainly in this country, has been tightening. The QE portfolio has been shrinking, and so there's a clear split there in the movements. So on QE more generally, the way I see it, the main channel through which QE affected the UK economy during the pandemic has been through the liquidity channel, offsetting market disruptions, particularly in the March 2020 episode. And then subsequent rounds were helpful in preventing a recurrence of those episodes as new COVID waves struck and there were more supply issues popping up. So in that sense, given that the role of QE has been mostly in offsetting liquidity disruptions and preventing further liquidity disruptions, I would expect the effect of the unwind of QT in the UK, to not have a material impact on the economy. And so far, our experience with the beginning of the shrinking of the portfolio is consistent with that. But obviously, QE here has been different from other districts.
So just to follow up, so you see QT proceeding as a runoff over time.
So, well, as we
there'll be a report coming out next month.
Right. So we will be in in August 2021, in the monetary policy report, we already said that we expect bank rate to remain the main instrument to determine the policy stance. And we would expect, again, any QT that happens gradually and predictably in well-functioning markets to have a smaller effect than QE. And I think that's the basis of the thinking. We haven't decided on the unwind yet, but that's what we are studying now.
Thank you. I look forward to that further. Just briefly, and then we'll turn to the floor. How do you see QT working its way through in either of the ECB or at the Fed in a similar way as a runoff, but the bank is going to be publishing its new thinking, I think, next month.
I'm going to come back to the fiscal constraints there. I do think that the fiscal constraints are real even in the US. So if you use the analogy of the 1980s, so when Volcker came in, hopefully this is not a recurrence of the Volcker episode, but when Volcker came in and he dramatically raised real rates, obviously. And the thing to realize is that when he did this, the debt to GDP ratio in the US was 25%, and the US was running primary surplus. The debt to GDP ratio now, we've talked about, is well above 100%. If you were to raise R above G persistently, even 100 basis points, that would be extremely costly. And I do think that we have to at least consider the possibility that the reason the Fed, even back in March of 2022, was still projecting real rates for the next 2 years below 50 basis points. Some people call this the immaculate disinflation hypothesis. I think that might partly reflect the fact that people on the FOMC understand that there would be a lot of pain involved if they raised real rates dramatically, given the fiscal situation. I think this is a slow-moving state variable. Well, it wasn't slow-moving in the past 2 years, but it typically is, and it looks very different from where it was in the 80s. So you could ask yourself, could Powell do what Volcker did? And I'd say that's not so clear. That would be extremely painful.
No, it'd be very unlikely for Powell to do what Volcker did, even without that situation, I suspect.
Yeah, I agree with that. Yeah.
Let me push in the opposite direction, also to make the panel more interesting.
Yeah.
But talking about Europe.
Yeah.
Italy. We talk about Italy. Debt to GDP is 150%.
170.
150, 150.3, I think.
Are you sure?
Yep, 150% is debt to GDP in Italy. 150%. Imagine, but only a third of that is due in the next 2 years, approximately. So roughly 50% of GDP. Imagine the ECB raises to fight current inflation interest rates by 300 basis points. Why 300 basis points? Because that's more or less what I think is right. Don't ask me why. Let's go with 300 basis points. 300 basis points over 50% of debt coming due in the next 2 years means that you will have at most an increase in 1.5% in your interest spending. It's much less than that, because some of the debt coming due in the next 2 years was borrowed 10 years ago, where interest was actually much higher than the plus 300 basis points that you'd add now. So upper bound, this is going to cost Italy 1.5% over 2 years, where I'm saying 300 basis points over 2 years may be just enough to bring inflation back under control. That seems pain, again. I don't think I'm too far off with 3-4% GDP. But Italy, this year, is benefiting in its 150% of debt to GDP with the fact that the GDP deflator is going to be something like 6 to 7% higher and probably another 4 next year. That means that over these 2 years, Italy will have inflated something like 10% of GDP of its debt. So I'm asking, me, the inflation hawk in the panel, if you want, who wants to control inflation, wants the ECB to go to 300 basis points. I'm asking, give me 3 percentage points of GDP. You've benefited from 10% from the high inflation. I struggle to see why concerns with the Italian debt, purely on fundamentals, would stop us from raising interest rates to lower inflation, which seems to be very much a sticking point in the debate in Europe. Of course, I understand that there's multiple equilibrium. Absolutely, I can understand more. But hold on, if you're going to tell me multiple equilibrium is a reason not to raise rates, not to control inflation, I will throw back at you multiple equilibrium and say, if you don't raise rates and inflation expectations go high, then the multiple equilibrium is that we think that interest rates on Italy at 10 years are 7%, and then we're back to the 1980s, and we'll have 50% debt GDP or unsustainable. So the discussion that seems to have gripped so much of the ECB that raising interest rates is absolutely not will throw Italy into default doesn't completely fit the fundamentals as I measure them. And when you go to multiple equilibrium, then we're welcome to tell stories in different ways. So slightly different perspective than the one Hanno was giving without rejecting, but just very focused on Italy and why this aversion to fight inflation for fiscal concerns may be a little exaggerated sometimes.
Very good. Very helpful to have that interaction. So we have some questions. We'll collect 3 questions perhaps. I can see 3 hands up. Wonderful. That's a good match. Man in blue, Michael.
And the blue.
Yeah, I didn't get the memo of dressing up for today.
Yeah, I mean,
that's okay. academics. Michael McMahon, University of Oxford. I wanted to sort of follow on a little bit from Ricardo's last point and sort of flip the theme of the panel. What would the advice be? And maybe Silvana, you can excuse yourself as you're listed as a Bank of England person here. But what would the advice of the panel be to fiscal authorities right now in an environment where potentially Ricardo's right? The central banks are going to have to raise rates 300, maybe more, depending on what goes on. But in a world where they both face this rising populism and the cost of inflation being disproportionately on poor sections of society, they've shown in the last 2 years they can take large fiscal actions to address such inequalities, and they were willing to do it. And yet they face these sort of slow-moving iceberg-like challenges of climate and demographics that are coming 20, 30 years down the road. I say this, I was going to ask your advice for the Chancellor of the Exchequer. The UK no longer has a Chancellor of the Exchequer because Rishi Sunak has just resigned. But for other countries that do have Chancellors of the Exchequer, what would your advice to them be?
Well, does that mean I can go back to the office now? Well, goodness me, I feel okay. I've been hiding for 3 weeks. Right, that's a great question. Can we just collect up the other two, and we'll get Gulcin in as well, please.
Thank you very much. I'm Ambrogio Cesabianchi from the Bank of England. I have a question about R-Star that we've been talking about, and I'd like to get the views from the panelists on if we were to kind of look through what we think about temporary shocks, is the risk of higher R-Star that we discussed something that you see as a high probability risk of having higher interest rates in equilibrium? Basically, I'm asking you to do a trend cycle decomposition, really. And, it's a dangerous business, but, if we were to exclude the cycle, and if we think about, all the factors that, at least in the academic world, have pushed down on R-Star, things like demographics, a slowdown in productivity, inequality, or the rise of risk premia, which have tended, or at least that's the way in which we think about the secular fall in R-Star in past decades. Those factors, to me, don't seem to be pushing towards kind of a balance of risk that is on R-Star going high. So once we exclude temporary things, the question is, do we still believe R-Star, there is a material risk of R-Star, the trend component of R-Star, to be higher? Thank you.
Take two more questions because I've been told we have to finish shortly. There are prizes to give out to young people, and that's the most important thing of all, it seems to me. We don't want to miss that. And then we'll go to Gulcin for the final question. We'll see if we get there in time. Please go ahead.
Yes, George Selgin from Cato. I have a quick question, mainly for Ricardo, but also for the other panelists, if they'd like to opine on it. And that is whether you think among those factors that may have delayed the Fed in raising rates, the pronouncements made by several Fed officials during the COVID crisis to the effect that they didn't expect to raise rates till 2023 or even 2024 may also have been a factor. That's one question. And the other, it concerns what I see as a kind of elephant in the room. Full disclosure, I'm an NGDP targeting fan, but hearing Ricardo comment on how central banks can't easily blame real shocks forever so long as they've got inflation targeting frameworks that they're committed to. And yet you said that you see inflation targeting, that regime, as the best we've ever had. Silvana, on the other hand, spoke of the important exceptions that the Bank of England has had to make to its 2% inflation targeting remit. And my question is, what about NGDP targeting, which automatically would have central banks see through real shocks and their effects on the price level, and would be a framework that, if it were adopted and explained, would relieve them of the duty to try to suppress inflation when it stems from real shocks? If that's an important qualifier, if it could be explained to everybody.
Thank you, George.
So of course, that's important.
Thank you, George. We'll just collect one more question, and then we'll sort of, you can pick whichever one you want. It'll be fine. Gulcin.
Thanks, Jacqueline. Gülçin Özkan, King's Business School. I'm changing the focus of this conversation a little bit and would like to ask you about climate policy. So I think we are at an unprecedented point in more ways than one, and we are at a cusp of adopting a new policy. There's almost near consensus, not just in advanced economies, but also in emerging economies, that we need now this climate action. So in one way, this changes the way we follow expansionary policy. We can't without worrying about potential for climate, but it might also provide possibilities, much talked about green investment and as engine of growth for going forward. So my question is, at this particular point in time, do you see this as a challenge or an opportunity?
Thank you very much, Gülçin. I think one thread running through those questions is in a sense, the central bank's remit. I suspect some concordance on this panel about inflation targetry. But the questions here were really about, should the remit be broadened? Do we have to take into account other considerations? Should we drop it altogether, go to nominal GDP targeting? How can we encompass the correct move to a green agenda, but within the context of continuing to focus on price stability? Seems to be that kind of sense emerging from the questions, as well as the questions on R-star itself. So I think rather than me directing you to answer, we have an idea of what people want to hear us answer. Perhaps I could just leave you to decide which parts of those questions.
So if I can start from
I'll go first.
Yeah.
Yes.
So I think climate change is obviously the biggest threat we face for livelihoods and lives. But this is a problem for governments, not for central banks, in my view. Obviously, central banks need to be really tuned on, and because we will be facing more recurrent weather-related events, and we need to understand the risks involved, and so on and so forth. From the perspective, and here I'm speaking mostly from the perspective of the Monetary Policy Committee. Obviously, financial policy has a different mandate. But for us, again, we have very few tools, and our primary focus is price stability. The remit guides us when we face shocks that put us in trade-off territory with activity and employment, and on how to return inflation to the 2% target. The remit also asks us to pay attention to climate considerations, and in some sense we do, but it's a very small part of the package. I mean, in our particular case, it enters in the composition of the portfolio of corporate bonds, which is a tiny part of the QE package, really. So we, from the Monetary Policy Committee, certainly are not going to do much to help with the climate problem, which is huge. But I like to stress what Ambrogio said about structural R-star or trend R-star. I think that the structural factors that have pushed down on R-star, as you mentioned, Ambrogio, demographics, lower productivity growth, inequality, incidence of tail risks, they have not gone away. And so that's why I think, trend-wise, that R-star has not changed. Obviously, in the short run, the equilibrium R-star, the small R-star might be higher. But the other issue that I think sometimes people don't realize that it's not that we have this idea of, okay, this is the capital R-star and the short R-star, and we don't look at anything else, and we just go by the star variables. No, we are looking at variables that directly inform us about what are the inflationary pressures. So we are looking at domestically generated measures of inflation, and this gives us a hint of where things have moved, at least in the short run. Again, for the long run, I don't have any reason to believe that the R-star trend has changed materially with the pandemic or even the war. But clearly, their short run equilibrium interest rate could have may have changed. But again, it's not a dominant factor in the thinking. We have so many other variables we're looking at that indirectly speak to those tensions.
Thank you, Silvana. Ricardo.
Quickly, let me start with exactly the R-star just to follow up. I think an underappreciated fact, but one that I hope gets more attention, is that if you look at the returns on capital, either measured directly through national income and product accounts, or if you look at the returns in financial markets at the right margins, BBB corporate bonds, equity including private and venture capital, what you find, and you do this not just for the United States or the UK, but for 30 OECD countries. And I say if, because I've done it, by the way, so I'm about to tell you the answer. What you find is that R star, and I mean the R star that comes out of the Ramsey model, the R star that's the heart of the DSG models that you write, Ambrogio, and I write, the marginal product of capital, the returns on private investment in the economy, has been completely flat for 20 years. So the so-called fall in R star, which has perhaps been over-explained by appealing to demographics and productivity, is entirely a government bond phenomenon. In, like Hanno was pointing, and I'll borrow a little bit from him, in a time in which government bonds have been in a particular strange couple of decades, in the last decade with intervention of central banks, as well as, strangely, with a successful inflation targeting regime that removed for countries like the US and the UK, in which sovereign default, let's say it's very remote, entirely all inflation risk, therefore making government bonds extremely safe. And at a time also in which we've had very large changes in financial regulation that have increased the demand for government bonds for collateral and other things, especially following the global financial crisis. So you ask for a reversal of why R star would go up, but I would reframe it as, will the spread between the R star in private investment and the R star in government bonds revert or not? And I therefore look at factors not like demographics or productivity, but rather to what has made government bonds special. Why will they stop being special? And boy, the fact that government debt GDP is so much higher, that central banks may stop doing QE, the fact that financial and the fact that, especially given the topic of this panel, that inflation risk may be back persistently as opposed to temporarily, may all, yes, lead me to expect that the gap between the two R stars will have changed. And therefore, while I won't be as bold as forecast permanent temporary decompositions, I will say that I am not confident that the government bond R star, the one that matters for public finances, the one that constrains policy actions, may yet indeed be rising, even as the R star that's relevant for transmission of monetary policy, that's relevant for investment decisions, continues to stay flat as a response of non-changing demographics or productivity. So I would draw the very, very strong distinction between those two. And I would think that the factors that you meant that are slow moving affect the other R star, not the R star that the mission reviews are about, and so on. I've called it M in some of my previous work, but that's a terrible, because everyone tells me that's like money.
Yeah, I agree with that. I think actually,
it's different R's.
Yeah, a great country to look at, by the way, if you're skeptical, is Japan. In Japan, actually, the only buyer for long-term government bonds, you can look at the flow of funds to verify this, is the Bank of Japan. Private investors have been selling since 2015. So the notion that you would take those yields to make inference about our star, you wouldn't want to do that, right? Because it's clear that that's not a market interest rate anymore. Private investors are no longer buying bonds at those prices. And I mean, of course, the regime we're in Europe and in the US is different from that in Japan, but Japan is, I think, just an extreme version. So I agree with Ricardo. I'm very skeptical about the low R star argument. I think to some extent the Fed and the ECB, maybe the Bank of England, are looking at their own shadow. Let's see what happens when we stop buying all those bonds. And I think government bonds will be less special, and interest rates will increase significantly, I think.
Let me answer quickly, George. Please. George, I was speaking about the current institutional regime in the last 25 years in a somewhat broader sense. Central bank independence with a nominal anchor, inflation target is the one that we've adopted, and with the use of interest rates as the main policy tool is, I think, what's delivered, and that's the institutional framework I was saying. I do not in any way want to say that we've reached nirvana or the optimum and that we can't improve over the one we've had. We should do mission reviews, change it. Is it better for that nominal anchor to be a strict inflation target, a core target, a forward-looking target, a nominal GDP target? I bundled all of those together in my answer, so I was not as extreme as I may have sounded. I was saying that regime, as opposed to, as I said, different regimes in which I'm thinking here of fiscal dominated, meaning central banks are no longer independent, where instead of a nominal anchor, we go to different, for instance, a monetary anchor, a gold anchor, a peg anchor, which I think is shown. But I'm showing here my lack of imagination by just looking at the past. But I would say NGDP is still within the what I call broad inflation targeting regime of the last 20 years, which I think has worked. And so I don't think I would abandon it. I would perfect it and discuss, should we really do nominal GDP or something else that's somewhat different. And then very quickly, just on Michael, so that he doesn't ignore it. We don't just talk about R-star. Michael, ultimately, first, this issue of R-star, which I'll repeat, which means that maybe the fiscal space is not the same as before. But there's a sense, it's quite striking the extent of permanent drift when you discuss this fiscal policy. We did something extraordinary 2 years ago in terms of sending checks to people to a very large extent, and now that seems to be what is expected, and any deviation from that is seen as something very terrible. We shouldn't be responding to all shocks by sending lots of checks to lots of people that cost a lot, and at some point, there are fiscal limits, and I think we will sooner or later have to discover the fiscal limits. So in the end, the answer to your question is inevitably, if you think there are some limits, that at some point governments do have to use that evil word that's been banished from dictionaries that starts with an A and ends with a Y when it comes to fiscal policy. That was austerity, guys. Yeah. At some point, you do have to at some point run some surpluses. Not just at every crisis, more and more, this requires a deficit, that requires a deficit, that requires a deficit in an endless way. Especially because, and then finally on the last question, on climate, because I do think that indeed we need some serious investments. Those require fiscal commitments, but those do not mean deficits. Investments that are important, that require payments, and either raising taxes or at least cutting a lot of other government programs to make way for the very important public investments that are required towards climate change.
Yeah, but if I may, I sort of agree with Silvana. I don't want to mischaracterize what you said, so correct me if I'm not characterizing what you said. I don't think it's the job of central banks to fix the climate change problem. The ECB on Monday announced that they were going to decarbonize their corporate bond holdings. I don't think the ECB has a mandate for doing that. I think climate change is a real issue, and politicians have to address it. That's how democracies work. The ECB has a super narrow price stability mandate. I read it a couple of weeks ago. There's nothing in there about climate change. I read it very carefully. And that's very important, actually. That's the reason I come back to it. In a democracy, you cannot give agencies authority over issues over which they weren't explicitly given authority by voters, because they don't have a mandate from voters. So I think it's a very bad idea to go down this route, and I think that central banks who do that might, in the long run, actually pay a price for it in terms of their independence. So I'm actually, even though I think climate change, I agree with you, is one of the biggest challenges, I think we should force politicians to deal with it and not have central banks become the default
only game
responsible
in town.
Agency.
It shouldn't be the only game in town.
Excuse me?
They shouldn't be the only game in town.
They should not be. They don't have a mandate for it, and it's not their expertise. And I think
one thing
that's right.
I would think we might believe in is having better politicians than we've currently got. But a lot of people argue you get the politicians you deserve. So it's a very
well, that's true too.
This has been a wonderful panel. There was a recent book written on monetary policy, and the second paragraph wondered whether monetary policy was dull. And let me say the author of that book is an idiot. It's certainly not dull. I love the fact I think about monetary policy and meet experts in monetary policy. I think it's just as interesting and fascinating as people who decide to work on diplomacy or foreign policy or defense studies. It is an area of research that combines quantitative methods, qualitative methods, history, practice, policy, interaction with politicians. It is a worthy source of work for your life's work, and I think it's actually fascinating for me to have sat next to you three today. I've enjoyed every minute of it. I know the audience have as well, but I think it's appropriate for us simply to give our thanks in the right way. Thank you very much.
Thank you.
Ricardo, thank you very much. Excellent panel.
Thank you.
Not at all. Thank you. Okay. I was told to finish at 6:45. Just about done it. That was great. Thank you very much.
I need to run otherwise, because I'm leaving for Portugal in 30 minutes.
Okay, good luck.
Heathrow or?
More complicated than that, but yeah,
Okay.
Okay.
And Churchill also gave a great segue to what our next session,
So
which is just a brief presentation about the, of the prizes. Do you gonna sit up front, guys? You guys gonna sit, sorry, up there in the first row? Okay. And so what we'll be doing right now is to, hand out the prizes for the Young Economist. And as Jagjit was saying, research in the area of central banking and monetary policy, but not only monetary policy, overall the area of central banking is really important and exciting. Our research center aims to, produce and foster research in this area, and the Young Economist Prize is an important part of this endeavor, in which we promote and support young researchers who are producing cutting-edge research in this area. So this year's selection committee comprised Frank Portier of the University College London, Misa Tanaka, who's the head of the research center of the Bank of England, and Martin Wheel from King's College, and also an ex-MPC member. So all the three members of the selection committee were impressed, as were we indeed, by the excellent academic standard of all the shortlisted participants. And, despite them not being able to be here, they really wanted to convey the message that it has been a very difficult choice given how, high quality all of these papers are, and that their choice was really driven mainly by, which papers they deemed were particularly relevant to central bankings and to the issues addressed in this conference. So before we announce the winner of the prize and the two runners-up, I would like to introduce you to our 7 Young Economist finalists. There's a little video for you.
Hello, my name is Hilary Stein. I received my PhD from Harvard University, and the title of my paper is Got Milk? The Effect of Export Price Shocks on Exchange Rates.
My name is Fabrizio Schumodi, and I'm a PhD candidate in finance from the University of St. Gallen here in Switzerland. My research interests lie at the intersection of international finance, asset pricing, and market microstructure. My job market paper is titled Dollar Dominance in FX Trading, and it attributes the dominant role of the US dollar in our global monetary and financial system to its use as a so-called intermediate vehicle currency.
Hello, my name is David Xu. This year I'm graduating from the University of Texas at Austin. I'm broadly interested in financial intermediation. The title of my job market paper is Financial Market Structure and the Supply of Safe Assets, an Analysis of the Leveraged Loan Market.
Hello, everyone. First, I would like to thank you for your consideration. I'm truly honored to have been selected as one of the finalists for the Qatar Center for Global Banking and Finance Young Economist Prize. My name is Ghassan Benmir, and I'm a final year PhD candidate at the London School of Economics. My paper is titled Policy Interaction and the Transition to Clean Technology.
Hello, my name is Fabian Zeirich, and I'm a PhD student at the Free University Berlin and at the German Institute for Economic Research. My paper, which is joint work with Oliver Feutli, is titled A Behavioral Heterogeneous Agent in a Keynesian Model.
Hello, my name is Niklas Schmitz. I am a second-year PhD student at the University of Cambridge, and my paper is titled The Downside Risk Channel of Monetary Policy. In this paper, I argue for the existence of a new transmission channel of monetary policy to equity premia. I show empirically that during recessions, monetary shocks can reduce downside risks to future macroeconomic growth and hence strongly support equity prices beyond any effect on mean growth rates.
Hello, my name is Elizaveta.
I'm finishing my PhD studies at KU Leuven, and I will join NHH as an assistant professor this year. I work in the areas of banking, risk management, and financial regulation, and particularly in my job market paper entitled Banks Next Top Model, I study the effect of regulation that relies on banks' internal risk models and show that this regulation is ineffective.
Okay, so as Francesca said, the standard was extremely high, so we're going to start by handing out a couple of certificates. 2 people not ranked, and then finally David will award the winner. I'd add that today, as I mentioned earlier, we had 2 of last year's Young Economist Prize, who Shahini and Rustam, who are really excellent advert for the prize itself. And I'd also add that yesterday that this year's candidates were generous enough with their time, even after red eyes, to help a new vintage of PhD students prepare for the job market. So all round, they've been a credit to themselves. So let me invite one of the runners up to the stage, Ghassan, Ben Mia, LSE.
Thank you very much. Well, I didn't necessarily prepare anything because I wasn't necessarily expecting that.
Tell us about the job
but
market,
I'll rumble something up. First, thank you to you guys. It's been fantastic. Thanks for the whole conference. And basically, it's really an honor. I'm very happy to be sharing this with all the 7 fantastic candidates. We didn't get to meet one of them, but hopefully we get to meet her at some point down the line. But yeah, nothing more than that. I want to keep you over here. So.
Thank you very much. So our second runner-up is Fabricius Somogri, if you want to come up. I don't know if you want to say it.
Thank you so much. I would like to thank the Qatar Center for Global Banking and Finance for awarding me this runner-up prize, and I would like to thank the conference organizers, each one of them, for organizing such a lovely event and for having me here. Thank you so much.
Okay, and I'll just re-emphasize how difficult a decision this was for our judges, but the winner of our Young Economist Prize this year is Nicholas Schmitz from the University of Cambridge with the paper, The Downside Risk Channel of Monetary Policy. Congratulations, Nicholas.
Cheers, thanks. That's very unexpected. I have a stick, so if you have 45 minutes, I could give a quick... No, that's a joke. At least someone laughed, thanks. I'm very honored. Thank you very much. It's been a great conference so far. I look forward to what we see tomorrow. Thanks so much for having me and for having this prize. And I hope you all have a nice evening. There will be a poster session, I think, so you can speak to all the candidates, except the one who unfortunately can't be here, including me. Thanks.
Thank you very much. So indeed, there is a poster session. So, please, first of all, please join me again in thanking all the finalists and congratulating the 3 winners. So we'll do one last round of applause just to... And, it was really great to see these papers, and please come to the drinks reception where you'll see these posters and other 3, and you can meet the finalists and all the finalists and talk about your research, or they can talk to you about their research. Thank you. So the reception is on the 8th floor. Yes, 8th floor. Thanks.